Hi guys, in this video we are going to record about the quick revision of audit. So we're going chapter wise, and in this quick revision video I'm going to revise the chapter 1 all parts as quickly as possible. So as you see there, this is about the very basic concepts involved in doing the audit. So let's start with the basic definition of doing the audit. So this is the coverage. Here I'm going to talk about the definition of audit. Then I will be talking about the objectives of audit. Once we discuss that, then one of the fundamental points in audit is the inherent limitations involved in doing the audit. We will discuss that. And then we will also be talking about audit as a discipline is related to several other areas. So what are those other areas that audit is related to? We will also talk about the relationship with other areas. Then I'm going to take you through the standards now that are applicable to your exam, and what are the standards and how is the flow involved in that particular standards. Not only that, we will also be looking at two very important parts here, the quality control aspects and of course agreeing to the terms of audit engagement, which is the kickstart of audit process with standard number 210. So let's get started. Let's do this. So you're going by the definition here as to what exactly is audit. So audit, as you know, is a independent examination. Audit is a independent examination. Now see guys, there's never a reason to by heart any definition. So every definition you go by raising some questions. When you raise questions, you get answers. That's when it makes it the definition, and that's what becomes easy for you to remember. Here let's ask 4 questions. Right, what is audit? So first question that we're talking about here is what is audit? It is an independent examination. Obviously the next question raises as to of what it will be financial information. Now why are we using the term financial information and not financial statements? Because we are expressing an opinion on financial statements, but we are not just checking only financial statements, right? So financial information is a term that includes financial statements plus all of books, papers, vouchers, all of that, books, papers, vouchers and contracts, all of that are included in the financial information. So audit is an independent examination of financial information of an entity. Now when you speak about the next word, obviously the question is, okay, you're doing what and of what and whose work is it? Is pertaining to an entity. Now so when you use the term entity, you have to glorify the term entity. What exactly are you speaking about? Entity, this could be profit oriented or not, irrespective of size or legal form. So this could be a proprietorship entity or a partnership entity. This could be a company, society, trust, AOP, BOI. So go for it and you have all of it, right? Independent examination of financial information of an entity, whether profit making or not, irrespective of its size or legal form. Now, the biggest question of all, why do we do all of this? Why do we do all of this? We do all of this when such an examination is conducted with a view to expressing an opinion, that being the complete idea of audit. The major audit objective is to express an opinion. So end of it, when you deal, whatever you deal, you need to express that opinion. So which is what we are looking at in terms of what audit is. Audit is an independent examination of financial information of an entity, whether profit making or not, irrespective of its size or legal form, when such an examination is conducted to express a opinion thereon. Moving up next is the biggest question here, what are the overall objectives of audit? So this piece of overall objectives of audit is discussed in standard number 200, which discuss about the overall objectives in conducting the audit, and it says what, that there are 2 pieces to the statement. Piece 1 being what? The overall objective of audit is to obtain a reasonable assurance. Now we all very clearly know that we use the word reasonable, not absolute, for a simple reason that we are going to see very soon, that it is not an absolute assurance because of the inherent limitations. Because of what? The inherent limitations involved in doing the audit. So that's a very basic point. So the overall objective of the audit is very clear. It is to obtain reasonable assurance about the financial statements. Fine. What about the financial statement? That they are free from material misstatement. To obtain a reasonable assurance about whether the financial statements as the whole are free from material misstatement. Okay, this is one part of the story. What's the next part of the story here? And obviously after you get to that conclusion that financial statements are free from material misstatement, that you have sufficient appropriate evidences to say that, then you can go ahead and give a report on the financial statements in accordance to the standards. Whatever your findings are, you can place those findings and put up a report that is discussed in the 7 series of standards. We will also see that in detail in the coming points. So what is audit? What are the objectives of audit? And you are obtaining only a reasonable assurance but not an absolute assurance. Guys, this question has been asked as true or false so many times. So be very clear about that, and that this because of the inherent limitations. And as you go by understanding what are those inherent limitations, why are we able to get only reasonable, okay, but not absolute? The logic is very clear. It is because the inherent limitations involved in audit. And what is that inherent limitation? Number one, so auditor, these are about the audit procedures. So the nature of audit procedures, the very nature of audit procedures are so that we involve test checking. And in test checking, there is a portion of work that is not being tested. So wherein misstatements can still be there, inherent limitation number one. Two, the very nature of evidences. See, the nature of evidences, audit evidences are persuasive in nature rather than being conclusive. So they're persuasive, not conclusive. Remember, which is also another very important exam piece. It's only the nature of evidences. You can't get concrete evidences, so there is always still a scope. You do more of work, you can always get more of evidences. And very much the very nature of financial reporting. This talks about the nature of financial reporting. Now, why it talks about nature of financial reporting? Because it involves judgment. Judgments and estimates are used by management. So therefore, the very first inherent limitation is, you can say, the nature of audit procedures, then you can say the nature of financial reporting and the nature of evidences, and also lastly you have all the inherent limitations of internal control which are adding up, because inherent limitation of internal control also form part of the inherent limitations of audit. Plus you have others like fraud related parties, and also something to do with this one, limitations with respect to time and cost. But you can't give them as reasons. I don't have time, so I'm not doing. I don't have the getting the enough fees, so I'm doing it. So that's not the reason. Okay, limitations with respect to time and cost. So these are all some of the very important points that one needs to consider in terms of understanding the inherent limitations. So what all did we discuss here? We talked about the definition of audit, then we discussed about the uh, overall objectives of audit. Now we spoke about the inherent limitations of the audit. Let's get to the next part wherein we are dealing with relationship with other disciplines. Now in between there are two small things that I would also want you to read, are the scope and aspects of audit. So what is the scope of the audit and what are the aspects covered? I think you should have a quick glance of those two concepts as well. Then talk about relationship. Okay, we have audit is not a lone activity. It has a relationship with various other areas like accounting, mathematics, statistics, economics, law. I think these are all the fundamental subjects that you also have part of. I mean, like to start off with your foundation of CPT, this is where you started with. So these are the basic areas where auditor has to have a complete idea of. And apart from that, you should also have an idea of the computer information systems, which is audit in CIS environment today is one of the prominent audits. So if you say that I don't know computers, makes no sense. And there is also, yeah, you have to have a thorough understanding of production, which is nothing but your client's business operations. Obtaining knowledge of the client business, having an understanding of that field is also something very important. And behavioral sciences, now that doesn't again mean that you have a degree in psychology, but definitely it makes a lot of sense for you to understand how it is actually involved in dealing with different people. Now you have to deal with your own article students, you have to deal with your client. You know, you can't be so ignorant and believe in everybody. Somebody may lie on face with a straight face and you would get away with that. So you should be able to have a proper understanding. It's called tact, the art of dealing differently with different people. So behavioral sciences are about that particular tact. And then you have to have an understanding of financial management, which I believe you are doing within capital budgeting, capital structures, ratios, and have an understanding of how to manage your finances. So all these attribute towards what the areas with which audit has a connection. So bottom line, audit is not a lone activity. Audit is connected to all these areas that you see there. And there have been questions that how audit is connected to behavioral sciences, how financial management and audit are related. So these questions have come in the past in the exam. So always they can come again. So be alert with respect to that particular thing. Alright, getting the main part of the story right now. Here are the look at the standards. What are the standards that you're talking about? Now guys, as such, standards are recommended by ICAI. There is a Audit and Assurance Standard Board of ICAI, which is recommended the standard. ICAI is a member of IFAC, which is a global body which has International Audit and Assurance Standard Board. So the IAASB has issued 5 types of standards that you see there on screen: standards on auditing, standards on review engagement, standards on assurance engagement, standards on related services, and standards on quality control. Now, thankfully, the content in SQC is applicable, and of these standards, 26 of those, subject to the latest amendment where 9 standards have been pulled off, 26 of those are again pretty much part of your syllabus, because the 8 series, so totally 38 standards, 3 of them are in the 8 series, which is not part of your syllabus right from the beginning, and then they have excluded a few standards from the existing standards of 200 to 700 series also. So therefore, you are left with a few standards to deal with the quality control standards and the balance 25, 26 standards. Right. So who issues the standard in India is central government. That is again, if you look at this company audit part of it. So 143 subsection 9 and 10, they talk about central government prescribing the standards. But as of now, the procedure is not followed. Till the time central government issues any new standards, those standards that are recommended by ICAI, which are these 5 type of standards, they are considered as standards for the purpose. And then same way when we go with standards and auditing, now this is our piece of discussion, right? So let's go and broadly see what are the standards and auditing broken down into. So introductory matters are dealt between standard 100 to 199, not much of a tension for us. There are only introductory matters, but from where are we bothered about are this the whole of 2 series, wherein you have all the basic principles governing the audit, right from stand number 200 conveying the overall objectives audit to 299, it talks about responsibility of joint auditors. Now all these, once you are thorough the basic principles, you might want to start a very important phase of audit called the risk assessment stage and the planning stage, because the planning is the most important part of audit, because the better you plan, the better you can perform and get the results. So the third stage, audit, planning and risk assessment, there are standards, 4 standards in the 3 series, 300, 320 on materiality and 315 and 330. The 2 4 series standards, 402 and 402 and 450, which are now not part of your syllabus anymore, but they are still part of the story, right? So basic principles governing the audit, of that we have the 2 series standards, wherein you have 200, 210, 220, which is again on quality control, 230 on documentation, 240 is on fraud, 250 is on laws and regulations, 260 and 265 have been pulled off, so you are left with 299, which is on responsibility of joint auditors. This. Moving up next is the next part of the story, wherein you're bringing audit evidence, one of the most important standard series, whole of 500 to 580. There are 11 standards here from 500 to 580, of which you don't have 540, which means you are left with 10 5 series standards, are quite very important. Then moving up next, you may want to rely on the work performed by some others like the other auditors, internal auditors or experts sometimes. So using work is in the 6 series. We have 3 standards here, 600, 610 and 620. Now after the notification, 600, 620 don't remain part of your inter syllabus, only 610 is part of it. So all of these standards, and then of course the most important 7 series standards on reporting, where we have again 700, 705, 706 and 701, wherein we also are supported by 710 and 720, whereas 720 is pulled off, so only 710 is part of the syllabus, right? So yeah, 260, 265, 330, they said the standard is pulled off, but they didn't, like really give 330. But if you look at the content of 330, it's about compliance procedures and substantive procedures. So I always have preferred discussing compliance procedures and substantive procedures, which is a very important part. So doing 330 is no harm, is what I feel strongly. So guys, that's what we have in the basic idea of standards. Very, very important piece. Now all I'm going to take you through is a very, very important flow involved in doing the audit, because this flow, the more you have an understanding about this flow, the greater the subject is going to be easy after, because this is what is the flow involved in doing the audit. And as we go on now, we will be able to see that flow, right? So the entire audit process, let's look at audit process at a glance, how that works. Audit process starts with engagement of the auditor, which is what is discussed in chapter number 210, which is the engagement of the auditor. So in this session we will be discussing that. Now once the auditor is engaged to do the audit, that's the first time he's being engaged to do the audit, it is called an initial audit. What does he do is to obtain the knowledge of client's business. He will obtain the knowledge of client's business. How to obtain the knowledge of client business? Again guys, for all the steps involved in audit, there is no tension that you have to take exclusively for doing this, right? Obtaining knowledge of client business, again 5 points are specified in one part of 315. See, actually 315 has 4 parts. Okay, so the first part of 315 talks about obtaining knowledge of client business, wherein you have 5 points to catch up. Now these two here, that is engagement of the auditor and obtaining knowledge of client business, these are called as preliminary engagement activities. Preliminary engagement activities. So this is before even any stage in audit. So this is a preliminary engagement. Preliminary means even before we begin anything, right? Then moving further to the next, these are obviously the audit planning stage. Planning and risk assessment being one of the most important stages here. So these two stages, that is audit planning. Now this exclusive phase completely is of planning, and planning paves way for doing the further audit procedures. Now if you look at what are the further audit procedures, so first you will determine the nature, time and extent of risk assessment procedures. So these two go hand in hand, that is you will do 300 and also determine the level of materiality in 320. And so once 300 and 320 are taken care of, then you go to 315 to perform that risk assessment. So now once these three standards are taken care, that is planning and risk assessment is performed, then we will get to the most important stage of audit, which is called the performing stage, which is the action stage, where the entire activity keeps going. Now, which is what you need to understand here. So determining the nature, timing and audit procedures is also followed by performing of substantive procedures, which are discussed all through the 5 series standard. The substantive procedures that you perform will be helpful for you to gather the audit evidences, will be helpful to do what? Gather audit evidences. So determining the nature, time and extent of audit procedures, performing substantive procedures, and of course the performance stage is not complete without documentation, right? So let's continue this test. Step number 7 is looking at documentation. Standard number 230 and also other standards here prescribe documentation. So step number 6, documentation. If you're through with that, now like say this is also end of performance stage. Then when you are ending the performance stage, right, that is after you look at this, these 5 stages: preliminary engagement activities, planning activities, and there it kickstarts the performing activities. So which is what exactly is 230 all about. And then moving further are the 2 stages wherein you will talk about forming and reporting. So these 2 stages are titled as reporting. These 2 stages are typing as reporting. So 700 and 705, which are about the reporting stages on how we will be doing, and 700, 705, 706 and 701 all of the reporting standards. So I hope you understood clearly the 8 steps involved in doing the audit, because this is the greater clarity that anybody needs. So once again, to have a quick understanding of this, let's look at all the audit process at a glance. So these 2 here, these ones are called preliminary engagement activities, formulation of an audit plan and program, and determining the nature, time and extent of substantive procedures. Now you will determine the nature, time and extent of substantive procedures by performing risk assessment procedures, and of course you will also do compliance procedures once you know how the controls are. So formulation of an audit plan, this is the planning stage. And all these three, determining the nature timing, that is compliance procedures, substantive procedures, and doing documentation, this is all that these three P's, this is the performance stage. And lastly, formulation of an opinion and reporting. Now these two stages here come down to reporting. Now I hope you got the clarity on what exactly are we supposed to do in audit, guys. Preliminary engagement activities followed up by planning activities followed by performance of these three steps, and wherein all the standards come into picture, and reporting stage. So once again, let me loop you up with the standards. So standard number 210 is what you use to right after this we're going to see the engagement of the auditor. Standard number 210, obtaining knowledge of client business, part of standard number 315, one part of that, right? Standard number 300, essay 300, come on, 320 will all help you in doing the planning, because planning and materiality very important. Then determining and performing substantive procedures. Now these two go with standard number 315, part of 330. Performing whole of substantive procedures involves all the standards from 500 to 620, wherein working papers are documented as part of standard number 230, while this is taken care by the 7 series, SA 700, 705, 706 and 701. So all of these put together will what make the entire audit process. So right from engagement of the auditor, that is from stand number 210, we have to go part by part and try and understand. So again, towards the end of the revision series, we will once look back to see whether we have covered all these steps, right? So that is exactly what we will be dealing with. And of course, if I have to be very clear, we're going to start off with standard number 210. So once again, as part of understanding what we have done, so standard number 210 is a kickstart for the entire story. So what all, now I wrote this procedure right here, we saw this particular procedure of the entire audit process at a glance. So now let me write through without their names as stages, only the standard numbers. So if you look at that, going by that, we have only standard numbers to catch up. So first we will be doing standard number 210, right away we are doing that. 210 is followed up by, in the next session we will be catching up for 315 part 1, which is about obtaining knowledge of client business. So these two preliminary taken care. Then start at the planning stage. We will be performing stand number 300 to know about planning, stand number 320 to know about materiality, and part of 315 to do all of the balance part. So of 315 to know the risk assessment part. So this is preliminary engagement, this is planning. Now let me take you through the standards involved in performance. We have standard number 500 on evidence, 501, 505 on external confirmations, 510 if it's your initial audit, 520 if you want to do analytical procedures, 530 to do sampling, and 580 to obtain written representations of mandatory standards that you will perform here, and also standards 600, 610 and 620 if you are using any work of others. Then you will also perform SA 230 and others, because you will be doing all the documentation involved. And at this point of time where you have gathered everything, there is this small scope before reporting. So after you finish gathering all the evidences and do the documentation, before you go to the 700 series, because you have 700, 705, 706 and 701, these are standards that help you in doing the reporting. But in this piece, there is a very important force called evaluating a misstatement, wherein you will be performing standard number 450. So guys, this is the overall clarity in what sort of application we will do in the standards. If you want, you can take a screenshot of this to understand how the standards are performed and flow, and we are also going to go in the further revision sessions by doing this only. Okay, so I hope that clarifies as to what we are doing and how we are understanding. Let's move on very quickly to agreeing to the terms of audit engagement. Now, agreeing to the terms of audit engagement, this standard has 5 parts, right? There are 5 parts to the standard, which is 1, preconditions to the audit, which only when present will be taking the audit, preconditions. Then if preconditions are present and there are no limitations and you're happy with it, then you will go with agreeing or agreement to the terms of audit engagement, agreement to the terms of audit engagement. And then just in case, if this is your recurring audit, will you have to send the engagement letter again and again, or what are you supposed to do with that? You're supposed to see that, and what is the story of any changes in terms of audit engagement. We are even going to look at that, changes in terms of engagement. And then part 5 is about additional considerations that don't make much of sense in terms of revision, but you can always check that additional considerations, two additional considerations are there where there are conflicts between standards and law. Okay, but otherwise we will now be covering all these 4 points to understand what are you supposed to thoroughly do in standard number 210. Let's start with preconditions, guys. Preconditions to the audit. So there are two preconditions to the audit. One, if your client is not using an acceptable FRF, then what will you be doing in the audit? So the first and foremost precondition that is required for the audit is whether the financial reporting framework to be applied in preparation of financial statements is acceptable. If I have to keep this short, you could say use of acceptable FRF, use of a acceptable financial reporting framework. That's exactly what you and I need here right now, use of an acceptable FRF. Then second one is the most important precondition, wherein you want the management to agree to their responsibilities, because if they don't agree that those are their responsibilities, tomorrow they may not end up doing it. So the first and foremost thing that you need to understand there, obtain the agreement of management that it acknowledges and understands its responsibility. How many responsibilities are there for management? 3 responsibilities, first of which is preparation and presentation of financial statements. 2 is design and implementation of internal controls. These 2 are the fundamental responsibilities of management. Along with that, because we are now doing the audit, who will provide us all the evidence? That is also management, where the third responsibility of management is to provide the auditor with access to all information, access to additional information, and unrestricted access to persons within the entity from whom the auditor seeks to obtain audit evidence. So this is only the person from whom you seek to obtain audit evidence. Now all that you need to understand here is that this particular piece where you are obtaining audit evidence, a very important part, because if this point is not done, then it leads to auditor being falling short of the evidence, which leads to lack of sufficient audit evidence, which may lead to you not giving an opinion or disclaiming an opinion, whereby the compliance to these two preconditions are the prerequisite. They're very, very important. If these two preconditions are not complied, then auditor will not take up the audit engagement. Or if there are any limitations which are prior to the audit engagement, I still didn't take up the audit engagement, I just checked two preconditions. So I hope you're clear with the preconditions. What are the two preconditions? Use of the acceptable FRF and obtaining an acknowledgement from the management that they will fulfill these 3 responsibilities which are theirs. After this, now if only you guys are very sure that these 2 preconditions are present and you can go ahead, then you can put up all of this in a written form of an agreement. But before you do that, check 2 things. What is that? Are there any limitations that are imposed prior? Now, all I want you to understand here is the word prior. Limitations on scope prior to the audit engagement acceptance. So if the management or TCWG, who are those charged with governance, one step above the management, impose a limitation, now that's the story. They have imposed a limitation, that means they're not letting you do what you're supposed to do. If management or TCWG impose a limitation on the scope of the auditor's work in terms of a proposed audit engagement, that the auditor believes the limitation will result in disclaiming. Guys, a simple point, when you end of the day know that it is going to result in a disclaimer, what is the whole point in taking up the audit? So therefore, it is very, very important to understand the connect here, that the auditor believes the limitation may result in auditor disclaiming an opinion, so therefore he shall not take up that particular audit engagement. Not only that, the auditor shall not accept such a limited engagement. Obviously, when you know that management is imposing a limitation and you will not be able to give an opinion, there is no point in taking up the audit. And also to say, the fact that this is like tying your legs and asking you to run, which you anyway can't. So therefore, if there are any limitations prior to this, prior is a very important, before you take up, it's a good opportunity. Before you take up only things are there, so better it is to not take up the engagement at all. This is one situation. The situation number 2 that you will not take up the audit engagement is here, where other factors, what are the other factors? The preconditions are not present, right? So if preconditions are not present, if the preconditions of an audit are not present, then the auditor shall discuss the matter with management, and unless all of the law requires, but there's no law that is requiring you to do that right now, but if there's any law that requires you to do so, then do it. But otherwise, normally if preconditions are not present, again here also auditor shall not accept. So the two specific cases: limitations prior to engagement, limitations prior to engagement, and preconditions, the absence of preconditions. These are two very clear situations where the auditor shall not, very clearly I'm writing it, shall not accept the audit engagement. It's a very, very important point. The auditor shall not accept the audit engagement. So this is part 1 to the standard, guys, wherein we spoke about what are the two preconditions that are required, and then the two situations where auditor will not take up the audit engagement. Now moving further here, we're going to talk about situation number 2. If only everything is good, agreeing to the terms of audit engagement, and we're going to put that as part of the audit engagement letter. What are the contents? Let's look at that. So I want you to clearly understand that there are 6 very important pieces that we will be putting up in an engagement letter. As to what those are is: 1, objective; 2, the scope. Though they are discussed in the same point, I would always like to split them because they're two different aspects. Objective of the audit and scope of the audit. What are our responsibilities, which you already know that it is our responsibility to express an opinion. What are the management's responsibilities, which also we have seen as part of the 3 preconditions, that management's responsibilities are also there here. So the objective of the audit, scope of the audit, responsibility of the auditor, responsibility of management. And now, earlier you did check that whether there is an acceptable FRF in preparing the financial statements, but right now, see, there are certain situations where the acceptable FRF may not be the applicable FRF for the organization. Now, like say for example, a company can prepare a balance sheet in T-shape format. A company can prepare a balance sheet in T-shape format, but at the same time, that is not what is prescribed. If you look at the Companies Act, what is prescribed is as per the Schedule 3 of the Companies Act. So, though you may be able to prepare it in T-shape, and it's a very acceptable form because that's also one of the forms of reporting, you cannot consider that as a applicable FRF. So, acceptable is what a framework that we can prepare and present financial statement. But the question now is it also the applicable framework? So, which is also something that we need to identify, and identification of the applicable FRF. This is point 5, 3, 4. So objective, scope, responsibilities of auditor, responsibility of management, and applicable financial reporting framework. Not just that, you will also pull off the reference to expected form and content of the audit report. See, end of the audit, what is the ultimate objective? It is to give the audit opinion, right? So now at the end of all this story, you cannot say that, we don't know in what form we have to give the report or what should be the content of the report. So it is always important that you properly in the report itself refer to the expected form and content of any report to be issued by the auditor, and a statement that there may be circumstances in which a report may differ. So if law or regulations says that it will differ, then there is a situation where it may differ. Okay. But guys, you should understand that these 6 points will be written clearly in the engagement terms only when the law or regulation does not prescribe all this. Now, if a law or regulation has clearly defined all these 6 points, point number 1, you anyway can't overrule that. Point number 2, what is the fun in seeing the law and writing the same thing again in the engagement letter? So just state the fact that such law or regulation is applicable. Instead of writing down all these points, audit shall be conducted as per so and so act. Be it audit will be conducted as per Banking Regulation Act. Audit will be conducted as per Companies Act. Because anyway the provisions are already told there. So if a law or regulation prescribes in sufficient detail, so it's given in sufficient detail in the law, so there's no real reason why you have to do it again, right? If law or regulation prescribes in sufficient detail the terms of audit engagement, then the auditor need not record them in a written agreement, except for the fact that such law or regulation is applicable. Just say that such law or regulation is applicable. You don't have to do anything further with respect to that. Okay. And also you should take an acknowledgement from management, a copy of the engagement letter, this is also called the terms of engagement, or in other words it's called the audit engagement letter. So get this signed by the management that they have acknowledged their responsibilities and they understand what it is. Okay. So put up all these terms. Who prepares the engagement letter? The very simple question. It is the auditor always. Remember this. A lot of people have made mistakes in true or false and all that. So it is the auditor who prepares the engagement letter and management just acknowledges. That word acknowledges clarifies that content. Okay. So that's the second part of the standard. So once preconditions are there and you guys are happy that you can take up the audit, put up audit engagement terms. Then moving further is to understand what is the story going on in case of a change in terms of engagement. Just in case if somebody asks you to change, the management asking you to change the terms of audit engagement, then very important point is auditor shall not agree. Auditor shall not agree where there is no reasonable justification. So if there's no reasonable justification, then the auditor definitely should not agree to the change in terms of audit engagement. And if the auditor is requested to change the terms just prior to the completion to a lower level, now see, you can do that. It's not a problem. Conveying a lower level of assurance means our assurance levels are coming down slightly because of the change in terms, but when compared to the old terms only. But that doesn't stop you from, you know, changing the terms to a lower level for a simple reason that if that lower level of assurance, what they're speaking about, if that conveys reasonable assurance to the auditor, so that means the auditor is still happy taking that lower level of assurance, it is giving him reasonable assurance, that is not a problem. So in such a case where reasonable assurances are given, there wouldn't be any kind of a problem. If terms of audit engagement are changed, then they obviously have to record it in a new engagement letter. Put it in a new engagement letter. You got to put that in a new engagement letter. So you don't agree if there are no reasonable justification, and if there is a reasonable justification and you're willing to change, whether it conveys a higher level of assurance or lower level of assurance, you can do that, but you just have to be very watchful about the reasonable assurance that you're picking up, right? And new engagement letter shall be put up in this particular case. And if the auditor is unable to agree, to the change in terms, now this is where a very caught up situation, this one, you are not willing to agree to the new terms, auditor is unable to agree to the change in terms of the audit engagement and is not permitted by management to continue the original engagement. That's a block. You can't go one step forward because you don't want to do the new terms. You want to continue the existing terms, but management is not letting you do that. So you can't go backward, you can't go forward, you're stuck in between. Not doing the new terms because you don't like them. You aren't continuing the old terms because management is not letting you do that. So it's a caught up situation. What is that you will do in this kind of a situation? What is that we will do? There is nothing better to do except for withdraw from the audit engagement. So when you're caught up like that, there is no situation that makes it better. So just withdraw from the audit engagement wherever possible, and obviously you have to tell people who are responsible that you are withdrawing. So just do that. Determine whether there is any obligation, either contractual or otherwise, to report the circumstances to other parties such as a TCWG or the owners, and just check if you have to tell somebody, and if it is so, you might want to tell that to them. Then moving up to the last part of the standard here, just in case if there's recurring audit, guys, initial audit you definitely have to send an engagement letter, but when it comes to a recurring audit, there is no reason why you have to send the same engagement letter again and again unless there are any changes. So what are the circumstances under which you will send in a recurring audit? Recurring audits, the auditor shall assess whether circumstances require the terms of audit engagement to be revised. Circumstances require them to be revised, and when there is a need to remind the entity. So what are the only two changes where the terms are to be revised? One, where you need to remind the entity of the terms, and that's exactly when you will be sending this. The auditor may decide not to send a new engagement letter or other requirement each period. It's not needed. Why do you have to send it again and again? However, there are some factors, like 8 examples are given there. Just brush through that. If you think that entity may misunderstand the objective, any revised terms or special terms are added, change in senior management, change in ownership, change in nature. These 3 changes definitely merit you to send a new engagement letter where the entity misunderstands the objective, revise the special terms, a recent change of senior management, a significant change in ownership, a significant change in nature or size of the entity's business, a change in legal or regulatory requirements, and also a change in financial reporting framework, and lastly a change in any other reporting requirement. So if there are any of these changes, then definitely there is a need for you to remind the entity about this, and therefore you will be sending a new engagement letter. Otherwise, you will stick to whatever you have sent. Okay, so that's it guys from standard number 210, 4 parts to a standard. Preconditions being part 1, part 2, putting them into an engagement letter, part 3, if there are any changes, agreeing to the changes and putting them in a new engagement letter, and having a discussion on part 4 on recurring audits. Very clearly it is said that auditor may choose not to send this period after period because it doesn't serve any kind of a purpose doing that. But if there are changes or there's a need to remind the entity, then definitely you will need it. It's a very important standard guys. Of course, I understand it's quite lengthy in terms of comparison with other standards. Yes, of course 210 is one of the lengthiest standards, but this is how you got to break it down into 4 parts and understand. Part 5 is about additional considerations where there is a conflict between law and financial reporting standards and a conflict between law and audit reporting standards, the standards in auditing. So how will you address that? Of course, law will prevail and you should make sure that there are appropriate disclosures. So you can get to that part. To wind up chapter number 1, I'm going to quickly take you through the last part where there is a glance about the quality control elements, where in standard number 220 and SQC1 they describe these quality control aspects, and these are the responsibilities of engagement partner. In other words, the auditor, the engagement partner has to be bothering about all these points. The 6 quality control aspects, going by the first one, it is his responsibility to take up a leadership to make sure that quality is followed in audit. Leadership responsibilities for quality on audit is always resting on the shoulder of the engagement partner. So the actions of the engagement partner, he has to take the leadership responsibility to make sure that appropriate message to the other members of the engagement team in taking responsibility is sent. Understood? So whose leadership responsibility is to maintain quality? It is the engagement partner. It is also the duty of the engagement partner and all of the team members to follow the ethical requirements, which I believe you know very well, the ethical requirements of integrity, objectivity, and of course you need to add up one very, very important point, which is called as independence, wherein we have 2 concepts discussed about independence, independence in mind and independence in appearance, and both should be there to avoid all those 5 threats to independence, right? Please go through those 5 threats also as you revise. They call the self-review threat, self-interest threat, advocacy threat, and you have familiarity threats, and of course intimidation threats. This could be a question in the exam guys, so you might just want to go through that also. Integrity, objectivity and independence, IOI, professional competence and while performing the work, due care. The rule of confidentiality, what does the rule of confidentiality say? That the auditor shall perform the audit and all the information that he gathers during the course of the audit shall be kept confidential. That is, you have to put it in other words, the auditor shall not disclose any information obtained during the course of the audit to any person. Understood? But of course 2 exceptions are there, unless it's permitted by the client or required by law or regulation, and those are the only 2 situations where he opens his mouth, which is called the rule of confidentiality, which is binding him. Integrity, objectivity, independence, competence and due care, confidentiality, and most important point is a professional behavior, where you have to maintain professional skepticism, which is undeniable fact of maintaining a professional skepticism. And what is professional skepticism? Is an attitude of 2 things: maintaining a questioning mind and being alert to conditions. So 2 ethical requirements, 6 ethical requirements as part of quality control aspect number 2. Moving up next, it's your team members who do the audit. So while recruiting, training and making them do the work, human resources, they have to make sure that policies and procedures are framed for maintaining a quality, like a leave policy, like what timing policy, when they have to come in, when they have to go out. Every firm should follow a quality control policy for their human resources. Firm should establish quality policies and procedures to make sure that sufficient personnel are there with all capabilities, competence and commitment. Randomly you should not pick up people, right? You should pick up people who have capabilities, competence and commitment to ethical principles, which you read in point number 2, which are necessary to perform the engagement properly. Okay. Leadership responsibility for quality in audits is with the auditor. Auditor, the engagement partner, engagement team members, all of them have to follow the 6 ethical requirements, and also while recruiting human resources, follow the policies and procedures meant for that. One of the most important points which has come for the exam so many times as a question put a start at that is the fourth quality control aspect. Before accepting or continuing any client engagement, the word acceptance is used for initial audit while the word continuance is used for a recurring audit. What should you do? SQC1 tells you to do four things before you accept or continue an engagement, which is you have to check four things: the integrity of principal owners, so like how honest they are and all that, the principal owners of the entity, their integrity aspects. If you check them, you should check our own team, obviously, whether the engagement team is competent to perform and do they have the capabilities to do that particular work, integrity of the owners of the entity, our own team members' competence and capabilities, whether the firm and engagement team will they be able to comply with relevant ethical requirements. So if this engagement is all about troubling you, and if this engagement is all about not letting you comply with the requirements, and I don't think so it's a very fruitful thing to do. So where the firm and engagement team comply with ethical requirements and significant matters that have arisen during either current or previous audits, you have to take them into considerations to again understand what implications will they have on audit. Four very important points. This question has been asked many times in the exam. What are the factors to be considered by the auditor while accepting or continuing a client engagement? So 4 points, guys: integrity of the owners, our own engagement team's competence and capabilities, and if you can comply with the ethical requirements, and significant matters which are arising during the audit. Not only that, the engagement partner is also responsible for the engagement performance, that it is performed well within the time and also by complying the professional standards and legal requirements. So the firm should establish quality control procedures to make sure that there is a reasonable assurance that you can obtain by performing this engagement by sticking to all the standards and legal requirements. And most importantly, setting these is of no use unless you monitor them. The firm should establish policies and procedures and make sure that you have to, such policies should have an ongoing consideration. That's a very important thing, ongoing consideration, and you have to monitor whether they are relevant, adequate, and operating effectively. Those are the words that you have to keep in mind. So you have to monitor. Simply setting up policies of no use, right? So you have to monitor them and make sure that that's the particular thing taken care of. So guys, that's what we have in chapter 1. This is a very quick revision of chapter 1, and this is pretty much, I think now you have an idea. If you have done the revision of chapter 1 already, this will be of great help, I guess, because we've done a very quick revision of the entire chapter 1. But if you have not done any revision and this is the first time you're watching a video like this, so guys, this is the pace at which you have to do revision if you have to be be ready for the exams. Okay, so if you're not able to catch up my pace, or if you feel this entire video was too fast for you to catch up, I think you should work hard enough right now, because this is time where you will have to be in the revision zone, and this is how revision works, because you can't spend 8-9 hours on every chapter which you do for classroom training. So I think the ones who are watching this, if you're comfortable with this video, you should do a thumbs up and then move on, wait for the next videos to come. And then of course, I do make sense to those people who are not making sense, because this guy is very fast right now. You just have to understand that this is the pace and this is the level of revision that is meriting for the exam. So very soon I will see you in the next session, wherein we will be speaking up about chapter 2 and parts of chapter 3. So things are going to go fast and the schedule will be completed in that manner. So I want all of you guys to be up to it and then keep this video. We will also be releasing videos wherein there's a cumulative marathon video to the end, whereby you can have a complete revision, but doing it in parts is always the best thing. Once you finish doing it in parts, couple of times before the exam, you can do the marathon. I will soon see you in the video number 2, where we will be covering about chapter 2, the quick revision there. Hi guys, so this is quick revision part 2. We have already seen up till engagement of the auditor in the last session. So in this session we will be going to see the quick revision of the further steps. So this is the scope of this session. 315 part 1, that is obtaining the knowledge of client business. I'm going to take you through that. Then 300 and 320, which is on planning and materiality. We will also then look at the balance part of 315 as to what we are supposed to deal with it once we've already dealt understanding and assessing the risk. And then we will also move about discussing compliance procedures and substantive procedures. So hell a lot of things to do in this session. Alright, let's get up, and I hope from the last session everybody has understood what range of speed is required in terms of a quick revision. See, because the very idea is once you know all the topics, this particular video should be a great help for you to revise everything very quickly, right? Moving on to the beginning, I want to take you through quickly once again to what is called as the audit process. Let's look at what audit process is all about. So we have already seen engagement of the auditor, which is what was spoken in standard number 210 pretty clearly. We discussed in the last session, and also we have discussed certain quality control aspects. But then before we go to formulation of the audit program, I think these two, which are called as the preliminary engagement activities, right now I think we have to go by this here, obtaining knowledge of the client business, standard number 315, and part 1 of that will speak about it. So that's it. That's what we ideally are looking at trying to do. We will do one thing. We will go ahead and we will see what we can do to obtain knowledge of client business. 5 very simple points to start off, guys. So obtaining knowledge of client business as part of standard number 315. So this entire set of understanding the entity and its environment, that's what the crux of 315. If you have constantly observed what 315 has always spoken about, 315 has been a 3-part standard. Part 1 is about understanding the entity and environment. Part 2 is about understanding the internal controls. Now, if you have done these two clearly, then we will be going about doing identify and assess the risk. Identify and assess the risk. This is exactly what we will be doing in terms of our understanding with respect to the 315. There's 2 parts to this standard we will deal later. Right now I'm going to take you through the 5 points. So whenever you start up the audit, all you need to do is to have a correct understanding of your client, for which first you need to understand to which relevant industry do they belong to. What are the regulatory and external factors? Now, because regulatory and external factors, these change from industry to industry. There's always a like a set of rules that apply exclusively to one particular industry, right? So that is exactly what is supposed to be understood by the auditor first. Like, what are those laws and regulations that are applicable to my client? Does my client belong to real estate? Does my client belong to software industry? What is the industry that he actually belongs to? That's the whole point. Relevant industry, regulatory and other external factors. If you have understood that, then we have to understand broadly a very important umbrella term. When I say umbrella term or omnibus terms, these are certain things which have deep meaning inside, which is what is called nature of the entity. Now, how do you understand the nature of the entity? Nature means what is the entity all about? What is it doing? How is it doing? So these are some things that one needs to understand about the nature. Nature of the entity, including its operations. Operations basically to understand what they do, where they get their money from. Ownership and governance structure. This is more to understand somebody who you have heard as TCWG. A clear split between who is TCWG, who is management, and who are the actual owners. So owners, regulators, TCWG is something that we need to have a perfect clarity on, because what is the structure, the overall, like you've seen organization structures and management, likewise here you need to understand who's having that ownership and what is the governance structure. Once you've taken care of both these, then what type of investments have they made? What type of investments have they made? The type of investments that they have made, and of course the type of what type of investments the entity is making. Because if you have made investment into another company in which you hold more than 51% stake, now they can all become your subsidiaries and all that. So therefore you need to understand what type of investments did our client make. Is it a long-term investment, or is it an investment which is current investment which is set to be sold within 12 months? So what is the investment that our client made? Operations, ownership and governance structure, the type of investment made, the way entity is structured, that is their organizational structure, and how it is financed. That is exactly where we talk about debt and equity. So here you know what exactly are we taking into consideration. So Are we solely financed by debt, which is a too risky thing? Are we solely financed by equity, which means we don't have any debt advantages? So considering all this, these are some of the points that we need to take into our consideration. Moving further, every entity's selection and application of accounting policies that will differ. Entity's selection and application of accounting policies, which will vary from entity to entity. Therefore, it is very important for us to understand this context. In this particular case, what did our client actually do? Not only that, the entity's objectives and strategies, and those related business risk. See, every entity will face a risk that they may not be able to achieve their objectives, and since in this particular case we're talking about they may not be able to achieve their objectives, that is exactly what we're counting as the risk. So what is the objective and strategy of your client, and what are the hindrances in achieving those, like what associated business risks are there in that, is also something that we need to understand. Then after these are done, you will measure the entity's financial performance. Now you can use ratio or trend analysis to do this, because what happened in the past, you can take the last few years balance sheet and try and understand, and then go by dealing with it, right? Industry, regulatory and other external factors, the nature, like you can understand the operations, ownership and governance structure. Then you go by the type of investments that have been made, and the way entity is structured and financed to understand the nature. Relevant industry, nature, entity selection and application of accounting policies, the objectives and strategies of the entity along with their associated business risks, and the measurement of financial performance. I hope things are going good, and that's what we have in the understanding of 315, which is now being speaking about the knowledge part, obtaining knowledge of the client's business. Then moving further, herein we are going to talk about, so these two steps right now have been taken care of. So right now, very important step wherein we are going to talk about formulation of the audit program, wherein we have to have the complete understanding of standard number 300, and then of course I will take you through some of the important points with respect to materiality. So let's revise those two standards, standard number 300 and standard number 320 on audit materiality. So moving further to standard number 300. So this particular piece of standard number 300, which is on planning and audit of financial statements. Now, before I go to understand, let you understand what this is, let me give you a quick framework. I want you to see this right in here. All we are trying to understand is make us comfortable in doing some things that we actually are supposed to. Like say for example, herein we talk about standard number 300. Standard number 300 is framed in the context of recurring audits normally. Framed in the context of what? Recurring audit. At the same time, standard number 300 also identifies certain additional considerations. It identifies what? Additional considerations, and that for initial audit. This is where you take up the audit for the first time. Got it? So if you do these two breakups, you know what you will be actually doing. Now what happens is, whatever we do in recurring audit, this side will be done here in the initial audit. So recurring audit will, all activities done in recurring audit will be performed in an initial audit, plus you will have these additional considerations to take care. And looking at what we will do in recurring audit, they're again broken down into two. Recurring audit is talking about this one, preliminary engagement activities and then planning activities. Okay, as part of planning activities we have two, that is establishing overall audit strategy, and developing an audit plan. Now that's exactly what we have to try and understand in doing this. Okay, so this is the broad framework, guys, what you see there, standard number 300. So if you're carrying a notes right now, see, whenever you're finding certain things important on screen, it's always good to make notes. If you haven't made one before, if you already have one, you're cross-referring that, it's amazing, right? So in standard number 300, we're talking about recurring audit, and in recurring audit we'll do two things. One is preliminary engagement activities, and two are planning activities. Now we'll get to that. First, preliminary, before even we commence anything about planning, first thing that we need to do is to have an understanding of the continuance of client relationship. Now, why are we using this term continuance? Because you already have a established relationship. This is in case of a recurring engagement, right? So we use the word continuance of client relationship. And in my last segment towards the end, I already discussed about quality principles in standard number 220, right? Acceptance and continuance for the client. 4 points we discussed, right? That is exactly what here they're asking you to check. The integrity of principal owners, competence of our own team members. So these are all something that they want us to actually check. So continuance of client relationship, that's point 1. Then 2, ethical requirements including independence, which is also the part of 6 ethical requirements: integrity, objectivity, independence, professional behavior, professional competence, and maintaining confidentiality. 6 ethical principles they've asked to check, and we did do that in 220 in the last segment, right? And not only that, understanding the terms of audit engagement as per standard number 210. So if there is standard number 210, all I want you to do is to have a understanding of the complete terms before even you start the planning of the audit. So once again, standard number 300 is about planning an audit of financial statements. And now that you're planning an audit of financial statement, you are expected to plan it in proper context. So wherein you talk about recurring audit and also initial audit. So that, keeping that in mind in that context, you need to understand what are we doing here. We are doing preliminary engagement activities and planning activities. So I hope you got part 1. Let's move on to part 2. So part 2 here we're going about 2 things: establishing an overall audit strategy and developing audit plan. Now these 2 put together here, these are called as planning activities. Planning activities. I hope you have a clarity on what you're supposed to do. Now guys, this one, the establishing overall audit strategy, that alone has the potential to come in the exam for a separate question. So I want you to concentrate on this piece. So what are we doing while establishing an overall audit strategy? While establishing an overall audit strategy, it is important for us to identify the characteristics of the engagement, and define its scope, because from engagement to engagement it differs. So all I want you to do is to identify the characteristics of the engagement and define its scope. Ascertaining reporting objectives, because at the end of it we need to know what exactly are we reporting about, right? So if you at the planning stage only know that it is important for us to at this stage only we have to discuss the fact that what is it we have to ultimately report, because after doing the entire work suddenly you realize that okay, this is not what I work for. Doesn't make any sense, right? So ascertaining reporting objectives of the engagement to plan the timing of the audit, and nature of communication required. So what is the first thing that we discussed here? What are the characteristics of engagement? Because they change from engagement to engagement, we need to identify the characteristics of engagement and define its scope. Ascertain the reporting objectives of the engagement, and nature of communication required. Now there may be several factors that you consider the past, right? Consider the factors that are significant in directing the engagement team's efforts. Now as an auditor, it's very important for you to channelize the efforts of people, right? Okay, so consider factors that are significant in directing the engagement team's efforts. And not only that, ascertain the nature, time and extent of resources necessary to perform an engagement. Ascertain the nature, time and extent of resources. This is not NTE of audit procedures, guys. This is the NTE of the resources required. Ascertain the NTE of resources necessary to perform the engagement. And whether knowledge gained on previous engagements. So if at all you have gained any knowledge from previous engagements, if you have worked here as an internal auditor, or you have rendered some assignment, or you have some association with the client in the past. So did we or do we gain any knowledge of that past? Whether knowledge gained on other engagements performed are relevant is something that we also need to understand. This is the consideration of establishing no audit strategy answers the question of what to do in the audit. It's a very important part to discuss what to do in the audit. Okay, so identify the characteristics and define the scope. Ascertain your reporting objectives. Consider what you're supposed to do to direct the engagement team's efforts, and ascertain the nature, time and extent of the resources required. How many people are required? Are they less in number, more in number? What is it all about? And then you also need to consider whether the knowledge gained on the engagements that you did in the past, are they of any use to you? Now, if you have done all of this, developing an audit plan is actually very simple, you know. How do you do the audit? Develop an audit plan, they're telling. How do you do that? Simply follow standards, right? You just have to follow standards on auditing. But if I have to tell you very clearly, follow standards, a very blanket answer. So if we have to make it more elaborate and content to make it understand, what we are supposed to do here is break it down. First, what are you doing? We're doing risk assessment procedures. As you go by the previous part, we did know. So after obtaining knowledge of client business, first you're doing planning. That is wherein you do all the planning activities required to perform risk assessment procedures. Once you perform risk assessment procedures, you will have an understanding of how much risk is involved in the organization. Now, once you know how much risk is involved in the organization, you will again see what controls have they established and obtain an understanding of controls. That is where in 315 we do a risk control matrix. What is the risk? What is the control required versus what is the control applied? Now, if we have a thorough understanding of this, then we can go about deciding as to what to do further. That is called further audit procedures, which we discuss in 330. I hope you're getting the clarity as to step by step what we're doing. So while we develop an audit plan, first let's plan to do 315, which is about risk assessment procedures. Based on the assessed risk of material misstatement, we will go ahead and discuss the further audit procedures as per 330, which are nothing but in the nature of compliance and substantive procedures, which should be the last part of today's session. What we are discussing, we will get to the closure where we do compliance and substantive procedures, wherein I will explain you the entire flow once again. So we have developed the audit plan based on the audit strategy that you have established, and more to this, after you do 315 and 330, whatever other standards are required, there are so many other standards, right? You can comfortably perform whichever standard you actually need. So considering all this, I think this is a major part. So going back here once again, let me try to explain you that quick idea of recurring audit. In recurring audit, we're doing two things. One is preliminary engagement activities, wherein you're doing these three steps. Two is planning activities. Planning activities are further broken down into these two: establishing an whole audit strategy and developing an audit plan. We have done this. Now what is left over is the other piece. You will do all of this again in a initial audit. In initial audit, apart from doing all of this, you will also, that is in addition to what you have done here, an extra step. What is that? This is called additional considerations. Additional considerations in your initial engagements. So when you take up the initial engagement, so you will do everything of what you did in recurring audit, plus these two additional considerations. Remember, sometime back we discussed this term called continuance of client relationship. Now, to be very honest, continuance of client relationship doesn't make any sense, for a simple reason that this is the first time you've taken up an audit. So when this is the first time you've taken up an audit, how will you use the word continuance? So that is exactly why we're using the word acceptance of a client relationship. Now, if this is the initial audit that you have taken up, then you will have to use the word acceptance of client relationship. But the same 4 points, would you check there? That is the same 4 point that you will check here. But this time we're talking about acceptance of client relationship. Then communication with predecessor auditor or previous auditor, right? It's a very important thing. This is an ethical requirement. If you are not doing this, you will be guilty under clause 8 of part 1 to schedule 1 of the Chartered Accountants Act. You will be guilty, because communicating with predecessor auditor is something that we need to actually do, for a simple reason that it is a matter of ethical requirement. Okay, so and what we communicate, we will just communicate the fact that we have taken up the audit in which they were considered the predecessor auditors, they were as the predecessor auditors. So we'll just have to ask them that, is there anything that will preclude us from taking this assignment? That's it, that is stop us from taking this assignment, because whether to respond or not is their choice, but our duty is to just make a communication, and that is exactly why we are making this kind of a communication. So this is the overall picture of what we do in standard number 300 as to planning and audit of financial statements. Now, okay, where do we stand in our timeline? We did standard number 210, SA 210, right? This was followed by SA 315 part 1. Now that was because we discussed and decided about how to do knowledge of client business, and both these were called what? Preliminary. Both those were called preliminary engagement activities. Now let's get to the major part here, planning and risk assessment, which is what you're doing now. Planning and risk assessment procedures. But before we go to 315, we did stand number 300, which explained about planning. So now is the time for us to understand the concept of materiality as part of 320, and then come here, do risk assessment procedures based on 315. Okay, so this is what we actually are supposed to do in terms of what we will be doing actually in risk assessment procedures, and then this will be followed up by further audit procedures. This will be followed up by what? Further audit procedures. Now wherein further audit procedures, they're discussed in 330 as in called as compliance and substantive. So these are all the points that we are supposed to discuss. I hope you're getting the picture right now. So these are called preliminary engagement activities which we have completed. This is 300 we've discussed. So should I move on to 320 on materiality, wherein we will do 320, have an understanding of materiality, so that will help us to start the audit, whereby using the concept of materiality we can understand whether the financial statements are free from material misstatement at a later point in time. So what constitutes to material is a very important factor. So let's now talk about materiality. So these are some very important concepts, guys. Materiality, let's deal with this, right? As a matter of fact, as in materiality, what items are material? Those items, materiality or material items, are those items which affect the user's judgment. Items which affect the judgment of users. Judgment of users, that's what is called as material items. So what items are material? If somebody is asking you, material items are those that which affect the judgment of users. As part of this, standard number 320 is what we deal materiality with. Okay, so what items are material? All those items which affect the judgment of users, the decisions that they take based on what they see in financial statements and which influence them, they are all part of the concept of materiality. So we need to now understand one very important point about materiality, which is nothing but materiality is not just going to deal with size of an item, it also deals with nature. These are some points that I want you to keep in mind very strongly. Materiality not just is bothered about size, but it's also about the nature, because one of the most important conclusions that we derive at the end of the story is even disclosure, sometimes non-disclosure of material item. Now non-disclosure of material item can't be quantified, right? But how material is it? So something like that is to be analyzed, which is very important. So materiality is affected by two factors, to the size and nature of the misstatement. Size and nature of the misstatement. Then one more important point about materiality is the levels at which materiality is discussed. Now materiality is discussed at overall financial statement level, and also for individual class of transactions, account balances and disclosures. And most of you have seen this word as nothing but assertion level. Okay, so the two levels that they're talking about materiality being set are, one, the assertion level, and the one, overall financial statement level. So please understand, materiality is something to do with the seriousness of an item, right? How influential it is in somebody's decision. That's what materiality is all about. So this is a very important point that one needs to consider. Items which affect the judgment of users, size and nature of the misstatement, and also it is discussed at two levels. And one more point that I would want you to also understand is materiality is defined in two stages. Materiality is defined in two stages. What are the two stages? It is used in the planning stage. And it is also used in the performance stage. Guys, as I told you, if you're if you're getting comfortable with things of what I'm saying and understanding it, it's also better to parallelly make notes. Okay, so if you haven't done that, this video will not go anywhere. After it's uploaded, it will definitely be there only. So if you want to come back and make some notes about all this, yeah, keep it this, because going back and reading the content one day before the exam from the main book is a big challenge, right? So we need summary notes, we need quick revisions, quick references. These are the things. No, if you have enough time and you can plug in your earphones and listen to all this, you can afford to do that if you are like very peaceful at mind. But if you want something always to be seen and read, now some people have the practice, like they have to see the book and read. That's what gives them comfort. Nothing wrong. So that's why I suggest you make summary notes. Okay, right? This gives a preliminary picture of materiality. So before I step into understanding aggregate value of misstatements, one last time, materiality is affecting something that affects the judgment of users, size and nature, two levels, overall level and individual level, and two stages, planning and performing. Moving up next is a very important topic called as aggregate value of misstatements. Aggregate value of misstatements. Now guys, this term aggregate value of misstatements, you've heard it as aggregate value of uncorrected and undetected misstatements, right? So this aggregate value of uncorrected or undetected misstatements is a basket of three things, right? Remember, this is a basket of three things. As when you find a misstatement, throw it in the basket. If you ask me, sir, what all will you throw here? Right? The contributing factors to this basket of aggregate value of misstatements is 1. Misstatements which are identified by auditor. Misstatements identified by auditor. And this is what he did during the audit. Misstatements identified by the auditor during the audit. Plus, what else will form part here? Misstatements which are uncorrected. Misstatements uncorrected, not identified by auditor. Now you may ask me, sir, if it is not identified by auditor, how will it fall here? So please understand, just because you didn't identify doesn't mean it's not a misstatement. You did sampling procedures. Now what if it's not covered in the sampling part? So there may be several misstatements which have not been identified by the auditor, but they are also part of misstatements. And what if some of them turn out to be material? So therefore, misstatements uncorrected, that is also a piece that one needs to consider in this context. Misstatements identified by auditor, uncorrected, not identified by auditor, plus the third one is nothing but the net effect of uncorrected misstatements of prior years or previous years. If there are any uncorrected misstatements of previous years, they haven't been rectified yet, the uncorrected previous years, so those are also taken into consideration. Got it, guys? It's a very important concept called aggregate value of misstatements. Now you may definitely ask me at this point of time, why are we discussing about aggregate value of misstatements? Because right now the aggregate value of misstatements is a very important consideration for us to check whether material misstatements are there. But that does not happen here in 300, that happens in 450. Standard number 450 is all about this. Which one? A comparison between what and what? Comparison between aggregate value of misstatements, plus, or sorry, versus aggregate value of misstatement versus level of materiality. So aggregate value of misstatement to the level of materiality, that's what you're going to use to obviously cross check what exactly are material misstatements. So that is what is going to happen in that particular standard in 450, right? So what items are material and what's aggregate value of misstatements? And moving further, we have a very important concept which is from the standard, which is called materiality in the context of audit. So which is also something wherein three items: misstatements including omissions are material. All misstatements including material only when if they affect the judgment of users. Okay, misstatements including omissions are definitely material if they affect the judgment of users. 2. Misstatements including omissions are material if they affect the judgment of users. And 2. Judgments about materiality. Whenever you are judging about materiality, you always take into consideration 2 things: size and nature. These are the 2 things that you always take into consideration. And 3. Whenever you're talking about materiality, it has to be spoken about in common consideration. Common consideration for financial statement users as a group. Consideration of common financial information needs of users as a group. So take all the users as a group, because you can't start discussing materiality for one person this time, one person that time and all that, right? So it's always a challenge, and this is exactly what you're supposed to do. So keeping in mind 3 items. What are the materiality in the context of audit? Misstatements including omissions are material. Judgments about users are material when you consider the size and nature of the misstatement. And then materiality is common consideration of financial statement of the users as a group. So this is exactly what you need to consider while you talk about materiality. Not only that, you got to make certain assumptions about users, right? 4 assumptions about users. Assumptions are 4 in number. You make assumptions that 1, they have reasonable knowledge of business. Reasonable knowledge of business. 2, what they have is they understand how financial statements are prepared, presented and audited. How prepared, presented and audited. So reasonable knowledge of business, how financial statements are prepared, presented and audited. And then you also need to make them understand the inherent, you also assume that, they understand inherent uncertainties. So assumptions are that users understand or have reasonable knowledge of business, understand how financial statements are prepared, presented and audited to the levels of materiality, and they understand inherent uncertainties involved in financial statements preparing, that they have judgments and all that. And they also understand and capable of making, they're capable of making what? Reasonable. They're capable of making reasonable economic decisions. So if you ask me, sir, is it not too much to make these many assumptions about the users? Definitely. But then if you can't make this assumption, you are going nowhere. Okay. So these are the assumptions that you have to make about the users. So now you have only one bunch of users called the group of users, for which these 4 assumptions are there. And now you will set up one solid thing called materiality at financial statement level as a whole. And then you will also set up materiality for individual class of transactions, account balance and disclosures wherever they are applicable. At this point, the last concept that we would want to discuss in materiality, it is called benchmark materiality. It is called as benchmark materiality. It is nothing but expressing materiality as a percentage of a chosen benchmark. That's the definition. Chosen benchmark. Expressing materiality as a percentage chosen benchmark. If you have to pick it up in my language, it's like dash percentage of dash. So in the first dash, you take whatever percentage you want, 1, 2, 3 up till so on, whatever number, dash percentage of. In the second dash, now herein in the second dash, you can take anything. You can take profit before tax, you can take turnover. These are all called benchmarks, right? So these are all something that you will take into consideration. Profit before tax, turnovers, or fixed asset, anything, whatever that suits that particular entity, you can take the second. So if you ask me a question, sir, what will be ideal to select in the second dash? Okay, so to select in the second dash, the last part of discussion, factors, factors that affect the benchmark. Factors that affect the benchmark. So if you're having the book right now, guys, you can mark 2 stars to this question. 5 points are there, they're very important. So factors that affect the benchmark, 1, what part of the elements, you have to cover all elements of financial statement, that is nothing but the balance sheet, P&L, cash flow, notes and all that, all of those, right? Balance sheet, P&L, cash flow. So you're talking about assets, liabilities, income expenses. You got to cover all elements, choose which one it is the one. Then the second factor that you will be considering is items which draw attention of users. Items which draw the attention of users. You have to consider all those items that you believe will draw the attention of users. And three, you will also consider the nature of entity, because what sort of an entity it is, and life cycle stage, where it is in the life cycle stage, right? Or is it in introduction growth, or is it reaching maturity? That also depends. No, the new companies, very introduction companies, you can't take some metrics like fixed assets and like returns and all that. They're not well established, right? So you can take some profit oriented companies, you can take profit before tax. So like that, depending on the entity's nature and life cycle stage also, you can decide what to take. So that, and then very important point, the ownership structure, how it is owned. That is also something that you can understand based on how is it financed by so much of equity, or is it only debt that is taken care of and all that. And most importantly, relative volatility. Relative volatility. This is a very important factor, guys, relative volatility. So that's what takes into consideration factors for determining what the benchmark is. And now one of the points that you generally are asked all the time is revision. Can we revise materiality? Definitely, why not? If revision of materiality during the audit, yes, very much possible. So I'm saying a yes, it is possible. So if you get to know something which you must have gone that time only, like if you become aware of something, had you known before, you would have caused you to set up a different level of materiality, then you can revise that, not a problem. Revision as audit progresses, that's what it is called. Okay, so you can always revise materiality and bring back a new level of materiality as you understand and get idea of new things, right? So that's the next very important standard called as 320 on audit materiality. So I hope you understood the context of what three pieces that we discussed here. I think we'll put up an exclusive session for 315 and 330 together, also highlighting the importance of compliance and substantive procedures to be followed up, right? So we will do that in detail. So I thought we will do a stretch of all. So let's keep this session short actually. Then in the next session we'll do one thing. We will do 315 and 330 out. And then also in that session we will discuss the basic fundamental facts about audit evidence, so that we can see the audit evidence standards in the upcoming revision session. So I hope this pretty much sums up what you have normally in obtaining knowledge of client business, planning, and totally having an idea of materiality. So these two sessions, the first one and this one, these put together the first two chapters for the new syllabus. And of course the relevant standards are almost the same in the old syllabus. So whoever is watching this video, old or new, content and concept doesn't change as such. So you guys can follow it, right? So like I said, I think it'd be too much to rush through all the standards and quick revision. So we'll do one thing, we'll go in parts, right? So in the next segment I will be discussing 315, 330 in detail as to understand what the risk assessment procedures are and further audit procedures are. And then we will also take an insight of audit evidences, so that we can understand what sort of audit evidences we can be using, and what is an audit evidence. We'll go right from the definition, try and understand what exactly we will do there. Okay, I'll see you soon in my next session, guys. Thank you. Hi guys, this is part 3 of our revision video series. Now we are going to discuss about two very important standards here, standard number 315 and 330, and then we will also look at an insight with what we are supposed to do with the evidence series, right? So if you have been following this, the part 1 we discussed about quality control aspects in 220, and then we have also discussed about how does the auditor accept the audit engagement. So those two steps, part of preliminary engagement activities. And then in the part 2 video we've been about how to obtain knowledge of client business. So after which we also have understanding of the planning and materiality aspects. So now is the time for us to discuss two very important standards, wherein 315 talks about risk assessment procedures and 330 talks about further audit procedures. So in this particular revision session I'm going to take you through 315, which is risk assessment procedures. Of course there is another name to the standard, which is the actual name. Risk assessment procedures is a short form because that is what the definition of those three aspects are. So this standard deals with three aspects. So let's go with the same thing here, SA315, going with all three aspects. Of course, there is a fourth aspect that we will deal later. For now, we're talking about first part. I think we already did understanding entity and environment. Understanding entity and environment. So, which is what gives you an insight about what are we supposed to do when we're trying to understand the entity and environment. Then, based on this, I hope you remember the 5 points that we've seen in the last session. What are the 5 points? Relevant industry, regulations and external factors, the nature of the entity, accounting policies that they are going to use, and objectives of the entity and associated business risk, along with also the way entity is structured and how it is financed and the entity's financial performance. So these are points that we have looked up there. Very important. I think you can go back to your obtaining knowledge of the client business notes to see what you do to understand the entity and environment. So part 1 of 315 has already been discussed. Now comes the most important part. Right now that you have the understanding of the organization and you also have the understanding of what items are material, which we discussed in the last piece. Now is the time for you to understand what are the internal controls. So I'm going to take you through 5 very important points to have a complete understanding of what internal controls are. So part 2 of 315 deals with understanding internal controls. Understanding what? Internal controls. Now this is where it stretches to importance and understanding internal controls. This is a very important piece as far as internal controls are concerned. Understanding the internal controls, first and foremost step that you will have to understand is, did they really set up any controls? Did they really set up any controls? If controls exist in that particular client of yours, such an environment is called as control environment. So all we need to try to understand first is control environment. And if you remember at this point, I would like you to remind the 3 A's: attitude, awareness and actions of the management, which will determine whether they are setting up the controls in the right manner or not. Attitude, awareness and actions. So that is what we need to have an understanding of whether controls are there with our client or not. So attitude, awareness and actions of the client is what we are actually looking at in this particular case. Understanding the internal controls, wherein you have proper and clear understanding of the control environment. That is what we are actually doing here. Attitude, awareness and actions, so which give you an insight about what you are actually trying to do with the client, right? Then talking about the next area, once you understand whether your client has a control environment. Now guys, logic is very simple. If your client has a control environment, which means they have the attitude towards setting up controls, they are also aware where to set up controls, and it also means that we have to check. Now they said actions, but did they really set up controls? For that, we are doing 315 now as part of audit. But do you think this kind of a risk assessment process would have already been performed by the entity? They should have, right? So that is why point number 2, what you're trying to understand here is entity's risk assessment process, not ours. Entity's risk assessment process. So trying to see what the entity did. Entity's risk assessment process. By trying to understand, now if they really did and then they set up controls, we will go by that. If they haven't done that, then of course we have no option but to do risk assessment by ourselves, right? So control environment and then understand entity's risk assessment process. Now wherein in risk assessment process you are talking about, if yes, take their understanding of what they did. If no, you try to do that risk assessment procedure. Now moving on to point number 3, which is a very important point and it has to be done in detail. Understanding the information systems. Understanding the information system. Now this gives you a thorough insight about what you are supposed to do and how will you be doing all that, right from what kind of transactions the company is involved into, what are the basic journal entries they pass, what sort of computing accounting system they are using, what are some of the material journal entries that have controls. Everything about the information system, how many transactions do they attack in a day, every complete detail about how transactions are happening, and right from what class of entries they pass to every possible thing about what kind of information system they use, all of it with respect to the complete information system, whether they are using manual controls in some places, whether they are using completely automated controls, or are they using IT dependent controls. All these are some points that we need to try and understand. So this gives you a complete insight about the entire entity's information system, and that also gives you a knowledge of what are the gaps involved in doing this. So control environment, entities, risk assessment procedure, and also having an understanding of what the information system of the entity is. Now once these are clearly done, this is exactly where you have a lot of insight about what to do. But then I would like to take you through two very important points. See, as such, the term internal controls is not restricted only to the areas of finance. So as point number 4, which I am writing here, the auditor should understand controls relevant to audit. Controls relevant to audit. Now, what do you mean by controls relevant to audit? Because there are so many internal controls and some of them may not be relevant to audit, the auditor has to select and apply all his procedures on those controls that are very much relevant to audit. Nothing much serious in that point. It's a very straight and simple point. Out of several controls that are there in the organization, you might want to see only those controls that are pretty much relevant to the audit. And moving up next is point number 5, the last one. It is the duty, you all know that it is the duty of management to set up the controls, right? So they have set up the controls, but are they monitoring from time to time? Monitoring is also another important aspect. Okay, so if you have, of course, these 5 points to summarize are very simple, but it does take a lot of time to have a thorough understanding of each of them, because it's going to consume so much time. You can't just walk into an organization and say, let me do this, right? So you will have to obtain a thorough understanding of what exactly these internal controls mean to the organization, and how exactly are they using internal controls to deal with, right? So this is the understanding part of 315. So if you see the 315's title, it is identifying and assessing the risk of material misstatement through an understanding of entity and environment. So if you have understood entity and environment part 1 and part 2, you're taken care of. But at the same time, it is also important for you to use all of this knowledge to do part 3 to the standard, which is all about, I'm taking it here, right? Identify and assess the risk, which is a very simple process because there are only 4 steps. Identify and assess the risk of material misstatement. Step number 1 is to identify the risk. Step number 1, identify risk. Step number 2, once you know what to identify, step number 2 is about assess and evaluate. Assess and evaluate. Identify and assess the risk, assess and evaluate. Now if by this stage you will be able to understand how big the risk is. So identify the risk, assess and evaluate. And 3, now is very important part. Every risk that affects the organization may not be something that can seriously impact. Okay, it is forming part in the risk list, but doesn't mean that it will be such a serious risk. So you have to identify how important or serious a risk is depending on what that is. That is where you can see, have to understand, see what can go wrong. This WCGWs are very important. That assess what can go wrongs. If there are many things that can go wrong, then there is sheer weakness in internal control. Despite setting up that control, if many things can go wrong, still what's the whole point in setting up the control? That will be the question. Identify the risk, assess and evaluate, see what can go wrong, and most importantly, the 4th and the last step, consider the likelihood. Likelihood is nothing but the probability. Likelihood is probability. Now every risk that is there necessarily need not mean that it has to happen, right? So you consider the probability of such a risk's occurrence. That's it guys. What you see on screen is what the entire part of 315 is. Of course, I'm going to take you through 2 very important points apart from these 3 parts, but these 3 parts justify the title of 315, which is about risk assessment procedures, identifying and assessing the risk of misstatement. I hope you got a clarity on this, right? Apart from this, what can pop up in the exam is another very important question which talks about uh, significant risks. Okay, so let's now talk about significant risk. I hope everybody has taken a note of this. If you're using notes to make notes, if you're taking screenshots and later want to do that, everything as per your choice. These videos are to make your life convenient from the perspective of the exam. The idea of making it short like this, an idea of doing this is to kind of bring it that ease and comfort in your preparation, right? So do this. And then moving up next, the two parts to 315 to conclude here are, moving on, stand number 315, continuation. After those three parts, you got two more parts which are very important. One, which is called as significant risk. This question has come in the exam so many times, so I'm marking a star to this. So I want you to concentrate pretty much and understand significant risk. What constitutes to a significant risk? Now, significant risks are those risks which require special audit consideration. These are what? Which require special audit consideration. And as per this standard, there are 6 significant risks that are actually part of the standard. 6 significant risks. What are the 6 significant risks that are part of the standard? So that is what we need to try and understand here. First, whether the risk is a risk of fraud. Risk of fraud. Okay, if it's a fraud is a significant risk area, it's very important to have a complete analysis of what the fraud is, and if there is a suspicion of fraud and there is something that you would want to understand from that, check out the risk of fraud. 2. Recent changes. Recent changes. Where? Recent changes in economic, accounting and other developments. Economic, accounting and other developments. So guys, it's a very important part which we're talking about. So significant risk is nothing but a risk that requires special audit consideration. Now when you're talking about risks that require special audit consideration, you're talking about risk of fraud. Risk of fraud, because though frauds are not the primary responsibility of auditor to be detecting it, but yes, during the course of the audit, if there is something that might attract your attention and there is a suspicion of fraud, you definitely might want to do that. Risk of fraud, recent significant changes in economic, accounting and other developments. And 3, whether there is complexity involved in transaction. Complexity of transactions. That is where serious transactions are involved, where journal entries are involving multiple number of people and multiple accounts. And then the next point is something that we have always seen as a significant risk. Risk with respect to related parties. Risk with respect to related parties. You know who related parties are, and transaction related parties may not be conducted at arm's length price. And when such things are happening that they may not be conducted at arm's length price, there is always a possibility of a fraud involving related parties. Thus, it's a significant risk area. And next area is where there is a degree of subjectivity. Degree of subjectivity involved. Wherever there is degree of subjectivity involved, there is nothing that you can really do about it. So because there are judgmental areas like depreciation and provisions and all that, where there is subjectivity involved. Risk of fraud, recent changes, complexity of transactions, related parties, degree of subjectivity is involved, and most importantly, the last point where you're talking about changes to the situations, right? When you set up controls, there are only certain points, but there are changes to conditions wherein you have unusual transactions. Usual transactions, everybody will set up controls, but wherein they have unusual transactions, that is exactly where there is a problem. Okay, so whether the risk is a risk of fraud, recent changes in economic, accounting and other developments, complexity of transactions, related parties with degree of subjectivity is involved, and where unusual transactions are there, these are all the areas where you would want to focus pretty much in understanding what risks contribute to becoming significant risk that require special audit consideration. And moving to the last part of this standard, wherein this standard talks about areas where substantive procedures, alone, do not provide sufficient appropriate audit evidence. Now, very important point this one, because we have seen this multiple number of times occur in the past, right? That there are so many areas, like say for example automated areas where entries are passed automatically, or where some of those transactions, which are fully computerized, where there is no paper trail or paper proof that such a transaction has taken place. So in those areas or in those cases, it is very important for us to understand that simply doing only substantive procedures, because you are not even finding an evidence, what will you do in substantive procedures? So that is exactly why you need to try and understand that you have to perform something called as compliance procedures, that is test of control. So these are areas where substantive procedures alone do not provide sufficient appropriate audit evidences, and that is exactly where it paves way to our next concept, standard number 330, which is nothing but responses to assessed risk. So I hope everybody has a clarity till here. So once again, let me take you through the last frame. This is what we saw, all of 315, 5 branches to that: understanding entity and environment, understanding internal controls, identifying and assessing the risk, and then you have significant risk in areas where substantive procedures alone do not provide sufficient appropriate audit evidence. I think that covers the entire standard number 315 is a very important part. Let's now move on. Okay, once again, before I move on, quick note on the timeline as to where we are. So we did talk about preliminary engagement activities, because I wrapped up stage 3. This is why I want to do this. Okay, so we talked about preliminary engagement activities. Now after we did preliminary engagement activities, which are about two things: SA210, that is accepting the terms of audit engagement, and then SA315 part 1, which is about obtaining knowledge of the client business. Preliminary engagement activities. Then we started planning and risk assessment, right? Planning and risk assessment. As part of planning and risk assessment, we did standard number 300 and standard number 320, and then as part of risk assessment, now we discuss standard number 315. So this entirely covers what we discussed, the whole of standard number 300, 320 and 315. Now it's time for us to perform the audit. Performing the audit. Now this is where exactly first it kickstarts with standard number 330 for us to, 330 for us to discuss about what did we or what should we do in terms of doing a performance part of the audit, right? So it's very important that you understand what we will be doing in terms of standard number 330. Right after this we are going there. Then after 330 we are going to discuss all about standard number 500, 501 on 3 selected items, maybe 505 on external confirmations, 580 on written representations. These are some of the basic standards that we have to actually deal with. And then we are discussing about two very important procedures that are called as SA 520 on analytical review procedures and SA 530 on sampling procedures. So if you have a complete insight of what we are trying to do here. So 330, then 500 we will be discussing now continuously as to understand what we are doing. Then in the next segment, which is an exclusive on 5 series, we will be discussing about 501, the 3 selected items, 505 on external confirmations, 580 on written representations, and 520, 530 on sampling procedures. Also, after all this, alongside that, we will also be discussing standard number 610, which is very much useful for obtaining knowledge of whether to use the work of an internal auditor or not. Two questions: can we use the work of internal auditor, or can we take their direct assistance? Now this sums up the whole of thing. And then towards the end of performing, there is very important stage on 230 on documentation. Maybe we will be seeing that. So this is the most extensive chapter that you have in your syllabus. And then after that we have the reporting series. In reporting we have standard number 700, 705, 706 and 701. Now if till now somebody has not noted, and this is this nth time that I am discussing this flow, because as long as this picture sits in your head, there is nothing that can stop you from understanding audit with clarity and audit more properly. So it's a very, very important piece. We will keep coming back here. This is a very important slide. This is understanding the various standards that you're supposed to, and this will give you a deep insight about what you're supposed to actually deal with. Okay, so moving further, and also of course here we can add up two more standards which we are supposed to perform. Standard number 240 in doing fraud, and standard number 250 in determining the applicability of laws and regulations, which probably if we have space in our discussion we can also pull those off. But right now let's move on to 330. I hope you understood. This is this is revision video 1. So if somebody is watching this video straight away, we have revision video 1 which covered this. We have revision video 2 which covered these two, and now 315, 330 and bit of 500. This piece is right now our revision video 3's coverage, and it will be followed up by the other revision videos. So it's a whole series, guys. Let's do this, and I want you guys to score very high in the exam. Stay focused when we are dealing with this, and of course I think these revision videos should be of some kind of help in summarizing the whole content and making your life easy. I hope that, and if that's happening through this video, do of course let us know that, because that kind of a feedback makes a lot of sense to us. And of course if you feel that this is going to help others as well, all I want you to do is to take it through to the others. I mean, of course you have seen us, we have never been on point of any commercial aspect, so we don't ever say like or subscribe or share. So but if you really do find some real understanding of the standard and you believe it benefits, now that's something not stops you from hitting the share button to somebody through a WhatsApp or your friends group and all that, where you're studying together. A mutual help is always meant, because when I did CA none of this were there, right? So of course maybe things can change now and things can be better. We're seeing better things happen, so I guess you should try and take that a little bit. Moving further, guys, let's not catch up. Let's now catch up with standard number 330, which is, now a lot of people are under the apprehension that 330 has been removed. Yes, absolutely, it is in the list of removed standard, but I want you to understand this, because nobody can understand audit without understanding compliance and substantive procedures. So let me take a minute to just explain you. 330 deals with further audit procedures. 330 deals with further audit procedures. Now the story in 330 is very, very simple. It goes by doing two parts to the standard. One is called compliance procedures. Compliance procedures. The other one is substantive procedures. Now I hope you have to have a understanding of what these are. Let us go by understanding them. A brief insight about it, because I just wanted to understand these two procedures, because the entire content of compliance and substantive procedures still would remain even if 330 is not there. So I just want you to understand what compliance procedures are in the first place. Compliance procedures are nothing but test of internal controls. Test of internal controls. So if you're making notes, make notes of this. Test of internal controls. Now very important, why are you testing internal controls? So again I want you to loop you with the insight of what we actually are doing here. See, we did 315, right? 315, the end results of 315, which is nothing but risk assessment procedures, these pave way to determine the NTE. Determine NTE, which is the nature, time and extent of 330. Okay, so please understand that determining the NTE of 330, how much compliance you're supposed to do and how much substantive you're supposed to do, will purely be determined based on the results of risk assessment procedures. So guys, if your risk assessment procedures say that controls are operating effectively, that is when you will waste time in doing test of controls. Otherwise, why will you waste time? Okay, spend time, you can say. See, if you believe, or if your preliminary understanding about the controls say that controls are operating effectively, okay, then only you will do test of controls. So compliance procedures about test of controls, and substantive procedures, a detailed breakup of substantive procedures is also there. We will see the detailed breakup. Okay, so understanding this is what 330's overall point of view is. I hope you are trying to understand what we're doing. So we did 300 where we planned what we were supposed to do, and we did 315 based on the understanding of the entity and internal controls. We assess the risk. After we did that, we are now going to decide based on the risk whether to do compliance procedures or not, and whether to do substantive procedures or not. So guys, two things that are going to be interesting here again as part of standard number 330. What are we doing in compliance procedures? So concentrate on this very important point. Two questions I'm going to answer here on compliance procedures. When do we do compliance procedures and what? When do you do compliance procedures? One, when auditor expects that after you perform risk assessment procedure, when auditor expects that internal controls are operating effectively. Now this is very important, guys. When they are operating effectively, that is the only time you will do this, because otherwise why will you do this and waste time? So you believe that internal controls are operating effectively, then you will do this. So if you obviously ask me the opposite, sir, if I believe that internal controls are not operating effectively, my preliminary understanding of controls say that they are not operating effectively, then straight away do what? Then straight away you will go and do substantive procedures. Straight away you will do substantive procedures. What are substantive procedures? We will see that also now. Okay. So when auditor expects that internal controls are going to operate effectively, and two, where compliance procedures alone, or sorry, where substantive procedures alone, because you're doing substantive procedures alone in areas like highly automated areas where auto posting of depreciation and other things are there. I told you that there are no paper trail. In the last part of 315 we discussed that you can't do only substantive procedures and get away with it. So therefore it is expected that you do compliance procedures in those areas. So where substantive procedures alone do not provide sufficient appropriate audit evidence, these two are the reasons why you do compliance procedures. And obviously the next question will be, what will we do in compliance procedures? As I told you, test of internal controls. What three things you will be testing as part of this? You will be testing the design of the internal control, design, implementation, whether they designed and implemented the internal controls, and its operating effectiveness. Design, implementation and operating effectiveness are the three aspects that are talking about what substantive procedures you will be performing later based on the test of control. Because if these 3 points are covered and you have a thorough understanding of these three, it's designed well, it's implemented well, it's operating effectively, you can do less of substantive procedures, right? So that relation, after I explain what substantive procedures are, we will see it once and for all and close this particular standard. I hope it's going good, guys. You guys, in this video comparatively I am slower than the other two, because these two standards are something that students have always found lack of clarity. So that's why I'm being a bit slow, though it's a quick revision. I want you to have this perfect clarity on this, and so that you don't have to waste time doing these again. Substantive procedures are further broken down into two parts, wherein it is called test of details. Test of what? Details. And analytical review procedures. You all know that it's shortly called ARP, which is built in standard number 520. So I'm not taking much of a time in discussing that now, because we'll be separately discussing analytical review procedures. Test of details are further broken down into test of transactions, which is called as vouching, and test of details part 2 is verification, which is test of account balances. So when you test account balances, this is called as verification. I think absolutely you can take a screenshot of this right now. That gives a complete summary of what 315 and 330 are all about. So I hope this particular session has given you a complete insight on 315 and 330. Guys, this is what we actually do in audit. First, do risk assessment procedures, assess the extent of risk involved in doing the audit, accordingly determine your further audit procedures, and as part of further audit procedures, first you will determine how much compliance procedures to do. How much compliance procedures to do will be purely dependent on these 2 points, that if you expect the controls are operating effectively, and then you will do this. and then you will determine the NTE of substantive procedures accordingly. So compliance will determine the NTE of substantive procedures. So everybody, I hope, has got an insight here. So let me take you back to that part where we have been discussing about how to do this. So 300 will help you plan, 320 will help you have that understanding of materiality, which will help you pave way for determining how material a particular item is, and then you will be trying to understand what exactly the risk levels are. Accordingly determine 330, which is the further audit procedures, which will let you know how much compliance to do and how much substantive to do. So we are right here, and now it's a time to kickstart the whole of 5 series to obtain audit evidences. So I hope till here everybody has had an insight, and guys who are watching this video for the first time, once again I tell you that you want go back to the last 2 videos and try and understand those, because it makes a lot of sense in having that continuous clarity, right? Okay, to wind up this particular session, I hope we are supposed to now do standard number 500. In standard number 500, we are discussing all concepts relevant to the topic which is called as audit evidence. Very important concept in audit, guys, the concept of audit evidence. So I'm going to take you through some of the most important aspects which are very relevant for audit evidence. Right, let me mark and keep what we are going to discuss so that we can start filling each one of those. First and foremost thing, the bigger question, always ask what is audit evidence. We will figure out what is audit evidence. Then moving to the first phase, if that is the audit evidence, what are the types of audit evidence, how is it classified, then what are the qualities of audit evidence, which are very important to understand. There are very important points, that sufficiency and appropriateness, as you know, that is exactly why everywhere we are running behind audit evidence to be sufficient, appropriate. So what is audit evidence? What are the types of audit evidence that we are talking about? Because again, they're classified based on the source that they're obtained from. They're also classified based on the nature. So we are going to take that also into consideration, and the 2 qualities, sufficiency and appropriateness, and the factors that affect sufficiency and appropriateness. So all of these are some points that we are thoroughly going to discuss right now. And one of the most important points are the procedures to obtain audit evidence. Procedures to obtain audit evidence. And if we have done all of this, then we will also discuss the rules of reliability for audit evidence. Let's start with this, guys. First, I think I can fit in this very much clearly here. We will also talk about the rules of reliability towards this. What is audit evidence? Any information, anything that supports an auditor's conclusion, any information, anything, you can obtain it through written, oral, discussion, whatever, any information used by auditor. Any information used by auditor for doing what? Any information used by the auditor in arriving at a conclusion. In arriving at a conclusion, that is what is called as audit evidence. Any information, it could be books, papers, vouchers, whatever you collect, any information that supports an auditor's conclusion is called an audit evidence. Now, you also need to understand that audit evidence can be in paper or electronic form. With the amendment to the Evidence Act 1872, from the time when Information Technology Act was introduced, so evidences in electronic form are also considered as evidences, and Section 7 of the Information Technology Act also says that audit can be conducted in electronic form. So therefore, audit evidences can be either paper or electronic. Keep that in mind. So what is audit evidence, guys? Any information used by the auditor in arriving at a particular conclusion. That's what audit evidence is all about, right? Moving further, very important point are the types of audit evidence. Here types are further broken down into 2, wherein I'm talking about the types which are based on the nature of audit evidence that you collect, wherein you have visual, what you see, oral, what you discuss with management and obtain, and most importantly written or documentary. Written is also called documentary, so you don't have to worry when you see the word documentary, it is nothing but written evidence. Then audit evidence is classified based on their sources, which are 2 sources, internal and external. These are the two sources of audit evidence. Right? I hope everybody has understood. What you see is visual evidence. What you talk to the management and gather through inquiry and confirmation, that is oral evidence, and written evidence is in the form of documentary evidences. When you get it within the organization, it is called internal. When you get it from third parties outside the organization, that is called external audit evidence. And there are two very important qualities again that you can't really talk about audit evidence without those two, which is called sufficiency. Audit evidence should be sufficient and appropriate. Audit evidence should be what? Sufficient and appropriate. Sufficiency refers to the quantum of audit evidence that you obtain. How much audit evidence do you obtain? Is that good enough? So how will you decide how much audit evidence do you obtain is good? It depends on three factors. Materiality. Higher the materiality of the item, more the evidence you have to obtain. Risk of misstatement. Higher the risk of misstatement, you will obtain more of evidence. And most importantly, size of population. Bigger the size, more the evidence. 3 points that will affect the quantum of audit evidence. Once again, that is materiality, which affects the audit evidence. Then risk of misstatement, which is also another very important point. And then the third point, like I said, size of the population. These are all some important factors which will affect the quantity of audit evidence that you gather. Appropriateness refers to quality. Appropriateness refers to the quality of audit evidence, which is also affected by two factors called relevance and reliability. Okay, now these are two very important words that I would like to discuss in detail. Relevance and reliability. There is nothing much to discuss about the word relevance. It is just the logical connection that you establish. So relevance as such is nothing but the logical connection with the evidence. So you don't randomly collect something. There should be some kind of a logical connection to gathering that. Reliability, 5 rules are there. We will discuss the 5 rules of reliability in the next slide. And then there are procedures. So I hope everybody is clear till here. What is audit evidence, the definition, types, qualities, and let's wind up this particular piece of discussion with procedures so we can discuss the rules of reliability and close this particular discussion. Procedures to obtain audit evidence. Right, again guys, I'm going to give you a small shortcut here, IOI. But this time it's not the common thing that we use for integrity, objectivity and independence. This is somewhat different from that. This is also IOI, but this time it is inspection, observation and inquiry. Inspection, observation and inquiry. That is what you're actually looking at. IOI, the procedures to obtain audit evidence. Then we have 4 more procedures which are talking about RARE. So IOI and RARE, these two, the 7 points totally. This is recomputation, analytical review procedures, re-performance, which is something that we will do with bank reconciliation statements and all, wherever you can gather the evidence and do it by yourself. It's all called re-performance. And then external confirmations, which is discussed in 505. So this is discussed in SA 505, wherein this is discussed in SA 520. We will see all of that. Oh, I think that's amazing. Right now what you see on screen is a complete summary of the entire standard of 500. That's nice. So I think you can take a screenshot of this as well, or if you are preparing notes, if you prepared it like that, I think you've covered 80% of 500 in one slide. That's so amazing. Right, let's move on to some uncovered aspects. We've discussed what are the rules of reliability. There are 5 rules of reliability, before which I would like to give you a one-liner about each of these 7. I hope you know them, but I'm just giving you one-liners. Inspection is about collecting documentary evidences. Observation is about witnessing a particular process, whereas inquiry is about asking for information from management and taking a confirmation in the form of a written representation. Recomputation or recalculation is all about doing some calculations that management has already performed, like in terms of depreciation or any provision computations or any computations, whatever they've done, you can do that. Analytical procedures is analysis of ratios and trends. We will see that in 520 exclusively. Re-performance, doing something what the management has already done. That's what is called as a re-performance. And then taking a confirmation directly from the third party is called as external confirmation, which also we will discuss in 505. So I hope this gives you a complete insight of what audit evidence is. And then to continue with this standard, we have just one very important factor to discuss, the rules of reliability. Let me move on to talk about 5 rules of reliability. 5 rules of reliability. What are the 5 rules of reliability? Reliability rule number 1, that is external evidences. External evidences are more reliable. External evidences are more reliable than internal. Okay, now this is a general statement, but there could always be a possibility that our client has collaborated with a third party. There can always be a chance that third party is also under the influence of our client. So this need not hold good all the time, right? External evidence is more reliable than internal. However, right, the second point is a continuation of the first. However, if internal controls are effective, if internal controls are effective, internal evidences are also reliable. Now you need not always think that only external evidence are reliable. If internal controls are good, even internal evidence are reliable. Rule number 3, evidence obtained in documentary form. Evidence obtained in documentary more reliable. Guys, you're not saying that is the only reliable thing. You're saying more reliable. Evidence documentary is more reliable than visual and oral. To add that the same kind of a point, evidence obtained directly by auditor. Evidence obtained directly by auditor more reliable than produced by management. Produced by management. So evidence obtained directly is always more reliable than the ones produced by management. This is only reliability. It's not like management, what they provided is wrong, but evidence obtained directly is more reliable than the ones that is provided by management. And lastly, evidence obtained in original form. Evidence obtained in original documents are always again more reliable than photocopy, fax, that is photocopy or Xerox, you mean? Photocopy, Xerox, fax, digitized or scanned document, digital or scanned. So you can take digital, scan, photocopy, fax, all these as evidences, but once you definitely have to see the original documents, and then you can safely and comfortably decide that particular evidence is worth taking it. Okay. So yeah, these 5 rules of reliability, again I'm putting a star to this particular question because this has been asked in the exam so many times. So guys, that's what it is about the audit evidence, and this is very important in terms of considering how you are going to use this particular concept on audit evidence to obtain sufficient approved audit evidences. Because if you remember, we did talk about the very basic objective of the audit says that auditors should obtain a reasonable assurance that financial statements are free from material misstatement, and to do that you need to definitely obtain sufficient appropriate audit evidences. So from these 2 slides, I think the very precisely presented what exactly the whole of audit evidence, what is it, types, qualities, the procedures to obtain audit evidence, and of course the reliability part. Okay, now this also brings us to another important point, that is from the standard, which talks about use of management expert. Yeah, this is some point which most people ignore. Use of management expert. Guys, you can definitely, now management has used somebody to do their work and consider the expert's work. Now you have to consider competence, capability and reliability of the expert, the objectivity of the expert, and then you should understand the field of expertise and see whether expert's work is sufficient. If these 3 concepts are being checked and you are happy with this, you can comfortably use the work of management expert. Use of management expert is dealt in standard number 500, while use of auditor's expert is dealt in 620. Don't get confused. So use of management expert is very much in SA 500, and you talk about three things: competence, capability, or objectivity. These three things you have to check, and then you just have to understand the field of expertise of the auditor, understand the field of expertise of the expert, I'm sorry, and then the auditor should also have understanding whether work performed by expert is sufficient for you to draw sufficient appropriate audit evidence. If that is sufficient, I think you can go good. So this is a small point but very important one, because generally people don't tend to focus on this point. Okay, so use of management expert. If somebody asks you, can you use management expert's work? Definitely it is a yes, only subject to the compliance of these three conditions. So I hope this session has given you a deep insight about 315 and 330 thoroughly, and also the entire breakup of standard number 500, and the all 7 parts of 500 are covered. So guys, if there is any inconsistency that you feel with respect to audit evidences, and you have to perform further audit procedures to obtain audit evidences to resolve that matter, which is also a very important point. If there is any doubt or inconsistency in the evidences that you obtain, then you have to obtain more audit evidences by performing alternate procedures. So that's it for this session, guys. 3 wide very important standards we have revised, and the next session is going to be a critical one, because you have all of audit evidence standards coming up there. We will discuss 501, 505, 580, and if time permits in that session only, we will be discussing 520 and 530 on sampling. I think we should do an exclusive session for analytical procedures and sampling. So next one may be a quick one, wherein we discuss about those 3 standards in detail, and also let me throw you an insight about 520 and 530 on analytical procedures and sampling. So which will complete almost like 7 chapters which are broken down in the new syllabus, right? So I will see you soon with part 4 of the revision videos. Hi guys, so this is part 4 of the revision videos, the series that you are seeing. We have completed up till standard number 500, where we had an insight on what audit evidence is about. So in this session, I'm going to pick up and give you insight about 4 very important standards, starting with 501, and then we'll move on to external confirmations in 505, and 580 on written representations, and 510, just in case if it is your initial audit engagement, what would you be doing? So this pretty much is going to be an informative video on all these 4 standards. Let's start the very first one here. We're going to talk about SA 501. Now to understand SA 501, we need to also try and understand what are the 3 selected items that we are actually looking at. Okay, so in this context, just to understand what are the 3 selected items, we are talking about inventory. So what constitutes to sufficient appropriate audit evidence with respect to inventory? Litigations and claims. Inventory, litigations and claims, and of course segment information. This is what it is all about. So this standard on auditing 501 is an extension to 500, wherein we spoke about audit evidence. 501 is also constituting to. In 500 we discussed that audit evidence has to have 2 qualities, sufficiency and appropriateness. And now in 501 what you're talking about is audit evidence, but for these 3 selected items of inventory, litigations and claims, and of course segment information. Let's see how it faces up. First and foremost thing, let's talk about inventory. What constitutes to sufficient appropriate audit evidence with respect to inventory? Now when you're considering inventory, the first thing that you need to understand is what are the factors that you are verifying in inventory. What are the factors or areas that you're verifying in inventory? And this factors, there are 2 factors here. One is called existence of inventory, and then condition. How is it? Is it in saleable condition or not? Okay, so that's the whole point. Inventory, wherein you're talking about its existence and condition. Now to understand existence, obviously one of the best methods to do is what? Physical verification. So this is what you can do with respect to inventories. You can do a physical verification of that. When the management is conducting a physical verification, you can be there, you can visit that place, and of course you can go ahead and continue the verification of be along with them. Observation is one of the methods to obtain audit evidence, so you can obviously even do that. Then talking about condition, it's important to know the condition because is it saleable or not, whether with the very purpose that we have inventory is to make sure that it is sold, and you can obviously keep it in a saleable form, so that is when it becomes inventory. If it is not saleable, then it is not part of the stock, right? So existence and condition. Now you can do physical verification. What is a possibility that you may not be able to go to the physical verification? Now this is a very practical scenario. Sometimes it may so happen that it is not practicable to verify that inventory only, or sometimes it so happens that it is practicable, but you are not able to go there because of your own reason. So there are two things which we need to discuss. So first point, we have discussed very clearly what are the two factors that you check in inventory. Then moving up next, once you know that this is the case, then what are we supposed to do? You can always do something with respect to physical verification. Not possible. This is the situation that we're dealing with, where physical verification is not possible. Now this is due to unforeseen circumstances. Unforeseen circumstances. When you say that the physical verification of inventory is not possible because of unforeseen circumstances, then all that you need to do is to do. If you are not able to go there, obviously you can perform it at an alternate date. On the day when management is conducting, you are not able to go, so you can do it on an alternate date and adjust for. So like say you were not able to go there on 31st March, go there on 5th April or 6th April. For that 4-5 days, whatever transactions happen, you adjust them. Such transactions which are occurring between the date of balance sheet and the date of actual physical verification, these are called as intervening transactions. Intervening transactions. So that's what we need to try and understand. Most likely that is what we are actually also on to. So inventory, you have to check existence and condition. You will check that by way of physical verification. If it is possible for you to go to the physical verification on the date when management is conducting, very good. If it is not possible for you to go on that particular date, then you might want to do it on an alternate date and adjust for intervening transactions. Okay, this is not possible because of unforeseen circumstances. What if it's not possible because it is impracticable? Now, what do you mean by impracticable? Impracticable, the problem is not from you. The impracticable, the story is very simple, that the inventory itself, the nature of inventory is itself in such a way that it's very harmful that you see with your eyes, or you go and verify. So it's quite dangerous to do that. So therefore, what is that you do when inventory verification is impracticable? This is problem from management side, not from us. This is a problem from management side. So when this problem exists from management side, what are you supposed to do? What are you supposed to do? You will again see, inventory verification by doing physical verification is not the only method on how you will gather inventory, right? So if there is anything that is pretty much disturbing you from this fact that it's a problem from their side that you can't verify it, perform alternate procedures. You will perform alternate procedures. These are very important points, guys. So as you see, this is what it is. If it's not possible for you to be there on that date, understand, and you can do it on another day and adjust for intervening transactions. But if that is not the case, and it is pretty much possible for you to verify, but it's a problem with the inventory only, then there is nothing but you can perform alternate procedures. You can apply the same thing to inventory under the control of a third party. If inventory is under the control of a third party, then all you can do to do that is what? Obtain a direct confirmation. Obtain direct confirmation from the third party. That's what you're supposed to do. Or you can visit their place, or you can arrange somebody to get it checked. That's it. Inventory is there with the third party, just doesn't mean that you're not supposed to do anything with that. You can obviously deal with it, right? So perform alternate procedures and obtain direct confirmation if it's a third party. So that's the story on the first selected item called as inventory. Now moving up next is the second specific item, very important one. This one is called litigations and claims. This is called what? Litigations and claims. Now if there is litigations or claims, very important point is first, how will you check that? Right, first and foremost thing again, the assertion that you have to check is the existence of this. Okay, so how will you know that if there are any litigations and claims? So if you want to know what any litigations and claims are there, first things first, what you need to do is to have a proper understanding here. In this case, you can always look out for what are those cases. Three possible ways are there on how you can understand. First and foremost, inquire the management. It's the most easiest way to do that. Inquire the management. Now they will tell you something that there are 7 pending litigations, 8 pending litigations, this is there, this is not there. There might be something that they would want to tell, right? So they can always do that. Now it's also important for you to understand after inquiring from management. Now that is not enough. So then you might possibly want to try and understand by checking the minutes of the meeting. Review the minutes of the meeting. Review the minutes of the meeting. Any meeting that took place after the financial year, like say, these are important meetings because for a simple reason that these are litigations, and to represent the company in the court, no, the company has to pass a resolution saying that he is the authorized representative. So we will find out that, and we will take into consideration that they are the authorized representatives and all that, and figure out what. So therefore, review the minutes of the meeting. And 3, you can always review the legal expenses account. Review the legal expenses account. So why did you pay legal fees? To whom did you pay legal fees? What is the logic in paying that legal fees? And why did you do that? So all those are pretty much into consideration. Now these 3, again, I'm not saying are foolproof procedures. These 3, if you understand, you will have an idea about what are the pending litigations and claims, if there is any, if at all there is any pending litigation, what is it? And now if only after doing all this, if you get to know that there are pending litigations, okay, then ask the management, right, management, whether all litigations and claims which they are aware of, which who they are mean management, which they are aware of, all litigations and claims which they are aware of, okay, whether they are properly disclosed that. What is about the disclosure of those is something that you need to ask. And ask this, inquire plus written representation. Written representation. You will take a written representation of all this, wherein if you take the written representation saying that all known contingent liabilities which the management are aware of, whatever litigations and claims are there, they have disclosed to the auditor. Take it in writing. Now very important point, if the management, if you have sufficient evidence to say that a required disclosure is not given, right, wherein it is important for the management to disclose something and they haven't disclosed it, now that always is a point. So where now you want to obtain all this information and management refuses. So there are 2 things, whenever there is a confusion, you don't want to understand all this, you can always obtain a legal advice. Obtain a legal advice. So in this case, whenever you want, you can always obtain a legal advice. But see, because if management is not able to tell you what it is, you should obtain legal advice, right? So you try to obtain a legal advice. Now, if management refuses, that is to not let you get the, see, we are asking them, if that is not the case, then we are going for obviously taking a legal advice. Yeah, so this is pretty much, if management refuses, okay, but that's not the story end. You can always perform alternative procedures. Any alternative procedures available, perform if you are there, right? Alternative procedures also not possible, then modify the report under SA 705. You will simply modify for a reason that a required disclosure that is supposedly to be given has not been given. And what do you need more than this? Okay, so you ask an entity's third party, the third party counsel for a legal advice, and if management refuses either to let you talk to them or there is no evidence from them, it's a classic case of you not having evidence. Try to perform alternate procedures. If that also is not possible, modify the report. Okay. So and if you see that the risk is high in these kind of things, then it's always better to give you a modified report, because they're not allowing you to get the audit evidence. You can always communicate the entity's external legal counsel, and if the management refuses to let you counsel, so we obtain a legal advice from where? Any counsel, you can say entities legal counsel, you can get that from them. Okay, if it's quite possible, you get that, but if it's not, then there is nothing that you can really do about. So very simple aspect. If at all you want to collect sufficient approved audit evidences for litigations and claims, all you need to do is to inquire the management about it, review the minutes of the meeting, understand if there are any litigations and claims, and check legal expenses, because you have to pay to lawyers and all that. That will get you to know, and ask the management for proofs of all this, and ask them a simple inquiry that all known contingent liabilities or litigations and claims which they are aware of, have they disclosed it to the auditor? And if they say yes, take a written representation, because that makes a lot of sense. Take it in writing. And if at this point of time neither they are giving you evidences nor letting you talk to the external legal counsel, if there are no evidences, you can always consult the external legal counsel. But if the management is refusing to give you evidence, neither they are letting you communicate with the external legal counsel, it's a classic case of they not letting you gather the audit evidence. So therefore you try to perform alternate procedures. If that is not the case, last part of the standard says modify. And then comes to this is the second item, inventory, litigations and claims, and 3, segment information. There is nothing much here. Segment information, the sufficient approved audit evidence for segment information is to just make sure that segment information, the presentation and disclosure of segment information is as per applicable FRF. Now there is AS17, right? AS17 tells you how to do segment reporting. So now all I am saying is there is a particular standard which says this is how you do segment reporting. Did they do the segment reporting like that or not? So just a very, very straight and flat simple point. That's about segment information. So guys, I hope there is clarity in this particular area. Standard number 501. We are talking about obtaining sufficient approved audit evidences for exclusive areas of inventory, litigations and claims, and segment information. Okay, so that concludes the discussion on standard number 501. We can safely move on to standard number 505. SA 505 is on external confirmations. 505 is on external confirmations. Now what you need to understand is we studied the rules of reliability, and as per the rules of reliability we did discuss that external evidences are more reliable than internal evidences. Nothing wrong, but then of course there could be collusion between your client and third party also. So it is not like external commissions are directly coming from some heaven and you can always rely on them. Definitely not like that. So there is always a possibility that you can go wrong with your taking external confirmations also. So first and foremost thing, what is an external confirmation? Always we need to have that clarity on the definition, right? What is external confirmation? An external confirmation is nothing but a direct written response. It is nothing but a direct written response. An external confirmation is a direct written response from the third party. Direct written response from the third party to the auditor directly. Okay, to the auditor. So who are the people involved here? Third party directly to the auditor in paper, electronic or other form. In paper, electronic or other form. Isn't that amazing again? So you can take a direct confirmation from the third party with respect to whatever you are dealing with. An external confirmation is a direct written response as to from the third party. You can take it as a direct written response from the third party in paper, electronic and other forms. Now this is something that you have to always keep in mind, that external confirmations are more reliable than internal, but Nobody said external confirmations are final. External confirmations can always be, tampered with. They can, the client can involve in manipulating the third party and getting an external confirmation. So yes, external confirmations are very much audit evidences. There's sometimes sufficient appropriate audit evidence also, but you should not be solely relying only on the external confirmations, right? So first up, let's talk about how to take external confirmation procedures. What are the external confirmation procedures? Now in that context, you talk about what are external confirmation procedures. 4 points are popping into the mind, because first, what are you trying to ask for confirmation? Okay, it's a very important point. Determining what you want for confirmation. So step number 1 as part of the procedure, determine the information to be confirmed. Determine the information to be confirmed. So now you know what you are asking for. Now then the next question, obviously, from whom are you going to ask? Once you determine the information, select the appropriate third party, because you should not just understand what external information are, you should also know from whom you are supposed to take. Determine the information to be confirmed and select the appropriate third party. Now once you know, yeah, this is the information that I need and this is what is the confirmation that is to be done. So once you determine the information to be confirmed and select the appropriate third party, it is very important for you to understand that you have to make the external confirmation and then send them. What is that you're talking about? Designing the confirmation request, design the confirmation request, and sending and follow up. This is a possible exam question, guys. Procedures to be followed for external confirmation. 4 simple steps. Determine the information to be confirmed, select the appropriate third party, design the confirmation request, and sending and follow up is something that you are supposed to actually do. So this is what we have to understand as part of external confirmation. So what is an external confirmation? From the procedures. Now very important point again here, just like if the management refuses that you should not ask third party confirmations. First and foremost thing, management's refusal of you asking, why are they involving into it? So could there be something fishy? You have to immediately check your professional skepticism and see, is this something that you need to be alert to the situation or condition. So right, in case of external confirmation, you find again a very valid and important point, management refusal for what? Management refusal to allow auditor to communicate with third party. So they are not letting you communicate with the third party, then what will you do? So don't worry, that is not the only method on earth, right? So they allow the auditor to communicate. Check whether there is a reasonable justification. For them not to allow, and then if so, yes, perform alternate procedures. As I told you, obtaining external confirmation is not the only method on earth on how you go about. So if there is management refusal, they ask them what is the reason, evaluate the response. Achha, they are telling correct only, this might be the problem, like that. If you can understand, get this. Guys, 3 important aspects. Then there is the last part of the standard we will discuss now. So first, what is an external confirmation? What are the 4 procedures that are involved in taking up the external confirmation? And if management is refusing, there could be a possibility of a risk of misstatement. It could turn out to be a fraud risk factor. So evaluate that case and ask for justification. If there is a reasonable justification, fine. But what if there is unreasonable justification? Right? If it's check reasonable, if justification, yes, you can perform alternate procedures. What if there is no reasonable justification? No. Then what will you do? Then communicate. Communicate to whom? Communicate to management or TCWG and tell them that you asked them for a confirmation and you didn't get it, and that's exactly when determine. And after this, communicate to them and consider effect on report report. Now it's a very important thing. What will I do with my report is also something that I need to properly understand in this case. Got it? So determine the information to be confirmed, selecting the appropriate third party, designing the confirmation request, sending and follow up procedures, and if management refuses to do. Okay, so this is the basic idea behind how you do external confirmation. Also going further, what you need to understand are the two types of confirmation request, two types of confirmation, two types of external confirmations, two types of external confirmation. What are the two types of external confirmation? There is a positive confirmation and then there is a negative confirmation. Now talking about positive confirmation is expecting a reply in both agreement or disagreement. That is, see, you only will tell them that the balance is 50,000. If it is matching, give us a confirmation. If it is not matching also, we are asking you to give us a confirmation. Expecting a reply in both agreement or disagreement. Or one more thing is there where you can seeking information. Now you know this is the best method. Instead of you giving, now like say you told them that balance is 50,000. They are like also yes balance is 50,000. So instead of giving them a number, you are just seeking information. So this time you write the letter, confirmation letter saying that during the course of the audit of X Limited, we came to see that you are one of the debtors. Kindly confirm the balance of X Limited in your books. So you are not telling any numbers, you are not telling anything, you are just seeking information. Now both these are ways which are called as positive confirmation. But whether it's agreement, disagreement or seeking information, you are expecting a reply. That is exactly what makes it a positive confirmation. And if they reply, very good, the reply can be considered reasonable. But what if the reply is unreasonable? So reply to positive confirmation is as expected, it's fine, normally reliable. Okay, normally reliable. But if the reply is not received, now again once again I am saying, if reply is not received, that is the not only method on earth. So what should you do? Alternate procedures. Now if alternate procedures are also not giving evidence, then we will consider the effect on audit report, which we anyway know. Okay, so what is positive confirmation, guys? Where you are expecting a reply either in the event of disagreement or disagreement, and you are also expecting a reply even when you seek information. Okay, then comes negative confirmation. In negative confirmation, you are expecting a reply. You are expecting a reply only in the event of disagreement. So here it's very clear, you will expect, so like say you are already sending a confirmation and that balance also will be told. So like say this time we will write the letter like this. We are during the course of the order X Limited, we have come to know that you are one of the debtors and we observe that your book balance is 20,000. If there is a different balance in your books, we expect a reply or kindly reply. A non-response from you within a period of 14 days is deemed as acceptance. That means if they don't reply in 14 days, time is over. It means that you will believe that the balance is right. Understood? So that's how it is. Only in the event of disagreement. But don't you think this is less persuasive? Negative confirmations are less persuasive than positive. You know why? For a simple reason that you sent out a confirmation to somebody, it is wrong, and still they didn't reply, and now that triggers the whole story. It is wrong and they didn't reply, which clearly indicates the fact that they should have replied, but they didn't. That is why negative confirmations are risky. So whenever you want to send negative confirmations, 5 conditions are to be definitely complied. Only if the 5 conditions are complied, then that too not one, all of them. Unless all the 5 conditions are complied, you can't obviously send anything here. What are the 5 conditions? 1. Item should contain small amount. If item contains a small amount, internal controls are effective. Internal controls are effective. Risk of misstatement, risk of material misstatement, the RMM component is less. Okay, so what is it? Item contains a small amount and internal controls are effective. Risk of misstatement is less. 4. Low exception rate.
low exception rate. You know what is exception? The chance that they would not respond, because the chance that they will respond, sorry. In a negative conversion, you are not expecting a reply, right? That is normal. But when you get a reply, that's an exception. So the chance that you will get a reply should be less. That is when you will send a negative conversion. So low exception rate. And like I said, now in the one more example, I sent a negative confirmation. That person read in your book's balance or 50,000. Are you no 50,000, 60,000? No. Okay, we will reply to this. He thought so, and he kept it aside. He forgot. Now he forgot, time got over, and what are you thinking sitting on the other side? That you sent him and he didn't reply, so that balance is correct. And after reading, sometimes if they don't reply, could that be a possibility or not? So you should believe that they will not do that. Only then you should send this, where third party will not disregard the request, will not disregard the request. So only then you can go for it. Okay. Internal controls are effective. Item contains a small amount. Risk of misstatement is less. Low exception rate, and where you believe that the third party will not disregard the request, only then you can go for external confirmation. Guys, this is what this particular standard spoke about. Standard number 505 is on external confirmation. What is an external confirmation? What are the procedures to obtain external confirmation? If management refuses to allow you to obtain external confirmation, yes and no, two things what you're supposed to do. And of course the two types of external confirmation, positive, negative, and negative can be given only when the 5 conditions are satisfied. So it's a very extensive standard. All 6 parts have been discussed with you. Right, shall we move on? I'm moving on to the next standard on discussion right now. We discussed 501, 505. Let's do 510. 510 is on initial engagements. Initial engagements. SA 510 is on initial engagements. Initial engagement means where you take up for the first time. Where initial engagement is where auditor has taken up the audit. Okay, for the first time. In other words, this is for your understanding, I'm telling. If you go by the book definition of initial engagement, where the previous year financial statements were two options. One, it is audited by a predecessor auditor. This is one case where it is audited by predecessor auditor. Second case, they are not audited at all. So in both cases, either in the past it was not audited and now you are auditing it, or it was audited by some other auditor and not you. In both these cases, this is only called as initial audit. And whenever you're taking up initial audit, again here also in this standard also, we are going to check 3 things, right? Initial audit of opening balances. Since this is the first time that we will do, all last year balances, have they been brought down properly? Opening balances. Consistency of accounting policies, and relevant information from predecessor auditors report, relevant information from predecessor auditors report. So these are all something very important. Opening balances, consistency of accounting policies, and relevant information from predecessor auditors report. So are they taken into consideration is also something that we need to see. Now let's look at first item, opening balances. So what you're supposed to do, check recent financial statements, whatever the most recent financial statement, check whether opening balances have been brought down. Carefully. Balance brought down have been proper. Are they carefully done? That's the first question. Determining whether all the opening balances have been brought down carefully. Nothing, take the last year closing balances and see whether they've been brought down properly. See this, practically speaking, today nowadays everybody is using software and ERP, so this problem might not arise. And since this problem might not arise, it's also important for us to understand we still do it. Okay, anyway it won't arise because there can be system errors in bringing down. So Whether opening balance have been correctly brought down, you can always cross check, right? By pursuing the audited financial statement. How do you do that? Check recent financial statements and whether they have been brought down properly or not is something that you are supposed to cross check very clearly. So now there is something where if the auditor observes that audit evidences are indicating the fact that opening balance are not brought down properly, right, where opening balance have been brought down correctly, yes. What if it's a no? Then you have to perform additional audit procedures, additional audit procedures to determine, because now see, opening balance have not correctly been brought down. So if they have not correctly been brought down, will that have an impact on the current year numbers or not? So perform audit procedures to determine the impact, determine the effect, you can say determine the effect on current year financial statements. Guys, simple logic. Last year opening balance are wrong. Automatically when they brought down current year, if that is wrong, opening balance will be wrong. If opening balance is wrong, irrespective of how correct the current year balances are, the closing balance is wrong. So, which is again saying that if last year closing balances are wrong, there are all possibilities that current year closing balances may also go wrong because of not rectifying the misstatements in the opening balances. So, very simple point, take opening balances, which is not even the closing balance of last year, take the most recent financial statements, I can say audited there in bracket. So, audited ones. I hope you guys are taking screenshots of what you're getting it, or you guys are making notes along with the revision videos. So make all these, like I'm making it very simple so that you don't have to go back and read the whole standard from the book. So when you see this the next time, your entire standard will be revised in 10 minutes. That's the whole idea. Okay. So opening balances, check recent financial statements that are audited and whether opening balance have been brought down properly. If yes, all fine, collect evidences. It's a 5 series standard, so gathering evidence makes more sense. Gather all the evidences. But where opening balance have been brought down, and then perform additional audit procedures to determine the effect on current year financial statements. You can see whether you can get the current year financial statement, you get it right or not. Now, obviously, final conclusive portion, conclusion. What is the conclusion? Obviously, both the situations, right? If auditor concludes that opening balances are misstated, no, guys, if you conclude means you have evidence. So, in this case, you will be giving either a qualified or adverse report depending on the seriousness, and just in case if your conclusions thereby auditor is unable to obtain sufficient appropriate audit evidence, then what will he do? He'll go for a qualified or disclaimer. So these are the two reports that he will give in this particular case. So I hope I am clear, whereby I am trying to make you understand what are the possible things that you have to check when it comes to your initial audit, which is about doing audit of opening balances. Check the recent financial statements that are audited. Whether opening balance have been brought down correctly, yes. Collect evidences, cool. No, then perform additional audit procedures to determine the effect on current year financial statements. And after you perform those procedures, you got a conclusion that financial statements not free from misstatement. Where you have solid evidence, you can go for qualified or adverse, and where you are unable to obtain, you can go for qualified or disclaimer. Now this is pretty much the first item called opening balances. This is what you do when you take up standard number 510, which is your initial audit. Now going further from there, let's talk about consistency of accounting policies. Now this is only one story, consistency of accounting policies, and you can check the consistency of accounting policies through last year notes to account. Take last year notes to accounts versus current year notes. Okay, how can you check last year notes to accounts versus current year notes? Check both these. So previous year and current year notes. Ideally, if there is a continuity, okay, no changes, then amazing, super, which means you can collect sufficient appropriate audit evidences to say that everything is being, nothing is changed. Now, but the question is changed. Now guys, there is no real reason why you should not change accounting policies. So if there is consistency of accounting policies, the answer to this is yes. That is, there are no changes, no problem, we discuss that. No, Their accounting policies, yes, there is no consistency, that means they have changed. Okay, now this is little serious situation, but because no problem, you have remembered the three reasons where it's required by another accounting standard or required by a statute and all that. You can change, nothing wrong, right? So consistency of accounting policies, whether the accounting policy changed. Yes, there are changes. I mean, yes, there are no changes, fine, everything is good. No, there is no consistency, that means changes have happened, right? Then ask a question about disclosure. Right? Did they disclose that change? Answer is yes. Then again, same answer. Collect sufficient number of audit evidences. Close the story. Where there is no proper disclosure, okay, then it's a classic case. And this is not a case where you will find auditor unable to obtain evidence. It's very much visible in the front of your eyes. Last year, it is there very much. Current year, it's there very much. See, both consistency is not there, proper disclosure is not there, where accounting policies have been changed and there hasn't been given a proper disclosure. All that you will do is to give what? Qualified or adverse. The classic case, there is only one answer here, qualified or adverse. There is nothing much, because last year notes to accounts and current year you can compare and you always will have evidence to say that there is lack of consistency or inconsistency is proved very clearly and they haven't disclosed about it. This is area number 2. Now moving on to area number 3, relevant information. Relevant information from predecessor auditor. Relevant information from predecessor auditor. Now what about relevant information from predecessor auditor? So if there is any relevant information from predecessor auditor, you need to understand that whether that information will have an impact. Now they say, let's say predecessor auditor gave a modified report. Okay, modification in previous year audit report. Right, he gave a modification. Now you have a simple task. Okay, if he is modified, fine. Right, whether opening balances have been adjusted accordingly. That is the question. See, he modified, right? You have to check whether opening balance have been, opening balance have been adjusted accordingly. The answer to this is yes. Yes, sir. Opening balance, just gather evidences, obtain sufficient appropriate audit evidences. Story is over. Nothing more. Just perform additional procedures. But yeah, watch this story. Modification the previous year audit report and opening balance have been adjusted. Answer is no. And it's clearly visible, right, that they haven't done that. And we don't know what modification he gave. He gave a modification maybe because of not having evidence last year, and now also you are not having evidence, but clearly for you it is an evidence to say that last year there was a modification, opening balances needed an adjustment and they didn't make that adjustment. So the answer is no. Predecessor auditors reports modification has not been adjusted in opening balances. You will modify current year report also. You will modify the current year report. Very simple. Understood, guys? So these are the 3 select items and select areas of what is called as a audit of opening balances or audit in case of an initial engagement. What will you do? 3 items we are covering in initial engagements, which is 1, opening balances, 2, consistency of accounting policies, and 3, relevant information from the predecessor auditor's report. I think we have going with the insight of understanding all this. So I hope everybody is following what we have discussed in the last 3 standards. We discussed 501, 3 selected items, and 505, what's an external confirmation and the 2 types of obtaining external confirmation, and this standard 510 on what is an initial audit and what are the 3 items that you will check in a initial audit. Along with this, let's move on to the last standard of this particular session, wherein we are going to discuss about SA 580, which is on written representations. Now there are some very important points in this standard. First of all, as usual, the question, what is a written representation? Right, written representation is a written statement. Written representation is a written statement provided. Written representation, written statement provided by management. provided by management to auditor, provided by management to auditor for doing what? Two things. Provided by management to auditor for two things. Okay, what are the two things? One is to confirm certain matters, to confirm certain matters. That's the reason number one. They'll give you a written representation. Two, it can be given in support of other audit evidences, in support of other audit evidences. That's the point, guys. So written representation is what? Written representation is a written statement provided by management to the auditor in support, or to, like, to confirm certain matters and support other audit evidences. So that's the whole point that we are actually trying to understand. Written representations, what do they constitute? For written representations are nothing but a written statement provided by management to the auditor to confirm certain matters and also in support of other audit evidences. So this is the exact point that we need to try and understand from the standard. And one of the most important and a star points, written representations on their own. That is, you are not doing any work and simply taking a written representation. Written representations on their own do not constitute to sufficient and appropriate audit evidence. Be very clear, okay? Written representations on their own do not constitute to sufficient appropriate audit evidence. They only constitute to evidence when they confirm certain matters or they are in support of other audit evidences. That's when they make a real sense. Otherwise, on their own, they are definitely not something to do with the sufficient appropriate audit evidences. So it's a very clear point that states what constitutes to a sufficient appropriate audit evidence. Okay. Now it's a very basic point as to who will give you written representation for what matters. We said management will provide it to the auditor. Now let's talk about the matters covered in written representation. Matters covered in written representation. What are the matters covered in written representation? Now, to go by that, first up, you need to collect a written representation from management saying that management has fulfilled what? That management has fulfilled its responsibility. That management has fulfilled its responsibility. That management has fulfilled its responsibility with respect to preparation of financial statements and to provided auditor with required information. Now this is compulsorily something that you have to take it in writing from the management, that they have fulfilled all their duties towards providing a representation, preparing financial statements. They give it in writing to you that they have prepared financial statements and it was their responsibility to do so. And 2, provided the auditor with all information required to do the audit. And 3, there are so many other standards which recommended for written representation, right? So you can take other written representations, like say example, you took it in 501. Remember, some time back we discussed litigations and claims. There you took a written representation. You can take again in 550. 550 is about related parties. So like that, so many places, other standards are also prescribing you to take written representations. You can even take it from that angle also. So those are the 3 points that you have to keep in mind. What are written representations? On their own, they do not constitute sufficient audit evidence, and these are the matters that you can take written representation for. Now, obviously, the form of written representation, it should be in writing. It's called written representation. So in writing, from whom? Management to auditor. That is the form of the written representation. And now very important point, date. When will you take written representation? Written representations will be taken by the auditor as near as practicable to, but not later than, as near as practicable to, but not later than audit report date. You can't take it after giving audit report, no. So as near as practicable to, but not later than audit report date, that is when you have to take. Very fag end of the audit, towards all procedures you finish, almost everything is done and dusted, it's all done, taken care of, and that is the point of time when you will actually go for taking a written representation. So what is a written representation? To its form and two things that it supports. On its own, it's not evidence, and these are the three areas you can take written representations for. And then the date, as near as practicable to, but not later than the date of audit report, that's when you take. Now the two very important situations towards the end of the standard: written representations. One, written representations requested, okay, provided by management, but there is doubt as to the reliability. Doubt as to reliability. That means they gave, but you are not confident that that written representation is the right one. See, if somebody is determined to do something wrong, the management, what is the problem in writing and giving? So they wrote and gave. It's not a big deal. So requested written representation provided, but you have a doubt as to reliability. Second one, requested written representation not provided. See guys, the logic is very simple. You requested, they didn't provide. You requested, provided, but there is a doubt as to reliability and you don't want to rely. Effect is same, no? So when a requested written representation is either not provided or requested, provided, but you have a doubt, what are you supposed to do? Of course, again, written representations are not the only way how you can do it. So in both these cases, auditor shall perform alternate procedures, perform alternate procedures, plus consider effect on audit report. Consider the effect on audit report. What is that effect? Now that you have everything, it is a requested representation not provided. And simple guys, when a requested representation is not provided, it leads to lack of audit evidence, and lack of audit evidence could lead to qualify or disclaim depending on the seriousness. So this effect, whatever we are talking about, this effect is nothing but qualify or disclaim is what the auditor would do with respect to that particular case. A requested written representation not provided or a requested written representation provided but is not reliable, both are leading to auditor lacking audit evidences, right? So in both these cases, what you will do is to not take those into consideration, and you will start performing alternate procedures. But if you are not able to get evidences from alternate procedures, you will consider the effect on audit report, whereby it leads to a classic situation of you are unable to obtain audit evidences, and therefore you will go for either qualifying or disclaiming the report. That's it guys, that's what I have for you in this session. 501, 505, 510 and 580, four very important 5 series standards. Okay, the part 5 of the revision series will take you through 520 on analytical procedures and 530 on sampling. An exclusive revision session is planned on that, so that we can cover two wide aspects of sampling and analytical procedures, and whereby you will have a complete understanding of that. And then we will pick up in the same session, after that, or in the same session if time permits, a discussion on internal controls, internal audit, and how internal auditors work can be used. So if we can target this, that gives you a complete insight as per the new syllabus from chapters 1 to 8. You will have a complete insight of right from the beginning to the planning part, preparation part, and then of course we would talk about, okay, we will do one thing, then in that case we will do 2 revision sessions, where one we will exclusively cover analytical procedures and sampling, and in the last of those series we will cover documentation and internal control part. So that sums up the complete understanding. Company audit, there will be a separate session already pinned up, that is already there, so you can go ahead and do the company audit thing. It's already available right now. So company audit, the 2-hour revision series is anyway there from 139 to 148, all the sections can catch up, and then we will have one final revision session on this one, audit reports and Caro. We will do it in one session to close our revision series. And chapters 9 and 13, that is audit of financial statements and special audits, we already have a video titled quick presentation, quick tips on presenting vouching and verification, so you can refer to that video. And once the series is complete, the next other 2 videos also, we will line up all this in a playlist and make, or if possible, and if it's able to be combined, I'll combine all the revision series into one video and make it available. But I think doing chapter wise, going time wise, along with your preparation makes a lot of sense, right? I'll see you guys in the next revision video, wherein we will be coming up with 520 and 530. Thank you. Hi guys, so this is quick revision part 5, and as I told you, we are going to deal two very important concepts in audit, covering two extensive areas. One is analytical review procedures and the other one is audit sampling. So let's go ahead and see how this particular standards are and what their insights are. Very important part to understand is that analytical procedures are still a part of substantive procedures. So let me take you through those analytical procedures as to what exactly are the analytical procedures. So I wanted to just remind the fact that substantive procedures, what we discussed in the past, substantive procedures, they are classified into test of details, test of details, test of details, and the second part of the standard is what? Analytical review procedures. Now, it's a very important part of our discussion because test of details, they both are vouching and verification. We don't have much to talk about it because we have separate chapter on it, and I already have told you that there are quick tips. The video of quick tips to this too on how to deal with them is already available. Now, this is exactly where we need standard number 520's guidance as to what exactly are analytical procedures, how is it going through, what is it you need as a prerequisite to do analytical procedures, and how you will be using them is also something that one needs to really understand. Analytical review procedures, let's deal with this. So first, as usual, whenever we talk about analytical review procedures, we go with the definition as to what exactly analytical procedures are. Analytical review procedures are nothing but an analysis of a relationship, or you can also say analysis or evaluation, anything makes the same meaning. Analysis or evaluation of relation between what? Financial information, between financial information, analysis of relation between financial information with both financial and non-financial information, financial and non-financial information. Now this is something that one needs to understand here. So analytical review procedures, which is part of substantive procedures, is talking about splitting the analytical procedures into comparison of two things. You're comparing financial versus financial, financial versus non-financial. The non-financial data is like headcount, that is number of people working in the organization. It could also be floor area. All these things are considered as non-financial information. Simple logic: if the floor area increases, we expect the number of employees to also increase. That is the reason why we would have bought more, right? So same way financial, here you can do sales to sales, sales versus sales comparison is financial. Purchases versus purchases, of current quarter to last quarter, last year to current year. So you can do that comparisons with respect to two financial items, and that is also called analytical procedures. Now what are the ways that we do this and how do we deal with this is also something that we will be able to figure out in this particular topic. We will go that into a deeper insight in that. But so how to perform analytical procedures, before we go there, what you need to understand is, whenever you are talking about doing analytical procedures, what is the right thing to do with respect to analytical procedures? Okay, analytical procedures is nothing but comparing what with what? Comparing financial information. When you are comparing financial information, you got to keep 3 points in mind. Compare something with comparable information of prior periods, comparable information of prior periods. Now this is one thing that you're doing. Comparable information of prior periods. Compare something with comparable information of prior periods. Point number 1. 2. Anticipated, that means future. Anticipated information about the future. Anticipated information. And then 3. If you compare, see, either you got to compare with prior period information, comparable information, or you got to compare with anticipated information, maybe like something like you can compare with forecast, what you made and all that. Or you can as well compare it with similar industry information. Similar industry information. Now these are some things that you would want to obviously compare, and that is exactly what we're trying to also do in analytical procedures. So these two are the fundamental points that you would want to understand. Analysis of a relationship between both financial and non-financial, wherein you also are talking about comparing these three things, that is compare comparable information with prior periods, anticipated information, or that is a forecast, and similar industry information. Now taking these into considerations, one of the most important questions is, if at all you are talking about anything with respect to financial statements, what are the aspects that you would consider in terms of a analytical review procedure? These are something that you need to obviously understand, because what are we using or what are we trying to compare in analytical procedures? Now, whenever we are performing analytical procedures, we need to also understand the timing of analytical procedures. A lot of people have done this particular thing wrong in the exam. Timing of ARP. When do you do it? Now in the standard it says that you can perform analytical procedures towards the near end of audit procedures. Near end of audit procedures. Now that has got nothing to do with what you do during the first two phases. See, near end of audit procedures, nobody stopped you from doing it. But nobody also stopped you doing analytical procedures during the planning stage. Right? So planning stage and testing, that is the performance stage, you can comfortably do analytical procedures. But most people have written wrong answers saying that analytical review procedures can be performed only at the end of audit procedures. Only? No. Yeah, it's a very ideal and a suggested time to do analytical procedures at the time of closing the audit. That's a very good time to do, but that doesn't mean that is the only time when you will end up doing analytical procedures, which is not the right thing to discuss. So you can do analytical procedures at planning stage, you can do analytical procedures at testing stage, and you can as well do analytical procedures near the end of audit, so that you can arrive at conclusions and compare. And if at all auditor's understanding of the entity and analytical procedures indicate some deviations which are very significant, then all that auditor has to do is to investigate into those results, which we will actually be doing towards the end. So very fairly simple standard. What to do in analytical procedures is a very important point. There are 4 steps to do in analytical procedures and the end results to compare. But how to do analytical procedures and factors to consider, these are some very important points that I would like to deal with in this chapter, because those are the most heavyweight parts of this chapter. So going back again, we have covered 3 aspects. That is, 1, what is the definition of analytical procedures? 2, what are we supposed to deal with or compare with when you're dealing analytical procedures? And 3, the timing of analytical procedures. Now let's move on to talk about point number 4, very important and very simple, techniques to perform analytical review procedures. And this is part of the new syllabus, guys. The question can come straight in the exam. There's no harm for the others to also know this. So the 4 techniques and straight could be a 4 marks question. First one is called as trend analysis. First one is called as what? Trend analysis. Of course, I hope you know what trend analysis is. Comparison of prior year's information. Just for you to know, prior year's information you take and compare, that is only called as a trend analysis. Okay, what is it called as? It's called as a trend analysis. Alongside that, it is also important for you to understand that we do for a trend analysis is more suitable for income statement items, because, and in fact the entire analytical procedures itself is more suitable for income statement items than balances, because balances, they reflect a position statement. But when you talk about P&L items, they are for a period, so you can compare last year what happened and current year what happened. I'm not saying they're not useful at all for the balance sheet items, but they make their own sense when you are trying to talk about. So this is trend analysis. Then we have ratio analysis. I hope you did this chapter in your financial management paper. Ratio analysis, computing all those ratios, gross profit ratio, net profit ratio, return on total assets, return on equity. If what not, 24, 25 ratios are there, you can cross check all of those. Trend analysis, ratio analysis. Now, this is where we need to, understand the second part of the definition, where they said non-financial data will be compared. Because in trend and ratio, both are involving numbers, right? But the third technique is called reasonableness verification. Now this reasonableness verification is mostly targeting non-quantitative factors or non-financial, rather, to be more precise, if you want to go by it, non-quantitative or non-financial or non-quantitative items are picked up. And based on what happened in the current scenario, if you want to already based on what has happened, you're going to create and expect what can happen. And that's the fourth technique, which is called as structured modeling. It is called as structured modeling. These four are the techniques. That are available: trend analysis, ratio analysis, reasonableness verification, and structured modeling. By their names only you can identify what they exactly are, and you can go by the trend analysis is about comparing last 3 to 5 years data and take the trend and understand. Ratio analysis is about taking all those 24, 25 ratios. Reasonableness verification is comparing a non-quantitative factor, like say for example headcount. The number of people working in the organization, they have gone up. The number of people working in the organization, they have gone up. And since the number of people working in the organization have gone up, does the floor area also go up? Salaries and wages also go up, and ideally we expect the turnover also to go up. So like that, establishing relation between the movements of non-quantitative aspects like that to quantitative aspects like salaries and wages. Obviously, headcount goes up, salaries and wages also have to go up. So considering those things in mind, we do reasonableness verification, and also there is structured modeling. Now, one of the most, I hope everybody is clear with these techniques, right? Now, while performing substantive analytical procedures, that is analytical review procedures is also called here substantive analytical procedures, because that is nothing but a substantive procedure, right? So very important part of this discussion is what are the factors to consider while performing substantive analytical procedures. It's a very, very important question, guys. Then there needs to be a proper follow-up on this, okay? The timing of analytical procedures, techniques are done, and now factors to be considered while performing substantive analytical procedures. To do all of this and to do whatever we are talking about, first and foremost thing before we discuss anything, there needs to be availability of data. If data is available, then only you can talk about doing anything of this, right? If data is not available only, what are you talking about? And even if data is available, it should be capable of being broken down into parts, and it should be easy for somebody to work on it. That is called disaggregation. What is it called? Disaggregation. Availability of data, disaggregation. The more the data can be disaggregated, the greater is the amount of analysis that you can do. As simple as that, right? You can go and dig deeper into the data, and further you can make more analysis only when the data is capable of being disaggregated. And one of the most important points, as I was telling you some time back, is account type. Which type of accounts are more suitable for analytical procedures? Now, like say I'm saying income statement items. I am not saying that it is not suitable for balance sheet item, but it's more suitable for income statement items. Very important, because you can tend to do these kind of works more on sales. You can do these kind of things more on purchases, or like that, you can kind of put an impact on it. Availability of data, disaggregation of data, the type of account that you're following, and most importantly, source. Where did you get this data from? The source is also an important thing, because the source is not reliable, then the entire exercise that you will be doing on analytical procedures may not really work properly. So therefore, pick up the source And most importantly, again, another very important factor, the items that you choose to do analytical procedures, if they tend to be predictable over a period of time, I hope you heard this line when you read before, predictable over a period of time. So predictability is another very important factor that you have to consider. The more the data is predictable, the better you can get the analytical procedures and results. You can work on those in such a case. And again, as you said, these are more suitable for income statement items. Even the assertion types, if you see, assertion types, these are more suitable for assertions like what? Completeness, accuracy, validity, occurrence. These are more those type of like assertions which are useful for income statement items. Okay. So availability of data, disaggregation of data, account type, source, predictability, and the type of assertion, assertion types, or nature, you can say nature of assertion. That is the right word you can use. And figure out items on inherent risk. It's a very important factor. Inherent risk, if the inherent risk is high, that is, you can figure out WCGWs, what can go wrong. If you can find out what can go wrong the sample, and then you can see whether you can make any kind of understanding of that or not. So when designing substantive analytical procedures, you choose those items where the inherent risk possibilities are higher. So guys, these are the very important parts of this standard. Once again, let me take you through from the beginning. Analytical procedures are nothing but a relation between or evaluation of financial information with a comparison with financial or non-financial data. Then comparing financial information, if you're doing it, you've got to keep three things in mind. That is, compare something with comparable information of prior period, anticipated information, and similar industry information, so that there is no second thought about doing something in this particular case. Moving further, we also are talking about the timing of analytical procedures. So when you're doing a timing of analytical procedures, you can do it in the planning stage, you can do it in the testing stage, you can as well do it near end of the audit procedures. And not only that, the techniques that are involved in doing the analytical procedures, trend analysis, ratio analysis, reasonableness verification, and structured modeling. Apart from that, you also have 7 factors to consider while doing them: availability of data, disaggregation, account type, source, predictability, the types of assertions that are used, and inherent risk on what can go wrong can be also understood. So I hope those guys who are regularly following these videos, you guys either are making notes or taking screenshots of this, things can be made more easy in doing this. Okay. So let me move on to the last part of the standard, which is talking about auditors understanding of the entity. Auditors understanding of the entity. This is one part of the story. Auditors understanding of the entity versus results of analytical procedures, results of analytical review procedures. Now, if these two are in line, that is, the results of analytical procedures are in line with the auditor's understanding of the entity, in line with auditor's understanding of the entity, no tension at all, things are cool. Where there is an inconsistency means based on what analytical procedures you did and based on what you thought the entity is, the kind of understanding that you're kind of maintaining, that there is an inconsistency, you are not somehow happy, then this time I'm using this word which is not generally used in audit, which is called investigation, but this time auditor is suggested to investigate further. So why do you say that investigate further? It is because the word investigate means to dig deep into. Now very clearly it is told that by doing the analytical procedures, you got an understanding that there could be some kind of an issue. Now when you know that there could be some kind of an issue, that is exactly why you should not leave it just like that. So professional skepticism is about having a reasonable doubt, but now that reasonable doubt is turning into very clear indications here with the analytical procedures saying that there can be something wrong. So when you are very clear that there can be something wrong, it is always better that you go for what is called as something to do with identifying and assessing the risk of misstatement by doing the investigation. That's it. That's the last part of the standard. If there are So if your understanding is not going in line with that, then you have to do this. So what to do in analytical procedures as such, if analytical procedures, steps involved in analytical procedures, yeah, that is also something that I missed. Steps involved in analytical procedures. Step number 1, right? Suitability of an analytical procedure. Suitability of analytical procedures. You have to figure out what analytical procedure is suitable. You saw 4 techniques. Out of those, which one is suitable? Now, having selected a suitable analytical review procedure, what you need to do is check the reliability of data. Whatever data you are getting it, you have to check that. Suitability of an analytical procedure, reliability of data, and then most importantly, if you have done this, like you selected a suitable method and you also have reliable data with respect to you to perform analytical procedures, now develop an expectation. Once you develop an expectation, you got to compare compare expected values, compare your expected values to recorded values. Expected values to recorded values is something that you have to definitely compare here. Suitability of a procedure, reliability of the data, develop an expectation, and compare the values. These 4 points, and this can also be a possible question. The 4 points we considered while performing substantive analytical procedures, or how to do substantive analytical procedures is: first, select a suitable method, then gather reliable data, and once you gather reliable data, develop an expectation based on that, and compare expected values with recorded values. See if there are all in line, and if they are not in line, after this one will come into picture, right? That your understanding with respect to the entity and what results you got because of analytical procedures is not in line, you might want to investigate further, and that's it. That closes this particular standard. So this standard again helps you gather sufficient appropriate audit evidences with respect to certain understandings of the auditor's perspective about the entity, and if there is something that where he needs to put up that work, you can always take into consideration of what to do further. Okay, so it's a very small but a very important standard, guys, which is called analytical review procedures, and actually in the new syllabus it's also been classified to be a separate chapter. Okay, so with that I think from the past where we've seen step number 5, this is step number 6 you can consider, and the last part step number 7. So I've covered 7 wide areas of the analytical procedures, and one last time let us look at all those 7. What are analytical procedures? 2, while comparing, what should you take care of? 3, the timing. 4, the techniques, 4 techniques that are available. 5, the factors to consider. 6, the steps involved in doing analytical procedures. And 7, comparing the results of analytical procedures versus the auditor's understanding of the entity to see if there is something inconsistent with respect to auditor's understanding of the entity. Okay, so that's the whole idea behind doing analytical review procedures, guys. And then going further, we have standard number 530 on audit sampling. Now I think it's a very interesting standard. You have lots of things to discuss here. Let's try and see in the quickest possible time how much of this standard can also be discussed. First of all, audit sampling. What is the technique of sampling? Verifying less than 100% of the items, verifying less than 100% of the items, and that is what? Items in the population. Now that leads to a new question as to what exactly is the population. Verifying less than 100% of the items in the population. Population leads to what? Entire set of data. Population nothing but entire set of data. Now these are 2 very important definitions which are very much important as part of the concept of sampling. Audit sampling is nothing but verifying less than 100% of the population. Population means entire set of data. If you have a brief understanding of these 2. Now the next question is, then after we have an understanding of these 2, what are we actually trying to do by having that understanding? Okay, you are using the concept of sampling. So what you will do now is, you will perform audit procedures Listen to this carefully. Perform audit procedures on sample. Perform audit procedures on sample, and based on this, based on sample, you will draw conclusions. You will draw conclusions on population. Now, watch out what's happening here. You are performing audit procedures. Very good. That's what is the idea. Perform audit procedures on sample, but you're drawing conclusions based on the sample over the population. Now, that's it. So, you are not checking the entire population, but you are drawing the conclusion on the entire population based on what you checked in the sample. So, based on what you checked in the sample, you are doing a complete verification or vouching of the sample but drawing conclusion of the population. Isn't that risky? Because based on sample, you come to a conclusion, and based on population, that is, had you verified the entire population, you would have come to a different conclusion. Now, considering these two, that is the conclusion that was arrived based on sample versus the conclusion that was arrived based on population. Now that, and if they both don't match, that is only called sampling risk. The risk that auditor may end up making a wrong conclusion based on sample. That is what is the concept of sampling risk. Okay, but before I deal with sampling risk, I want to take you through a couple of other things so that we can discuss what anything else is. So I hope you understood what is population, what is a sample. Is that part of population that is selected for verification is called a sample. The best part about sampling is that you will do verification procedure, you will do all your audit procedures on sample, but you will end up drawing conclusions on the population itself. So which is what is the entire idea of this concept of sampling, so that it can ease and comfort your time and the extent of work that you do, because the amount of time that you take to do a particular work will be more if you do the entire work on population. But if only you're doing that work on sample, then your work burden is also reduced and you can draw a conclusion on the sample also. Now, going by that, so that is the very first topic of some of the very important definitions of sampling and what you will do. Then going to the next part of the discussion in sampling, we are talking about the sampling approaches. Approaches to sampling. Approach to sampling. So if you go by the approach to sampling, there are two approaches to sampling. The first approach being judgmental sampling, or it is also called non-statistical sampling. Non-statistical. The very reason why this is called non-statistical is because the other one is called statistical. Statistical sampling and judgmental sampling. So if you are not using statistical sampling, anything and everything else is all what? Non-statistical sampling or judgmental sampling. This is purely based on auditor's professional judgment. Which one? Professional judgment is what judgmental sampling is about. But statistical sampling has two things, right? You will have random selection. You will have random selection. That means every item in the population will have an equal chance of selection, and also use of probability theory. Use of probability theory. So if they either use probability theory or they should have both. Every item should have an equal chance of selection, plus they're using a probability theory. That is only called as statistical sampling. Now, please don't mistake the fact that statistical sampling is much better than judgmental sampling and all that. Nothing. Statistical follows random selection and using probability theory. Judgmental doesn't. And there is nobody who told you that you can't make good judgments without following the statistical method. You can always do judgmental and still get the best samples and pace. This is purely based on auditor's experience and professional judgment, right? So which one is better? That is not a question to be asked. But there are two approaches. Remember that much. One is called a statistical approach where they use these 2 points, and the other one is called a judgmental approach. That's it. And that is very clear on how you deal with these two. Clear? These are the two approaches to sampling on what will you be doing in terms of what a audit sample is all about. Guys, I think you guys are supposedly following what is being told. And again, once again, I'm just reminding, you just want to take a screenshot of whatever it is, you can always pause and take a screenshot. Now, let me move on to the next, that is the third part of talking about what exactly is the concept of reading or doing this sampling. by using the various sampling techniques. Sampling techniques, that is a question. Sampling techniques. What are some of the sampling techniques? Now, if you have some of the sampling techniques, you should always go by using one of the sampling techniques. What are those sampling techniques? Simple random, like first let's say they're classified like this: random sampling, interval sampling, monetary unit sampling, next one, block sampling, and haphazard sampling. You can use any one of these. There is no force or no compulsion on you to use only one of these. You can use any of these: random sampling, interval sampling, monetary unit sampling, block sampling, and haphazard sampling. So all you need to do is to understand that what each of these are. Let's not take all our time in putting up, because these are some of the things that have come in the past in the exam. They can always come down. Random sampling is further classified into simple random sampling. Now the best thing about simple random is that every item has equal chance of selection. So I'm saying 1 by 100, which means if there are 100 items in the population, every item has an equal chance of selection, which is 1 by 100. Then there is stratified random sampling. What about stratified random? Now if you say what is stratification, now here first I need to tell you what is stratification. Now sometimes it happens that we have a heterogeneous population, that is population ranging in a very wide manner. So of that heterogeneous population, first you have to break the heterogeneous into sub-homogeneous. So dividing a heterogeneous population into sub-homogeneous populations. Okay, sub-homogeneous populations. This entire process is called what? Stratification. Now, apart from understanding what stratification is, this part of selected population is called as strata. So, what will we do with the strata? Nothing, you will perform again simple random only. So, only this is a two-step procedure. Like say for example, data are ranging between 10 rupees to 5 lakhs. You are having data ranging between 10 rupees to 5 lakhs. Now, if you don't do stratification, and this is a very wide population, so what we'll do, everything up to 10,000, that is 10 to 10,000, let's call it as one group A. Then we will go with 10,000 to 1 lakh as group B, we'll go with that. Okay. And then we will say 1 lakh to 3 lakh as group C, and 3 lakh to 5 lakhs as group D. Now let's go by this. So the moment you break something like this, and inside each, now they become sub-homogeneous populations, and then you can go ahead and select one by one. What is this two-step process called? Stratification. First, divide a heterogeneous population to sub-homogeneous groups, and in that sub-homogeneous groups you again do simple random, which is your first method of sampling or sampling technique, which is called as random sampling, which involves both simple and stratified. Then go by interval sampling. Okay, interval sampling. Now what are we doing in an interval sampling? Nothing but, let's say there are 1000 items and we want a sample size of 50 items each. Now how can you divide 1000 items or 1000 transactions of 50 items each? You can, it is nothing but equal to 20 subpopulations, right? 20. So what you will do here is, you will go by interval 1, 2, 3, 4, 5. Like this you will populate all 20, and you can do one thing, you can leave an interval and start selecting whatever you want. Now this 20 populations each consisting of 50, right? So I'm going to select 2, 4, 6, 8, 10, 12, 14, 16, 18 and 20. So why did you select only these? The first number is a random start. The first one that you picked up, no? That's a random start. You can as well do 3, 6, 9, 12, 15 also depending, and nobody said that you have to break it down only with 50. So if you want only 10 big clusters and you want to break it into 100 items, you can still do that. It's all depending on. So you will leave a definite amount of interval and then go by that. That is why it's called as interval sampling. What is interval sampling? Is a systematic selection method. Okay, it's a very systematic selection method. That's why it's also called systematic sampling sometimes. Interval sampling, the second one. Then the third one goes by its name, monetary unit. Monetary unit, wherein you will go by simply straight high value items. High value items are selected in that monetary unit sampling, high value. Then as we spoke about fourth one, block, wherein you say a definite block of consecutive items. Definite block of consecutive items, wherein if you are seeing that you want to pick up from 101 to 200, all continuous, definite block of continuous items, that is what is called block. And when you follow no particular manner, to avoid personal bias, to absolutely avoid personal bias, there is no scope where any personal bias involved, no stratification, nothing, absolutely it's random, you're preparing everything and picking up, that is only called as a haphazard sampling. So this is what we're talking about here. Sampling techniques is a major topic in the sampling, right? Random as part of simple random, stratified random, dividing heterogeneous into subhomogeneous is called stratification, and it's called strata. From the strata things are selected, then interval, monetary unit, block and haphazard sampling. I hope that has given you an insight on what exactly we are supposed to do in terms of a sample when you are picking up using one of these methods. So guys, you got to go through these two things and not make a mistake here. As you see, the approaches to sampling are judgmental and statistical, and the techniques or methods used for sampling are these 5. Let's now get to the last concept in sampling. I would want to close the topic on sampling by discussing the concept of sampling risk. Sampling risk, very important topic as far as I am concerned here. Sampling risk. What is sampling risk? Is nothing but risk that auditor's conclusion, based on sample, auditor's conclusion based on sample is different from auditor's conclusion based on population. Had you audited the entire population, you would have come to one conclusion. Take the on hand. You audited sample, take that. Ideally, they both should be same. That is the idea of sampling, right? The sampling concept itself is that you will do audit procedures or on the sample, and you will draw conclusions on the population. That is the idea. But had you audited the entire population, there was a possibility that you might have got a different opinion. Now that is quite dangerous, right? Because based on sample, you came to some conclusion. Based on population, you would have come to some other conclusion. The possibility that these two are not same, that this different, the possibility, the risk that the auditor's conclusion based on sample may not be the conclusion he would have derived based on auditor's procedures on population, that is only called as sampling risk, which is a very, very important point in terms of considering that. Now, how does this happen? So this happens when you consider based on sample the results, you judge them and the effects of this. Let's understand this. I want everybody to understand this table carefully, how I'm getting this. So what are the two audit procedures? Audit procedures, if you go by audit procedures, you have compliance procedures and you have substantive procedures, right? Okay, we will go by both those. Compliance procedures. Now compliance procedures, obviously you're testing controls. Substantive procedures, you're testing transactions, account balances, you know that. So controls, we use the word deficiency, and substantive procedures we use the word misstatement, right? So wherein as per compliance procedures, based on sample, this is one conclusion, based on sample, and then actual conclusion which would have been on population, if these two are there, what sort of risk is it leading to and what is the effect? These are the points that we need to try and understand right now, okay? Based on sample, the first thing, based on sample, auditor concludes that controls are effective. He concluded, okay? He picked up a sample and he checked and he said that controls are amazing, they're very effective. But if you look at the actual story of it, controls are not effective. Controls are not effective. This is the reality. But when will you get to know this? Only when you check the whole population. But since you are concluding that they're effective, now the see the negative effects. You concluded that the controls are effective. Now because you conclude that controls are effective, you will do less of substantive procedures. Now the fact that you will do less of substantive procedures, there also you are reducing the scope for finding any misstatement, which is why this risk is called as risk of over reliance. You relied too much on the controls where you should actually have not relied, and the effect of this, you might end up giving an erroneous, that is a wrong audit opinion. This piece is very dangerous. Erroneous audit opinion. Okay, but the other side, okay, that is still wrong, but it's slightly cool. You know how? Because you believe that controls are not effective. Based on sample, you believe that controls are not effective, but actually they are effective. Now guys, simple logic. When we decide that controls are not effective based on the sample, will we extend our audit procedures? Yeah, that's what they told, no? So whenever you are not happy with the sample, increase the sample size. So that's what we will do, and we will eventually get to know the reality that it is effective. So based on sample you conclude that they are not effective. Then you will obviously increase the sample size and eventually get to know the reality that they are effective. This is called as under reliance, where you could have relied on a control, where you could have relied, you didn't rely, and that is why this is called under reliance. But this time you're not going wrong with the opinion, but definitely it leads to some kind of more audit work, right? Leads to more audit work. Same thing, flip side of the story, if you're talking about substantive procedures wherein auditor decides that material misstatement, auditor decides that misstatement does not exist. Auditor decided that misstatement does not exist. Now look at this. When you based on sample conclude that misstatement does not exist, you will definitely not increase the sample size because you are happy with it. No, but actually misstatements exist. No, that's the tension. Right? You accepted a sample which you shouldn't have accepted. This risk is called risk of incorrect acceptance. What is it called? Risk of incorrect acceptance. Where you unnecessarily accepted something that you shouldn't have accepted, which is again leading to the same thing where you might end up giving an erroneous audit opinion. Very dangerous. Vice versa, the story is not very dangerous for a simple reason that you believe that misstatement exists. Now, actually it does not exist. Now, the moment you know that misstatement does not exist, you will obviously, when you know it exists, you will increase the sample size, and when you increase the sample size, you will get to definitely a conclusion that no, actually material misstatement does not exist. Things are eventually becoming slightly cool. This kind of a risk is called incorrect rejection. You rejected a sample which you could have actually accepted. This is called incorrect rejection. And this will also definitely lead to same more audit work. Okay. So quite a dangerous thing here. But these two things, under reliance and incorrect rejection, not a great tension. But definitely over reliance and incorrect acceptance are a great tension. All these put together, they make up the concept of sampling risk. That's the whole point. I hope you understood. Let me quickly in a minute just revise this. We have two procedures, compliance and substantive. In the compliance procedures, you picked up a sample. Based on sample, you decided that controls are very effective, but actually controls are not very effective. So this is what happened. When you believe that they are actually effective and they are not effective, you did over-reliance on them, leading to wrong audit opinion. Same way, when you believe that controls are not effective, actually they are effective, that means you under-relied on the control, but eventually you get to know that by performing more audit work, and vice versa on the story on substantive procedures, where you believe misstatement does not exist. Now that's a serious thing. You believed of that it does not exist, but actually it exists. You incorrectly accepted a sample, which could again lead to an erroneous opinion. So these two are quite dangerous sampling risk, and 2 and 4 are not so very, because we are still doing more audit work and getting away. So I hope you understood the concept of sample, population. So quickly going back, what are we talking about here? Are all of these points, guys? We have had a lengthy discussion on sampling. What is the definition of sampling? What is population? What are the two approaches to sampling? What are the sampling techniques? And what is the concept of sampling risk? They're all something that we need to understand through this standard on sampling. And if auditor is not happy by doing sampling procedures, you may always want to extend the sample size. And if sample indicates anything that is a material misstatements or fraud presence is there, then auditor might want to investigate the results thereof. So that is what is the conclusive part of the standard. And there is also one very, very important thing that I want to conclude with, what is called as an anomaly. An anomaly is a misstatement or a deviation, which is not a true representative, of the population, which is not a true representative of population. Now, because this is not true representative of population, any conclusions that you make on anomaly, that there may be more items like this, you may go wrong. So anomaly are those items which are one of their kind, okay? They are not true representative, they demonstrably not a true representative of the population. Based on those anomalous transactions, you should not make or draw conclusions on the entire population. But as a basic point, everybody will have a same and simple question that, sir, how will I know it's an anomaly? Wherein that would lead to a matter of professional judgment. And wherever auditor judges, right, an item, it is first of all in a rare cases, an item which is considered as anomaly, that too in extremely rare circumstances. When auditor concludes an item to be an anomaly, okay, if he concludes it, he has to obtain sufficient appropriate audit evidence to say that really that item is anomaly only. Okay, so what is an anomaly? Which is not a true representative of the population, and if you take any conclusions based anomaly, you may go wrong big time. So that is one of the reasons why, for you not to go wrong, you have to understand and make a proper professional judgment considering the fact that it is really an anomaly, and for this you have to obtain all possible evidences, that is all sufficient appropriate audit evidences to make sure that the item really is only an anomaly and that is not a true representative of the entire population. So I hope this session was pretty much useful for you in understanding two very, very important standards. In fact, in the new syllabus they classified into two different chapters. So I think this video, of course it's a longer one, but compared to, and I've been relatively slow in this video for a simple reason that these are concepts that people have to understand by putting that much amount of focus. So I hope this video provided you insight about both analytical review procedures and audit sampling. So I will see you in my next revision video very soon. Thank you. Hi guys, welcome to quick revision part 6. In this revision session we are going to talk about three concepts: audit risk, which is one of the very important concepts which explains the relation between inherent risk, control risk and detection risk. And then we will also be talking about section 138. Section 138 speaks about internal audit and how we can use the work of internal auditor. So this is the coverage of this particular session. Here we will be talking about three aspects. Let's start with the first one: audit risk. What is the concept of audit risk? Now, the first point that we are supposed to discuss here is what is the concept of audit risk, and then we can go by breaking down the risks involved in that further. So as we speak, the first and foremost thing that we need to pull out here, audit risk as a now, what is the main objective of the audit? Main objective of the audit and the auditor is to express the opinion, right? Right. In expressing the opinion, what can go wrong? Okay, where the financial statements are materially misstated and the auditor says no, they are not misstated. Now that can lead to a serious problem whereby the shareholders, whoever are there, they may end up thinking that the auditor's opinion, is a true and fair one, and he is saying that financial statements are true and fair. can be true and fair. Now that is exactly what can cause some kind of a discomfort later to the auditor, because where financial statements are materially misstated, he has ended up calling them that they are true and fair. So that the risk is always there. So let me put it up in clear terms. So audit risk is the risk that auditor risk that auditor may give an inappropriate opinion. Risk that the auditor may give an inappropriate opinion when the financial statements are misstated. When the financial statements are materially misstated. When the financial statements are materially misstated, you are not supposed to give a true and fair view. But this person right here is giving a true and fair view even when the financial statements are misstated. So that is called the audit risk. Risk that the auditor may end up giving an inappropriate opinion. Actually, what is the appropriate opinion that you should give when financial statements are materially misstated? When financial statements are materially misstated, you should be giving something that is not true and fair. Like you have to give a modified opinion, but he is giving a clean report. This possibility is called as audit risk. Now you have to understand why audit risk arises. Audit risk arises because of two components broadly, which is called RMM, which is nothing but the risk of material misstatement. Risk of material misstatement. Risk of material misstatement. Now what you need to also understand as part of risk of material misstatement, see the logic is very clear. Risk of material misstatement, when you are talking about, this is purely arising at the level of management, because it is a duty of management to state everything, right? It is a duty of management to state things. So the possibility that management may wrongly state certain things is a risk of misstatement. And the possibility that misstatement can turn out to be a material one is what we are discussing in this particular case as risk of material misstatement, the component called RMM. If that is on one side, then that is from the problem of management, right? What is from the point of view of the auditor? Auditor is also performing substantive procedures, correct? Auditor is also performing substantive procedures. The possibility that auditor's substantive procedures may not detect a material misstatement, that is called detection risk. That is called detection risk. So audit risk has two components broadly: risk of material misstatement and detection risk. Now, RMM is further broken down into IR and CR. Risk of material misstatement. This one has two subcomponents, which is called inherent risk. Inherent risk. Now, inherent risk arises because of lack of control. The controls itself are not there. That means the risk is there by nature. Risk is there inherently. Then if inherent risk is there on the other side, you to overcome inherent risk, we'll set up controls. But there is always a possibility that controls may fail, and that is called as control risk. So what you see right now here is the brief overview of what is contributing to the concept of audit risk. So audit risk is nothing but the risk that auditor may end up giving an inappropriate opinion. That too when the financial statements are materially misstated. And therein we talk about breaking it down into two parts: risk of material misstatement and detection risk. What about risk of material misstatement and detection risk? Risk of material misstatement arises at the point of view of management, because something that can go wrong, it is their duty to state, and while they are stating, if something can go wrong, that is only called as a risk of material misstatement. But yeah, it can also happen that auditors, substantive procedures may not be able to detect a misstatement, which is also called as detection risk. So, and why will something go wrong at the level of management? If that is the question, why will something go wrong at the level of management? The answer is very simple. Either because the risk is there and they haven't addressed it, which is called inherent risk, or because they've addressed it by setting up a control, but there is a lapse in the internal control, which is called control risk. So we have to understand all these three terms very clearly. So first let's start with understanding what are the contributors to the concept of risk of material misstatement. Risk of material misstatement. Now, what is risk of material misstatement? Here, risk of material misstatement, first contributed to that is inherent risk. What is inherent risk? Inherent risk is a risk that their financial statement may be prone to a misstatement, right? Risk that financial statements may be subject to a material misstatement, may be subject to a material misstatement. Okay, risk, what we're talking about here is that financial statement may be subject to a material misstatement before consideration of controls, before consideration of internal controls. So before even you consider any sort of internal controls, if there is a possibility that something can go wrong, the possibility of that something going wrong is only called as inherent risk. Now, what's the next best thing that you can do to bring down the inherent risk? Inherent risk is brought down, or you overcome inherent risk by what? Setting up of controls. Setting up of controls. You set it up by, you do it by setting up of controls. Risk of material misstatement occurs because of inherent risk, because it is naturally there, the possibility of something going wrong. But then also what you need to understand is that it can be brought down by setting up some controls. But the story is not over there. You have set up controls, but there are all possibilities that the controls may not achieve its objectives, right? What is the main idea of control? To prevent and detect. But the possibility that a relevant internal control, may not prevent or detect and correct. Now, either it should prevent or detect and correct. So, a possibility that a relevant internal control may not prevent or detect and correct, or fails to prevent, detect and correct. This particular concept is called as control risk. What is it called as? Control risk. Risk that the control may not be able to fulfill its objective. That is only called as control risk. Now, you need to be very clear about this. IR and CR, whatever you are seeing there here, these two, they have to always be assessed together. A combined assessment of IR and CR is supposedly to be done, for the simple reason that you cannot distinguish between IR and CR. That is why no standards distinguish IR and CR. They're always talking about risk of material misstatement, because these can't be there. So please understand, if IR is there, which means that inherent risk is there. So controls are only not there. The very reason IR is existing implies controls are not present. When controls are not present, there is no question of CR. Okay. Now, if you say control risk is there, the very risk that control risk is there is only because controls exist. And when controls exist, IR won't be there to that extent. So, please understand, IR and CR, they don't coexist in the same thing. In all those areas where inherent risks are there, they are there because controls are not there. Same way, in all those areas where control risk exists, which means inherent risk has been already handled and addressed. So we need to understand that IR and CR do not coexist. So what is the solution here? You need to do a combined assessment. There always needs to be a combined assessment of IR and CR. So that's what take home from this particular concept here right now they're talking about. So end of things, you need to understand RMM, that is risk of material misstatement, it is nothing but a combined assessment of IR and CR. Okay, it is a combined assessment of IR and CR, because it's a proportionately to be understood. In all those areas where controls exist, IR won't be there, and in all those areas where IR exists, which means IR is there, so therefore controls are not all there, so there's no question of control risk. So risk happens because of two things here, where controls not at all there, and controls exist, but they are not operating effectively. So I've got to put it in very clear terms for you. Let me say RMM, the reasons. One, controls do not exist. This is the final conclusion. Controls do not exist. Controls exist. Controls exist, but they fail. They fail to prevent or detect and correct material misstatements. Detect and correct material misstatements. That's it, very clear. Right? If controls do not exist, that is inherent risk, and if they exist and don't protect, it is CR. Now, what is your assessment as an auditor about IR and CR? Now, the simple logic is, if IR and CR, that is the combined assessment of these, IR and CR, that is the risk of material misstatement, is assessed as high. Assessed as high. Now guys, tell me, if IR and CR are high, which indicates that either controls don't exist or controls are weak, right? IR and CR are high means that only, no, either controls don't exist, that's why they are high, or exist but not operating effectively. Bottom line, in both the cases, what you need to understand is you can't rely on controls. If IR and CR are assessed on high, or it is not to rely on controls, not to rely on internal controls, which will lead to a consequence of perform what? Perform more substantive procedures. Perform more of substantive procedures. Now this itself is creating a lot of impact here. Perform more of substantive procedures. So there exactly is something that one needs to consider as to how we will be doing it. It's assessed as high. We're not supposed to rely on internal controls, and you have to perform more of substantive procedures. Now that brings us to the understanding that if IR and CR are assessed as low, which means you believe that internal controls are operating effectively, you can comfortably do less of substantive procedures. So the vice versa of this story also holds good, is what you're trying to say. So your assessment based on this will determine the extent of or NTE of substantive procedures. So simple logic, but what we are trying to continue here is what saying assessment of IR and CR will determine the NTE, nature, timing and extent of substantive procedures. Nature, timing and extent of substantive procedures. That's it guys. So if you are assessing it as high and you are not relying on controls, you will perform more substantive procedures. So if the assessment will determine how much you have to do high or low. Now you doing high or low substantive procedures will determine your next risk, which is called as detection risk. Detection risk. Now what is the concept of detection risk? Is nothing but the risk that auditors substantive procedures, substantive procedures may not detect a misstatement, risk that auditors substantive procedures may not detect a material misstatement. Now that is something which is called as detection risk. Now that is a very simple risk because that is assessed accordingly. So your detection risk will be absolutely depending on the extent of substantive procedures you do. The more of substantive procedures you do, less will be the detection risk, right? But when will you do more substantive procedures? More substantive procedures will be performed when controls are not very effective. So now the final conclusion, as to draw a conclusion on how much is the audit risk. We assess RMM, we assess detection risk. So now what is the final conclusion, which is audit risk? Audit risk is arising because of two reasons, as I told you. Audit risk is nothing but risk of material misstatement and detection risk taken. So risk of material misstatement is nothing but a combined assessment of IR and CR, while audit risk is a combined assessment of all three. So AR, which is the audit risk, is nothing but IR into CR into DR. Close this topic. The last part of the story wherein we're talking about the relation between risk of material misstatement and detection risk. Risk of material misstatement and detection risk. What is their relation? The risk of material misstatement and detection risk, if you see what is their relation. Now, if IR and CR, the combined assessment of them are supposedly high, that is IR and CR are assessed as high, will you do more of substantive procedures or not? So, IR and CR is high implies more substantive procedures, which implies a lesser detection risk. Okay. Same way, if IR and CR are low, IR and CR are low means what? That means controls are already operating effectively. That's what your understanding is. And if that is the case where controls are operating effectively, you will do less of substantive procedures. And when you do less of substantive procedures, which implies that detection risk is high. So if you watch carefully, finally towards the conclusion, the relation between RMM and detection risk is nothing but there exists an inverse relationship. There exists an inverse relationship between the combined assessment of IR and CR and also the DR. That is the whole idea behind the entire concept of audit risk. So I want all you guys as you're doing it. So if this far you've come and you're already watching all these revision videos of course. This is part 6, so you've watched 5 parts already. I hope it's going good. So this is the whole idea here. We need to understand what exactly is the concept of audit risk. So audit risk is something that we need to understand as a matter of fact. Yeah, okay, I want you to go through the all 4 slides. Audit risk, the definition. Then we said that audit risk occurs because of risk of material misstatement and detection risk. Risk of misstatement, 2 reasons: inherent risk and control risk. And as to inherent risk and control risk, you also need to understand that it's a risk of material misstatement that distinguishes this fact. Inherent risk is nothing but the risk where controls do not exist, is brought, like before consideration of any control, that is called inherent risk. That's brought down by setting up of controls. And if you're setting up controls, new risk crops up, the possibility that control fails, which is called the control risk. That's how we understood IR and CR and the relation between IR and CR. Their assessment will give rise to what will be the NT of substantive procedures, which will help you determine what is the detection risk. And this is the final relation between all this. So take the screenshots of all those and just try to understand it once again. It's a very deep, very simple concept. You just have to understand what is IR, what is CR, and what is DR. I hope this quick revision of audit risk has brought back all the memories about what the audit risk is. Okay. So on agenda, the number 2 item is on section 138 of the Companies Act. Section 138 of the Companies Act talks about internal audit. Section 138 Companies Act talks about internal audit. Okay, so let's talk about some of the basic points here. This is a very prominent question that can come for MCQs or true or false, or even a short question can also possibly crop up. So let's talk about what companies have to comply with section 138, for which we have to know applicability of section 138. If you look at the applicability of section 138, starts with every listed company. Every listed company, so there are no two thoughts, there's a mandatory application for every listed company. Then 2, every unlisted public company. Every unlisted public company. Now when you say unlisted public company, you have limits, guys, here. So I want you to remember the limits using a small shortcut. You have DPBT. Okay, DPBT, wherein you have deposits, D for deposits, P for paid up capital, okay, and B for borrowings, and T for turnover. Now, as you understand, this being a very simple thing, why I have listed down in this order is because there are numbers which you have to remember, which you just have to remember that deposits are 25 crores or more. Deposits of 25 crores or more. So if you are having or accepting a public deposit of 25 crores or more, so that is exactly where internal audit will be applicable to you. And then start taking twice of each. The 25 becomes 50, 50 becomes 100, 100 becomes 200. Simple analogy just to remember, 50 crores or more of paid up capital. This borrowings, right, strictly is more than, okay, more than 100 crores. Now this I want you to remember, guys, because borrowings alone, they said more than 100 crores. It's not greater than or equal to, it's only greater than. And turnover again 200 crores or more. So if every listed company internal audit is applicable, unlisted company if they cross this limits is applicable, and for every private company also, or every private company, you again need to understand that only B and T limits are same, but only borrowings and turnover, only these limits, same limits, 100 crores greater than, strictly greater than 100 crores, and turnover 200 crores or more. Now what do you understand by this? This is the applicability for internal audit. Section 138 says this one, what is it called? Internal audit is applicable to every listed company, unlisted public company. You have a deposits, paid up capital, borrowings, and turnover of those limits 25, 50, 100, and 200 or more. And every private company whose borrowings and turnover are in excess of 100 crores, the borrowings, and turnover 200 crores or more. But this brings us to the end of applicability, wherein now you've seen what or to whom it is applicable. Now, big question is, who can be internal auditor? Who can be internal auditor? This is the second part. So this is point one. This is point two. Who can be internal auditor? Chartered accountant? Definitely. Chartered accountant can be. Cost accountant can also be an internal auditor, not a problem. As matter of fact, such other professional who has the requisite qualification, they can also be an internal auditor. So there is no rule that only a chartered accountant in practice and all has to be the internal auditor. Okay, internal auditor can be a chartered accountant, can be a cost accountant, can be such other professional. So that is what section 138 says. And one of the best things about this is the chartered accountant here may or may not be in practice. He may or may not be in practice, and he may or may not be the internal auditor, may or may not be the employee. So internal auditor can be the employee of the company also. No, that's a point. Okay. So all these points something that you need to remember very much about the internal auditor, because they've asked this question in the past. Mr. X is an employee of A Limited. Can he be the internal auditor? Very much. An internal auditor may or may not be the employee. Okay. So this is the applicability, and this is something to whom it is. Like to who can be the internal auditor, and of course, the audit committee if it exists, and the board if the audit committee is not there, so they will decide the scope and direction of the internal auditor. What is the internal auditor supposed to do, and what frequency? That is how frequently you will do the audit and what you will do. All those are certain things that are discussed under this very small section, but a very informative one, because the points here, the limits, and then who can be the internal auditor. This is the point, you can be the internal auditor. And then two very important points take home: you may or may not be in practice, and also as a matter of fact, if you are, it doesn't matter if you are chartered accountant, cost accountant, or such other professional also, and you can as well be the employee of the company. So this is what the scope. Again, I'm just also adding the third point here: scope, timing, and extent of internal audit. Scope, time, and extent are decided either by board or audit committee. They will decide what is the scope, time, and extent of internal audit to be performed, that they will take care. It's a very small, simple piece, guys, which is called internal audit. Okay. Then going by that, the first and foremost thing that we need to understand after this is internal auditors' work. Now, to all the guys who are doing only new syllabus, you have only one standard from the 6 series called 610. People, if you're watching this and you're from the old syllabus, you still have the other two, 600 and 620 also from the series. And since the other two 6 series standards have been cut down for the new syllabus, I'm possibly expecting that there can always be a question from standard number 610, which is talking about using the work of internal auditor, Now this is a point wherein in this particular standard you are deciding using the work of internal auditor. Now, with the amendment from 1/4/2016, this standard has taken a new phase. Like there are two parts to the standard now. This standard is not just going to talk about how to use the work of an internal auditor. This standard is also going to talk about if you can use the internal auditor for getting some work done by taking his direct assistance. By taking his direct assistance. Now, so let me take you through the two parts to the standard here. Part 1 is determining whether to what extent, three parts to this, determining whether and to what extent the work of internal auditor, the work of internal audit function, the work of internal audit function can be used. This is the first part. Okay, determining whether to use them. If at all you decide and say whether yes we can use it, to what extent, and whether the work done by internal audit is adequate or not. These 3 points you have to check. But this is part 1 to the standard. What is part 1 to the standard? Part 1 to the standard deals about determining whether to what extent the work of an internal audit function can be used. And going by the next part, here we're talking about determining whether in which areas and to what extent, determining whether in which areas and to what extent internal auditors can be used to, this time watch it carefully, provide direct assistance. That's a very important part. This is a new addition. Of course, it's been time right now. Not that it's very new and all that, but hardly there are any questions asked in the exam about this. So this is part 2 to the standard, and I want you guys to focus on this part 2 as well, because I understand that a standard can be asked in the exam only in terms of bits and pieces, but this less asked. Okay, they may not ask you the whole standard, but this is one of the less asked standards in the exam. They can always get back to asking it. So part 1 of this deals with using his work, which means he's already performed the work and we're just using that work. But part 2 of this particular standard deals with using the internal auditor himself for taking some kind of a direct assistance. That is, you make him do some kind of a work by taking a direct assistance. Okay. Now, part 1 and part 2, two parts to the standard. Let's go ahead and see how we are going to use these two parts to the standard. Okay, let's do this. Part 1 of the standard. I'm not writing the entire title again, guys. Part 1, I'm just saying using the work, which means he has already done the work. Okay, using the work of internal auditor. He has already done the work, and what you're doing is just using that work. In doing this, you got 3 branches to cover. One, first answering a question of whether you can use the work of internal auditor. If the answers to this question is like no, here itself you can stop doing this part of the standard, because you don't want to use the work of the internal auditor. Whether can we use the work of internal auditor? There are 2 questions here which we are supposed to ask. We will ask and see. And if the answers to those questions are yes, actually you can make it 3. Okay, whether. Then the next point is, if all these 3 are yes, like yes sir, we can rely on the work of internal auditor. So then they said whether yes we can rely on the work of internal auditor. Then part 2 to the standard is to what extent can you rely on the work of the internal auditor. There are 4 points this time here which are subject to decide. To what extent can you be able to rely on the work of internal auditor? Whether, to what extent, and if only you decide what extent you want to rely. A very important question is whether the work performed by him in that area is adequate. So you'll check the adequacy. So if you're happy with the adequacy, you can comfortably go ahead and rely on that particular work, for which again there are 4 points. We will catch up now one by one. We are going to see whether to rely. First question. Now, when will you rely? If that guy is competent enough. Okay, he should be competent enough, and not just competent. He should have worked with proper care and caution. Like a simple point. If you have worked in that area, with what care and caution you would have worked, this guy also should have worked with the same care and caution. That's the idea that we are looking at. Okay, so let's go with the questions to be asked. Whether, okay, extent to which internal audit function, extent to which the internal audit function is relevant, external is relevant, and the second factor that we're talking about here is relevant, and check their objectivity, check his objectivity. So relevance and objectivity are the two factors, relevance and objectivity. Those are the two factors that we take here, relevance and objectivity. Let's go ahead. I am taking up point number 2 after relevance and objectivity. Whether he performed his work with proper care and caution. Now, if he hasn't performed his work with proper care and caution, now before even that, to perform the work with proper care and caution, he should be of something, right? Some level that he is competent of. So, level of competence, relevant, that is relevance of his work, objectivity, level of competence, and whether he has followed a systematic and disciplined approach. Now, if the answers to all these three questions are yes, it's not like only one of them is yes. The answers to all those three questions are yes. That is, yes, the work is relevant. Whether the work is relevant, he has done it with being unbiased. Objectivity is about being unbiased, right? So yes, the work of the internal auditor is relevant and is done with it properly, that no bias is there, it's all clear. Objectivity, that being unbiased. The level of competence, with which he has done the work, that is all pretty much fine. And whether there is a systematic and disciplined approach in doing his work. Now, if you are confident and comfortable with these 3 points, the answer pretty much okay to this. So you can then decide the answer saying that okay, we can now rely on the work of the internal auditor. That is, whether to use, the answer is yes. What to do after that is a different question. Whether, the answer is yes. Then after that we have to decide what extent. To decide what extent of the work will be used, okay? I mean, like, you have to decide to what extent you will be using his work, right? For that you have to understand the nature and scope. That is the very first point. Nature and scope. What is the work that he did and whether that is any relevant to you, whether nature and scope of that work. To what extent, the first point that we talk about is the nature of the work performed by internal auditor and the scope. Because if his scope was limited, then you should not prefer relying on his work because that's making no sense, right? So you rely only on that where there is a proper scope for his work. So nature and scope. And then one of the most important points here, guys, you determine how much work you will rely on the internal auditor, right? But see, it should not be eventually that you use more of his work and you do less of his work. Okay, so just in one or areas, again, I'm not deciding one or two areas, but whatever, use less of his work, do more work directly. That's a very important point. Use less of internal auditor's work, and perform more work, directly. He has to do more work directly. That's a very important point. And after all this is there, no, it is very important because the end of the day, the knife is on your head only. The sole responsibility for entire audit, the external audit, is on the external auditor only. You relied on the work of internal auditor, you can't blame them. Okay, they did the work, I just relied, so it is all their mistake. Who asked you to rely? So remember, you use less of their work and perform more work directly, and always remember that sole responsibility for external audit is with external auditor only. There is no way how internal auditor is involved in this. He did the work. He didn't come and tell you, sir, please rely on my work and all that. You are relying because you want to reduce the NTE of your audit procedures. So you rely on his work because you want to reduce the NT and not because he asked. Whatsoever be the reason, for an audit opinion being expressed, the auditor is solely responsible. Remember this point very well. They can ask you this in multiple choice, true or false. Okay. The sole responsibility for all this is always with the external auditor. And most importantly, if at all you are using the work, communicate to TCWG as per SA 260. You might want to communicate to the TCWG that in which areas you are going to use their work and what you're supposed to do with their work. You communicate the TCWG. Okay. So two parts of the standard. To decide whether yes sir we can rely on the work of internal auditor, then you can decide to what extent. Accordingly, you can decide this extent. And now, one last thing before you wind up this particular part is the checking whether the work performed is adequate or not. Okay. See who has done this work? Internal auditor. Now, since the internal auditor did this work, it is important for you to understand whether the work performed by internal auditor is adequate or not. So, in this context, we are raising this time a few questions. First up, again, whether work performed by internal auditor, whether work performed by internal auditor, whether the work performed by internal auditor is all what? Planned, performed, supervised, reviewed, and planned, performed, supervised, reviewed. Time to time it has to be reviewed. Okay, and then it is also to be documented, because tomorrow what will you look at? Huh? So whether the work performed by internal audit is properly planned, performed, supervised, reviewed, and documented. This is something that we need to get a straight arrow, right? See, you are using somebody's work, whether they did that properly. Now, if they themselves didn't do that work properly, how will you use it? So whether the work performed by internal auditor is planned, performed, supervised, reviewed, and documented. That's your first question. If the answer to all that is yes, yes sir, it was planned, performed, and all this was gathered and all that, then only it should make sense. Then, okay, see, if it was planned, performed, documented, all that doesn't mean that internal audit would come to a proper conclusion, right? So you ask two more questions. What are those? Point number 2 on adequacy. What is point number 2 on adequacy? Whether sufficient appropriate audit evidence, whether sufficient appropriate audit evidence was obtained by, whether sufficient appropriate audit evidence was obtained by internal auditor, whether sufficient and appropriate audit evidence is obtained by internal auditor. It's always a important question to ask, because if he didn't obtain, what will you do then? Okay, and not just that, point number 3 says conclusions reached by internal auditor are appropriate. Very important, because if these conclusions, see, you should just ask yourself a question: if I was there in his place, whether I would have also come to the same conclusion? And if the answer to this is yes, then you can comfortably go ahead and check. So these are the questions that you are supposed to ask here, guys. Whether the performance of the internal audit is properly planned, performed, reviewed, supervised, and documented. If it was yes, that means you have enough data to work on. Whether sufficient approved audit evidence was obtained by the internal auditors, and if they obtained it, whether the conclusions reached by internal auditor are good enough. And also at this point of time, you have to consider one very, very important factor. These are 2 points that are repetitive from the first point, which is wherein you're talking about this one, objectivity and level of competence. So as part of this point number 4, to check the final point on adequacy, you have to do one very, very important check. Consider the nature and extent of his work. How will you do that? By considering judgment involved. If high judgment is involved, no, you do it directly. Don't ask them to do it. Same way, risk of material misstatement. What is assessed? If assessed risk of material misstatement is high, it's better you do it, not rely on them. And check their objectivity. And lastly, level of competence. Check their objectivity and level of competence. And most importantly, towards the end, do some work by yourself. You might have done, but you know this method, right? Re-performance of some work. They might have done it, but you do it again. I think that concludes it. Wow. So that looks perfect on screen right now. What you have is part 1 to the standard, and this is so clear. We have 3 questions to ask: whether, to what extent, and adequacy. Guys, this content is roughly 2 pages in your material, and that's been summarized on your screen right now. Absolutely. So if you can remember all these key terms, I think that itself is more than enough for you to remember this for the exam. And if they ask you, even if they ask you in the exam, this is what you're supposed to write. So there are no new things that you actually have to do. Whether, to what extent, and adequacy are the 3 factors that one needs to consider. I hope everybody has got clarity till here, because that's one last part that is pending for this standard and this particular revision session, which is part 2 to the standard. Part 2. What is part 2 to the standard? Part 2 is using internal auditors direct assistance. Using internal auditors direct assistance. Now here also, very importantly, if you are talking about taking direct assistance of the internal auditor, how will you do that is the question, right? Let's talk about that. Same thing, whether, and then determine the nature and extent. Okay, so let's go the 3 parts here. Whether can you take the what do you say, direct assistance of the internal auditor. Okay, same point guys, but one of the points that you have to keep in mind is whether it should not be prohibited by, I mean, like you can say, if not prohibited by law or regulation. If it's not prohibited by law or regulation, not prohibited by law or regulation, then what is it you can do? If it's not prohibited by law or regulation, you can comfortably rely, subject to checking, again the 2 things. One, which is called the objectivity of the internal auditor, and 2, level of competence. Now, it's a very important factor, guys, because if he is not competent, what will you talk about? So, level of competence. Sorry, yeah. So that goes there very clearly. So you're talking about whether to use the work of the internal auditor, part 1 of the standard. Part 2, whether to use the internal auditor himself for a direct assistance. And if the answer to that is yes, that can be yes only if it is first not prohibited by law. If law says you can't use the work of internal auditor, as of now there is no law which says that, but if there is any law that says you can't use the work of internal auditor, then definitely you might want to not use it up. But otherwise, wherein it's all saying that you can go ahead and use it, you need to understand that you can use it subject to these conditions: checking objectivity and the level of competence. Then moving up to part 2 of the standard, which is talking about the nature and scope. Now if you remember, we got to talk about the same 4 points that we discussed there. Which one? The judgment involved, risk of misstatement, understanding the level of competence and objectivity. They are same 4 factors. Okay, so the same 4 factors. So to determine the nature and scope in the areas, factors to be considered, I'm going to again tell you the same 4 factors, wherein now let's talk about some of the points here. 1, again, objectivity and level of competence, both are factors. Objectivity and level of competence. Judgment involved. Assessed risk of material misstatement. The assessed RMM is high, then you don't take their direct assistance, you involve and you do it, which is a very basic and obvious need, right? So objectivity, level of competence, judgment involved, and assessed risk of material misstatement. Now, one of the most important points, the area where you are taking their direct assistance, okay, should not be from the areas where internal auditor has already been involved. If he has already done some work there and reported to management, you can't take that. Okay, so objectivity and level of competence are factors we check. Judgment involved, if it's a high judgment is involved in that, then you do it. If the assessed risk of material misstatement is high, then also you will be doing it. and then it should definitely be from one of those areas where he has not done previously. So if you believe that he has done that previously, then there is no point taking his lessons doing it again. It's a self-review thread, okay? And then while taking or using direct assistance, we have to do two things, guys. Very important, this also towards the end, because these are two things that you have to supposedly do. One, okay, take, what do you say, a written agreement. Take written agreement from an authorized representative of management. Take written agreement from an authorized representative of management, saying what, that internal auditors will be allowed, internal auditor will be allowed, internal auditor will be allowed to follow external auditor, and management will not intervene, because they should not poke their nose now, right? So take it in writing from somebody from the management saying that yeah, they will not step into this and they will not intervene in any of these matters, right? Take a written agreement from authorized representative of management that they will not involve into the work that internal auditor is doing as a direct assistance to the external auditor. So it's absolutely between the internal auditor and the external auditor, and we have to very clearly ask the management not to involve or intervene into this. And plus, see, you as an external auditor are always bound by the rule of confidentiality, right? Now, you also have to take or make an agreement with internal auditor, agreement with internal auditor, that he will keep confidential, that he will keep confidential, he will keep confidential all matters that he saw during the audit, all of that will be kept confidential. You will take it. Very important, because see, you are not supposed to open your mouth because you are bound by rule of confidentiality. But you are like, I mean, he is like, I am internal auditor, so I can open. No, because he can't talk on behalf of you. Hey, this is what I did for the external auditor and all. He can't go and tell outside. Okay, so you bind him by the agreement and make sure that you document both these. One copy of the agreement you will take it from management saying that they will not intervene in their work, and two, one agreement you will take from the internal auditor saying that he will not intervene into the, I mean, he will not declare anything outside, and he will keep confidential all the matters that he came across during the course of the audit. So guys, this standard as such, if you want to look at the overview, standard number 610 is broken down in two parts. One, using the work performed by internal auditor, and two, areas where providing direct assistance. So for both, there are conditions that are there. This is pretty much extensively written right now on your screen. Take screenshots of part 1 and part 2 and run through the whole of it. So that brings us to end of another session, wherein we have discussed three wide, varied, important concepts. One on audit risk, section 138 on applicability of internal audit and who will do the internal audit, and if the external auditor wants to use the work of an internal auditor, what all are certain things that he is supposed to do. I will see you with revision part 7, wherein we will be covering aspects of fraud, which is standard number 240, and I will also take you through with an insight in standard number 250, applicability for laws and regulations, and also we are looking at the last standard 299 in that particular case. Okay, so those are the three aspects that we will be looking out in the next session, which will be the last of these series from my side, because company audit and this one, reporting standards and tips on vouching and verification, have already been there available. So that brings us to the conclusion of all the 10-part series. So I will see you soon with part 7, where we will be concluding this revision series. Thank you.
Hi guys, so in this last segment of part 7, we are going to revise 3 very important standards, because all of which have already featured in the exam so many times. So it is pretty much important for us to understand how these 3 standards influence an auditor's activity during the audit. So I'm going to cover 240, which is on fraud completely, and 250, which is going to talk about auditors' duties with respect to laws and regulations, and standard number 299 on joint audit. With this, we will be covering almost all the standards that are applicable to your exam. We have already covered so many. So before I wind up this entire revision series, I would like to let you know that we have already covered right from standard number 210 to 20 on quality control, and then of course we also did the entire coverage of the planning series 300, 320, which is on materiality, 315 and 330 on risk assessments. Then we have got into the 5 series. We did a segment on 500, which is exclusively speaking about the entire concept of audit evidence. Now after that has been taken care of, we had 501, 505, 580, which are the 3 and 510 on opening balances, the 4 standards that of the 5 series we have covered. Then an exclusive session on analytical procedures and sampling, we have covered standards 520 and 530 to have a complete understanding of the 5 series. So the standards that we haven't covered in the 5 series are 560, which is on subsequent events, which is post the audit, if at all you get to know anything which may influence your judgment, that, and 570, which is on going concern. And I believe people can cover these 2 standards. And just in case if I get a chance to do one more, we will put up all those balance standards in one lot, and we will also take care of that. Now before we even move on, I would also want you to know that we did a segment where exclusively we discussed internal audit, standard 610 on using the work of internal auditors, and we also have discussed section 138, which is applicable for those companies as mentioned in that section as per the Companies Act. Also along with that, in that session we discussed the whole concept of audit risk. So I think that has brought us till here, and we also have to have an understanding of why we have to do all of this. As a matter of fact, we did start our entire discussion with saying that the auditor's fundamental responsibility or the objective of doing the entire audit is to obtain sufficient and appropriate audit evidences to make sure that the financial statements are free from material misstatement, and then he can go ahead and safely give a true and fair opinion. But on all this point, also along with these 3 standards, I would also want to know, what is the comfort zone with respect to standard number 230, though it's not a critical standard to be dealt across separately. I will give you a couple of quick insights about standard number 230 on documentation, so that we will be complete in all respects. So let's get started, guys. This would be the the last set of standards that we will be dealing in this revision series, and as already mentioned, this would probably cover all your 8 chapters in the new syllabus, except for that audit in computerized environment, where it's a small topic, and I would like to take you to take the lead in doing that small part. And also along with that, we have a complete revision series ready for the company audit part and audit reports, for which the videos are available for quite some time, and also quick tips on how to present vouching and verification question answers, along with questions on special audit, which are in the likes of education institution, hospital, cinema hall, clubs and all that. I also made the same video wherein you can as well understand how to write those answers. So I think these revision videos, the series of these revision videos have given you an insight of what to do and how to do in audit. And just in case if it has done, please do let us back know. And if there is anything that you are also willing to contribute as part of a feedback, it's always good if you can share it as to us, so that we can try and improve that in the next coming sessions. So it's always a learning experience, so I think you should be upfront and share that upfront in the comment section, whereby you can let us know what is that extra. Of course, I do understand if you're commenting on the chapters that we haven't done, there's a little work left for you to do, because all I did is to put all efforts to bring in these 10-part revision series. And hopefully what we will also do is, by the time these videos are completely taken care of by you, we would also provide you a combined video of all this, wherein you can do a marathon of all of this, and we'll make a playlist to make sure that you do. If it's possible to do a complete marathon video, we will do that. If it's taking too much of length and time, if upload issues are there, then we will make a playlist of all these 10 revision videos and put it in a playlist for you to go through the whole of October, depending on your time slots, and make sure that you rock in the exams that you write in November. So this last piece, let's get started. First, before I start 240, like I told you, I'd just give you a quick insight on standard number 230, which is on documentation, audit documentation. And what are we actually trying to do in audit documentation is also something that I would want to refer it back. So let's move on here, wherein we talk about what is audit documentation. Now this, again, as we go, let's start with definition only. Every time we go with definition. So now also we talk about what is audit documentation, the definition of audit documentation. Audit documentation is nothing but a record of, it's a record of audit procedures performed, record of audit procedures performed. Record of audit procedure performed, because you have to have a proof, right? So tomorrow if somebody is coming and telling you what did you do in the audit, this is what it is. Record of the audit procedures performed. Relevant audit evidences obtained. Relevant audit evidences obtained. Relevant audit evidences obtained. And most importantly, and the conclusions reached. And the conclusions reached. That's the whole point. So it's a record of audit procedures performed, relevant audit evidence is obtained, and the conclusions reached. That will decide what you have done in the audit, and you have to keep a copy of that so that it is useful for future references. So that's the first and foremost thing that I would want you to know about audit documentation, which is nothing but a record of all the audit procedures performed, relevant audit evidence is obtained, and the conclusions reached. Then going forward from here, we also need to understand why do we document. So why becoming an always an important question. The two reasons. Now audit documentation, guys, it serves two primary reasons along with 6 additional reasons. Now this is some piece that I want you to very clearly get into the understanding, because I think you should have a thorough understanding of this. The two primary reasons: one, it serves as a basis. It serves as a basis for auditors' conclusion. Serves as a basis for auditors' conclusion. It's a very clear point. Serves as a basis of the auditor's conclusion. And not just that, it's an evidence, right, that you did the audit. It's an evidence. It serves as a basis for the auditor's conclusion. And how will other people know that you did audit in accordance with standards? So therefore, again, documentation is an evidence. It's an evidence that audit. It's an evidence that audit was planned. Audit was planned and performed. Planned and performed in accordance with SAs, right? All the SAs. It's compulsory that you do this, because these two things are the fundamental reasons as to why we document. Because tomorrow somebody comes and asks you, it could be any regulatory authority, it could be even ICA, asking you for clarity on doing the audit. So it serves as a great basis for you to support your conclusion. Yeah, this is the reason why I got the true and fair conclusion. This is what it is all about. So you can always be very clear about telling that. Apart from telling that as well, it's also important that it serves as an evidence that you are randomly going and telling that you've complied the audit and all that, but it's always better that you try and be very clear about what you're talking of. So you say, and your evidence serves as a very basic purpose for saying that the audit evidence was performed. Audit was performed and audit evidences were collected in accordance with the standards. So you write this as two primary reasons as to why you obtain the audit. Okay. So guys, this is one of the most asked questions from this particular topic. What is the need for documentation? Two primary, and now let's see 6 additional purposes. 1, serves, or you can say assist engagement team. Assist the engagement team. Assist whom? The engagement team to plan and perform the audit. Assist the engagement team to plan and perform the audit. Assist the engagement team to plan and perform the audit. Helps, okay, we are telling them to plan. Once they do the work, should we supervise or not? So again, the documentation helps to direct and supervise the audit. Most importantly, whoever has worked on this audit enables audit team, nobody can run away from their responsibilities, enables the audit team to be accountable for their work, enables audit team to be accountable for their work. Nobody can run away from their responsibilities. And whatever work you do on the documentation, you will be signing on it. So enables the audit team to be accountable for their work. And the next point is a very simple one, because here you're talking about keeping this, like there is one of the points that says that you have to retain audit documentation for a certain period. I'm sure everybody knows it, I'll get to that, but it is nothing but a record of audit work performed, record of audit work, which is, it can be used for future. You can say that used for record of audit work used for future, whatever is future relevant, that one. Then remember we studied about quality control aspects. So if we studied about the quality control aspects, who will check what in the quality control aspects? It's important for you to understand what will the quality control reviewer come and do. The quality control reviewer will also come and check what the documentation only, right? So it enables, actually 5 and 6, it does two things. Enables what? A quality control review, enables a quality control review. And not just it enables a quality control review, it also enables external inspections. Any external inspections, it enables that also. Okay, so that's what the whole thing, guys. Here audit documentation, it serves 2 basic and 6 additional purposes, and that's exactly what we are looking at. It's a record of all the audit procedures performed, and it serves 2 primary and 6 additional purposes. It's a very important part of our discussion, and that is exactly what we try to do and understand in documentation. Apart from this, I would also want you to let 2 more important points in this revision video about documentation. One is let's say the third point, as we discussed, assembly of audit file. When should you do the assembly? Right, assembly of audit file. If quality control reviews and all are there, before even completing the audit, you will have to assemble. Otherwise, normally it's an administrative process, and you have to complete the entire thing within 60 days, from the completion of audit, or 50 days from the date of audit report, you can say that. Because see, this is just a process of putting everything together in the file and all that, but that also should not be ignored, right? So audit documentation is just an administrative process of filing everything into the files, and that should be done within 60 days from the date of signing of the audit report. And one more point that I would like to tell you is about the retention of audit documentation. I hope everybody is aware of the retention and keeping it in very clear terms. 7 years you have to retain the documentation. 7 years from the date of signing of the audit report. From the date of signing of audit report, you have to keep it for 7 long years, and it's a mandatory requirement that you keep the audit documentation for 7 years. And if there is any departure from any laws or regulations, or if you have not done something because there was a particular reason for it, and there is inconsistency with respect to audit evidences, for all these reasons you have to record the reasons and keep it. Okay, so I'm just writing all those as a departure from relevant requirements, or one more point I can add up here is that there is inconsistency in audit evidences, So all this, what you need to do is, for all this also you have to maintain documentation. Okay, it's a fairly very simple limited coverage standard, guys. Standard number 230 talks about maintaining audit documentation, and audit documentation here has spoken about maintaining a record of audit procedures performed and all that, and then this is the piece that you right now see on screen. You take a screenshot of that. That's the major part that you're talking about. 2 primary and 6 additional functions is what the audit documentation, which is one of the favorite question of the examiners from this, if it has to come for 3 or 4 marks. Now if there's a multiple choice question or a true or false question, they can always ask. They have already asked so many times that audit documentation be retained for 8 years, and that will be a false statement. People, they just get you confused to that books of accounts, right? So you will see, then you will immediately get a confusion in the exam. Books of accounts 8 years or documentation, all that. So be very clear. Books of accounts are for 8 years, and audit documentation, okay, working papers, so that are maintained for 7 years from the date of signing of the audit report. Okay, so that's the whole point, and I think I can give you a small technique to remember that right now. You remember this word accounts. Accounts has 8 letters. Okay, so the word accounts has 8 letters, and that is exactly why you will retain it for 8 years. Books of accounts can be kept for 8 years, so no confusion. And since this is kept for 8 years, the only other thing that can be kept for 7 years is what? This. But there also you can have a technique. There also the word auditor has 7 letters, so auditor has to keep it for 7 years. Okay, this is 8 years, and auditor has to keep working papers for 7 years. Go by the letters. The word accounts has 8 letters, and that's why it's called that's why it's 8 years, where in books of accounts. And small techniques, guys, something to remember, right? So not to mess up in the exam, because it costs 1 mark, and it's not easy to just let go of things. So it's something that you can find out. Okay, so it's a first standard. In this part of the discussion, we have audit documentation. Now moving up, next we have standard number 240, which is a very important standard. Now 240 is on fraud. Before we talk anything about 240, I would also want to take you through a little bit about fraud, because fraud has been a separate chapter in the new syllabus. So what is discussed in fraud? Fraud as such, what is it? It's an intentional, fraud is an intentional act. Fraud is an intentional act whereby use of deception, that is cheating, use of deception. And why do you do that? To obtain unjust or illegal advantage. To obtain an unjust or an illegal advantage. So fraud is an intentional act of using deception, that is cheating, to obtain an unjust or an illegal advantage. And because you know this, misstatement can happen because of 2 reasons. One of the reasons why misstatement can happen is misstatements happen because of errors. The other reason why misstatement happen is because misstatements happen because of fraud. Okay, so fraud is nothing but an intentional act. The only thing that separates fraud and error is unintentional, but whereas fraud is absolutely intentional, right? So fraud is an intentional act whereby you're using deception, that is cheating, to obtain an unjust or an illegal advantage. Now if you ask a broader question on how does fraud happen, fraud happens because of fraudulent financial reporting. Fraud happens because of fraudulent financial reporting. And not just that, fraud also happens because of misappropriation of assets. Misappropriation of assets. Now if you see what exactly that means, fraudulent financial reporting talks about falsification, forgery and all that. Falsification of documents, you're talking about falsifying some documents, or forgery, changing something and it is not true and all that, forgery. And then intentional misapplication of accounting principles. Intentional misapplication of accounting principles. These are all some of the points that you need to try and understand. It's about fraudulent financial reporting, falsification, forgery and intentional misapplication of principles. And then misappropriation of assets is again broken down into misappropriation of goods, and the last but the most common kind of fraud is defalcation of cash. Defalcation of cash, wherein there is frauds like teaming and lading, suppressing cash payments, and or inflating cash. Suppressing or inflating the cash, teaming and lading frauds. And I want you guys to focus on this part. Teaming and lading, that alone can be a question. Let me give you an insight on a quick note. Teaming and lading is a fraud whereby what are you doing? You receive money from somebody, you're adjusting it in the name of somebody else, and then you're doing this repeatedly again till the time this keeps going, and always one person's money. Say for example, you received it from one debtor, you won't pass the entry, you'll hold on. When second debtor pays you money, you will adjust the first one. Okay, second debtor is kept open. Then when third debtor pays, that is when you do second. So this one is open. So always that one debtor's money is always with you, and it's keep going on. Before any intimation goes to the debtor, you keep doing this. So you adjust first one. When you receive, you won't pass the entry, you'll hold it. When you receive the second one, you'll adjust the first one. Then third one, then second one. Subsequently, you keep doing this, and this is exactly what is called a teaming and lading fraud. So I guess you got the insight of what fraud exactly is. Fraud is an intentional act wherein you are using deception or cheating to obtain an unjust or an illegal advantage. Fraud leads to fraudulent financial reporting and misappropriation of assets. There are two ways of doing fraud, which is talking about falsification, forgery, and intentional misapplication of accounting principles. And in misappropriation of goods, wherein you see what exactly is misappropriation of goods, that also can be spoken of. And then you're talking about defalcation of cash. You know what defalcation of cash is? Is suppressing cash receipts or inflating cash payments, or then doing teaming and lading. All these are the broader reasons for fraud. Now, why? Very important question. Why there is a fraud happening? Why? Why? Because there is a incentive or pressure. Somebody is feeling a pressure, that's why they are doing a fraud. Or somebody sees some gain in doing it, so they wait for an incentive. Or somebody does it because there is an opportunity to commit fraud. And the third reason is quite amazing. You know why they're doing fraud? Because they don't feel they're doing a fraud. They've rationalized their attitude, or they rationalize their mind, saying that what they're doing is right. Okay, so attitude or rationalization. Now there is nothing that I can speak about this, because he is somebody who has rationalized their mind. What I'm doing is I'm fine with it. It's not a fraud. And when they think like that, there is nothing that you can really do about it. Okay. So the incentive or pressure, there's an opportunity or attitude and rationalization, all of which can lead to quite a great damage. Okay. So that is all the reasons, the four reasons that you see as to why fraud happens. It can happen either because of an incentive or pressure, it can happen because of an opportunity, or there is somebody's attitude or rationalization which allows, their mind allows them to do that fraud and comfortably even get away with it. Now that's the best part. You do it and you don't feel that you've done something wrong. So, and there are examples under each of this which I would want you to go through, because that's one of the important parts of this story. Now let me take you through the two important parts. The standard 240, wherein you're talking about one, responsibility of management. Yes, this is very important, because the primary responsibility to prevent or detect and correct a fraud, primary responsibility to detect a fraud, rests with the management. We are not involved in finding out frauds. See, we are not set out here on a mission to go and find out frauds. The primary responsibility to find out a fraud is the responsibility of management. Having said that, then what is auditor's responsibility? Auditor's responsibility is during the course of the audit, if at all he comes across a fraud, then auditors have to bring it to the attention of management or TCWG. Now, please understand, you are not going on a hunting exercise to find out fraud. What is a fraud? And we will go and set out and find frauds. No, that's not your objective. What's your objective is very clear. You do the audit, but during the audit, now when as matter of fact, auditor should be what? He should follow professional skepticism, and I hope everybody knows what professional skepticism means, right? It's an attitude of having two things. Professional skepticism is about two things. What? A questioning mind. It's about questioning mind and being alert to conditions. Being alert to conditions. So it's very important. You have a questioning mind and you're being alert to the conditions, right? That's what professional skepticism is about. So be alert like that with respect to fraud also, because you are nowhere on a hunting exercise to go and find out frauds. Nobody has given you that responsibility also. Your responsibility still remains the same. What is that? Obtaining reasonable assurance that the financial statements are free from material misstatement, and then you give the opinion. That's it. That's your job. You are not doing anything more or less. Okay? Frauds happen, that is because of lapse of internal controls, which is the responsibility of management to set up a zone. Primary responsibility always rests on the shoulders of management. It's not on you. You don't have to take it on your head. Got it? And after that, it is also important for you to understand that auditor's responsibility is to keep it during the course of the audit. Whatever is the fact that you have seen this, it is important for you to understand how you will be using this as part of the entire thing to drive that content. So you follow professional skepticism, you go by your audit, gather evidences, and during the process of audit, if at all there are indicators, now that is where I come to the last topic in fraud, indications of a possible fraud or a possibility, indicators of possibility of fraud. You know what this is called? Indicators of possibility of fraud. This is called a fraud risk factor. It's called a fraud risk factor. When you say this is what fraud risk factor is all about, that's what you need to understand. Fraud risk factor is a possibility of fraud. It's not a fraud. And when you find a fraud risk factor, all that you need to do is to obtain more audit evidence. You have to probe into that area because your professional skepticism reveals that there is a possibility of a fraud. Obtain more audit evidence. And but then towards the end, if auditor concludes that financial statements are not free from misstatement, that too due to fraud. Now obviously at this point of time you will report to management or TCWG, report to TCWG, and based on the response modify report as per SA 705. Things don't work out, that's what you're going to do there. Modify the report as per SA 705. I hope you got this one, guys. So it's a very quick insight of what the entire concept of fraud is all about, right? Three parts to the story that I've discussed here. First up, we talk about what is fraud. It's an intentional act of using this deception. Fraud happens because of fraudulent financial reporting and misappropriation of assets. And then fraud happens because of the four reasons as to incentive of pressure, opportunity, attitude, and rationalization. And what is management's responsibility? What is our responsibility? The concept of professional skepticism to be applied while checking for fraud, and the concept of a fraud risk factor wherein you have to obtain more audit evidence to see that it's just a possibility and not the truth. But if at all you conclude or you find that there is a possibility of a fraud and that really needs to a suspected or an actual fraud, communicate it to the TCWG, and if they make corrections and take action, very good. If they don't, you might want to modify the report as per SA 705. Okay, that brings us to the conclusion of standard number 240, and the next standard that we are looking at in this series is SA 250, which is on auditor's responsibility with respect to laws and regulations. Now at this outset, as I always start with, I need to tell you and understand that there are two types of laws and regulations. One which have a direct effect on the financial statements. Direct effect on financial statement, maybe like income tax laws, labor laws. There are certain laws that have a direct effect on the numbers.
But there are certain laws that do not have a direct effect, do not have a direct effect. They do not have a direct effect. And now that they do not have a direct effect, this is the major part of the story here. Because they do not have a direct effect on financial statement, you should not think that they're not responsible. Like say for example, prevention of child labor. Now you are saying that as per the Child Labor Act, children are not to be employed, but on the factory premises, you found some children working. And okay, you found this. What if tomorrow some vigilance authorities find this and they put a seal to the company saying that because children are employed on the factory, let's lock this down. Now, that's a serious thing that will continue to, that will end the continuity of the firm, which is like there is a issue on going concern now. As of now, it was just spoken about as a law that has nothing to do with financial statement. But right now, the entire going concern is stopped. So all I'm saying is there are certain laws which affect the numbers, like payment of gratuity act. You compute gratuity. Payment of bonus act. Compute the bonus. Income tax act. You go for provision for tax. So all these have a direct effect on the financial statements. While there are some laws which do not have a direct effect, but they not having a direct effect, no, that could possibly lead to an indirect effect. You don't use the word indirect because not used in the standard. You say do not have a direct effect, but some way or the other they also have a effect. That's the point. So first we need to be very clear about this classification, that there are two types of laws that have a direct effect and which do not have a direct effect. Now what are we so bothered about in this standard is non-compliance, because if they are complying with the law, nobody is having a problem. No, you just gather sufficient approved audit evidence to see whether they are doing that properly. Non-compliance, what do you mean by that? Whereby you're doing something contrary to the laws or regulations. If you do anything contrary to the laws or regulations, that's what leads to a non-compliance. Okay. Now, again, getting to the two most important things here: responsibility of management, and responsibility of auditor. Now guys, again the story is very simple. You need to understand how we are dealing with this, because again it is not our primary responsibility to go and make sure that somebody complies with laws and regulations. It's not our business. But having said that, I also want to make you understand that it is a responsibility of management. What is the responsibility of management? To make sure that the entity complies with all applicable laws and regulations. This is the part of the story here, right? So talks about non-compliance, wherein you talk about responsibility of management, wherein to make sure that entity complies with all applicable laws and regulations. Then what is the duty of the auditor? See, it is their duty to comply. Our duty is to just check, that is evaluate whether there are any non-compliances. Auditor's responsibility to obtain sufficient appropriate audit evidence that the entity has or complies with the laws and regulations. So our duty in this standard is to obtain sufficient appropriate audit evidences to make sure that we are not responsible. Definitely, I'm making it very clear once again, guys. Auditor is not responsible for complying. Okay, auditor is not responsible for complying the laws and regulations. That is a duty of management. Our duty is to just obtain an understanding of what are the laws applicable to them and see whether they have complied all the laws and regulations. Now for this, auditor is to conduct an extensive understanding about what laws are applicable. That I can tell you, because first make a list of what laws are applicable. What is auditor's duty here? Auditor obtain a general understanding or obtain an understanding of laws and regulations applicable to the entity. It's a very important point. What are the laws and regulations applicable to the entity? Make a understanding of that. And C, then you obtain sufficient appropriate audit evidences, okay, in this regard, that they have complied. Now let's get to the major part and the conclusive part of the standard, because the standard is very simple. It talks about what laws are applicable,
to the entity whether they have complied with it or not. All laws may or may not have a direct effect, that also has been discussed. Then we spoke about duty of the management and duty of the auditor, and auditor has to obtain a thorough understanding of what laws are applicable, because sometimes it may so happen that auditor, after preparing a list of all the laws applicable, he's telling the entity why you didn't comply. Entity is like, we don't know. So there can always be a possibility that management is not aware of the fact that they have to comply with the laws and regulations. I think that is going to create a problem later. Okay, so you have to obtain sufficient appropriate audit evidences in this regard, and you have to be very clear about what evidences are being collected here, and make sure that there is no non-compliance. Now, very important point, if auditor identifies or suspects any non-compliance, if auditor identifies or suspects any non-compliance, what is supposed to do? First, report to TCWG. Now 9 out of 10 times we expect that TCWG should take an action. If they act upon it, just like how you saw in fraud, if you communicate to them and if they take up the action and everything is taken care of, then there is no problem at all. Just in case they don't do and non-compliance remains like that, and if the non-compliance appears to be intentional, which is like again a fraud, you might want to communicate that to the TCWG. And very important point is to consider the effect on audit report. Now what you need to understand at this point of time, when you say consider, I'll explain that consider piece here. Consider the effect on audit report is nothing but, if auditor, there are two things here. If auditor concludes, now you know this, if auditor concludes that there is non-compliance, when you use the word concludes, normally when do you use the word concludes? Only when you have evidence, right? So if auditor concludes that there is non-compliance, then he will go for qualified or adverse. Okay, then if auditor is unable to obtain sufficient appropriate audit evidences, then auditor shall go for qualified or disclaimer. Now this purely depends on the evidence, guys. This is absolute 705, SA 705, depending on what evidence you have or not. So because if you have come this far, if you're doing this, I think 705 piece is very easy, because that's the ultimate reporting part of every standard. So there I don't think you will have any problem. And lastly, you also have, if you have identified non-compliance, duty to report to enforcement authorities. On your own, if you are going and telling, sometimes it may breach the rule of confidentiality, okay? But if it's not on the own, and if you're going and communicating to them because you have to, it's a responsibility, so that you have to determine responsibility as per laws and regulations. That's the point. So you will determine as per laws and regulations. You will not go and simply outburst and tell whatever you're supposed to, because that's not needed all the time. So yeah, auditor should obtain an understanding of the laws and regulations applicable to the entity, obtain sufficient appropriate audit evidences, and if the auditor identifies or suspects any non-compliance, you report either TCWG, consider the effect on audit report, and see if there's a duty on you to communicate to the enforcement authorities. So that is what is the whole crux of 250. Okay, so 250 spoke about two types of laws which have direct effect, do not have a direct effect. What are you supposed to do if you identify? What is a non-compliance? When something is contrary. And then what is the responsibility of management and auditor? And this whole piece of your reporting aspects, right? That brings us to the last standard for this session and also this entire series, is standard number 299, which is on the responsibility of joint auditors. What is the responsibility of joint auditors? First of all, who are joint auditors? Where more than one auditor is involved. where more than one auditor is involved in auditing the financial statements, where more than one auditor is involved in auditing the financial statements. Now that's what is something that relates to joint audit, where more than one auditor is doing the audit of same set of financial statements, then that will only be termed as a joint audit. So you need to understand when and how joint audit is to be done. First of all, joint audit, as I told you now, is done by more than one joint auditor. And very important, SA 299 does not deal with using work of auditor of a component, using work of auditor of a component. You know what is when I speak about using the work of auditor component, because this is dealt in standard number 600. So 299 is responsibility of joint auditors. You got nothing to do with the work of a component. Component here is about the branch, division, subsidiary, associate and joint venture. This is what is discussed there. But the auditors of this, you can use their work, but that's discussed in standard number 600. So standard number 299 does not deal with any of that. Standard number 299 straight deals with joint auditors responsibilities. And of course, very simple, and there are only a couple of points that I would want you to know from the standard, because this standard as such, if you see what is the crux part of the standard, each joint auditor is responsible for their own work. Each joint auditor is responsible for planning and performing their own work, and this is all very clear. So when you say joint audit, there are two things that come to somebody's mind. What is that? One is sole responsibility. Where is the joint auditor solely responsible? And where is the responsibility joint and several responsibility? Where is joint and several? This is the major part of the standard. Sole responsibility for three areas. So I can straight tell you: one, work allocated to him or work assigned to him. Okay. Two, for his own audit program. And then for all the audit documentation that he has to maintain. For all of the audit documentation. Now this is something that definitely you need to be really concerned about, because you have a sole responsibility with respect to all these. But when you talk about joint and several responsibility, what is it with respect to joint and several responsibility? Now if you see what is the joint and because for all these you are doing it, so you are responsible. One, work not divided. For all the work that is not divided, all you guys are responsible. Okay. And two, I want you to concentrate on this point. Matters brought to knowledge of one auditor. Matters brought to knowledge of all auditors by one, on which all agree. See, you guys have agreed together, right? Then you're all responsible also together. Understood? It's a very important point. No, though only one person told, why are others bothered about it and all that. So the fact is that it was brought by one, but it's collectively responsible for everybody, because all of you have agreed. Otherwise, don't agree. Okay. So what happens if I don't agree? We will see that piece also. And for the NTE, nature, extent of audit procedures, all of you are jointly and severally responsible. And then I can add up one more thing. For all presentation and disclosure aspects, all reply. And then lastly, compliance of relevant statutes, all the following the standards and all that. And for audit reporting. This is the major part of the standard, guys. Rest of the part, I think you can have a glance, but if this is something to be revised very well. Yeah, this is the thing. One very important thing: what is joint audit? Where more than one auditor is involved in doing the audit, and it does not deal with this piece. The non-applicability of the standard is also discussed. And if at all you find something where you want to communicate to the TCWG, you can do so. Now there is one very more important point which I'll be discussing in the next one, but before that, what is sole responsibility, what is joint responsibility? Are you clear with this? 3 points are sole and these 5 points are your joint responsibility. Now, very important question to the last piece of the standard, wherein we just spoke about something where a matter was brought to the knowledge of all partners, but some of them didn't agree, right? The joint auditors didn't agree. So is there a obligation that because majority people agreed, I should also agree, right? What is that happens in case of difference of opinion? This is the last but very important point. So many times it's been asked. It can be asked as a true or false. It can be asked as a short question. Difference of opinion in joint audit. Difference of opinion in joint audit. Now please understand, if there is a difference of opinion in joint audit, one, auditors are not bound by, remember very clearly, I'm writing it, not bound, all in caps, not bound by majority. They are not bound by majority. Very simple. Okay, auditors are not bound by majority. Each auditor can give a separate report. I mean, whoever are agreeing together, they all can give a collective report. See, normally there is one report issued in the joint audit. After joint audit is over, normally one report only is issued. But if there is only difference of opinion, then they are not bound by majority. Because other two told, I should also, then there is no rule of that sort, is what I am trying to make it very clear. Each joint auditor can give a separate opinion. There is no rule that you're bound by any majority. Each auditor can give a separate opinion. But when you're doing this, when you're giving a separate opinion, you might care to include another matters paragraph as per SA 706. Just say that other auditors have made other reports, so you have to just care to give a other matters paragraph. Otherwise, there is nothing that stops you from doing any of these things. I hope everybody is understanding this. Auditors are not bound by majority opinion. Each auditor can give their opinion. You can give a separate report, but just make sure that there is a other matters paragraph. That's it, guys. That's what we have in this particular standard 299 read with 706 to give the other matters paragraph. So guys, I hope that brings us to the end of this revision series. I've recorded 7 parts, and this being the 7th part. I'm very glad that whoever have watched all this through, and if you've been watching all this, thank you so much for being a constant support. And every time, it's only because you guys watch, it gives me a feeling that I have to do more and all that. And thanks for all the feedback that people have been sharing. And just in case you have anything more to share, you can always keep sharing on the platform. We also have an Instagram platform which is titled CAHK Classes, which is my official handle for classes. So if you guys haven't been there yet, you can, if you're watching this, you can always get onto Instagram. And of course, if it's disturbing and deviating, do not. But then otherwise, if you want to use it for a purpose, you can always get onto the Instagram channel, wherein we have always been posting something or the other very much relevant to your studies. So yeah, that brings us to the end of an amazing 7-part revision series, 3 parts of which are already available on YouTube. So that makes it a 10-part revision series. And hopefully, now that this 10th part is also released, the 7th part is also released. So all 10 parts, I try and bring them all in a playlist. And first up, we'll also try to make it a combined marathon video of all the parts, if it's possible to do so. But I think we will have time limit issues. So just in case if we don't, then we'll try and do that. And if it is possible to do that, that will be amazing. Otherwise, you have all the 10 parts in one place. So all I wish is you to take cues from this revision videos. Keep constantly revising. That's the key for a subject like audit, and make the most out of it. So I hope your exam goes well in November, and if at all these videos have helped you thus far, and you believe that they're going to help you further in your preparation, do share these with your other friends to absolutely help them also. There is nothing that it's always grow together is a great philosophy. So you can share it with others and also let them do well in their exams. So I wish you all the best for the upcoming exams, and I just hope that you come out with great results. Thank you, guys.